ladies and gentlemen, distinguished guests, it's a great pleasure welcoming you here to another annual economic conference by the Austrian National Bank. I would like to welcome everybody and anyone here who is either here in person, and I see that the take-up rate to those that are registered is not too bad. Great, thanks for coming. And also to welcome those that are electronically linked with us. Reportedly, 200 people are watching us from afar. And I hope, that most of them will not be tempted to try two things at the same time. It doesn't work so much, but have the opportunity to stay with us and get focused on these great papers we're going to hear. And those would like to extend my warm and hearted thanks to everybody who was working to make this conference possible. So those who are in front, but also those who are behind, thank you very much. Last year's conference, we explored central bank of the future, opportunities and challenges, and our discussion then laid to some extent groundwork on issues we are facing today. And over the last year, we also saw a number of issues and substantial challenges, each with the potential to reshape global economic landscape, but also the very framework of monetary policy we are operating in. And for this reason, as to be expected, we are approaching this year's theme, namely monetary policy and structural tectonic shifts. And this is very much how we feel and see the tectonic shift coming through earthquakes and volcanic eruption. So this is what we see also here. The world has recently experienced geopolitical tremors, disruption that have shaken long-term assumptions and institutions. And in my opening remarks, I would like to offer the overview was disruption as I see it heading us, and what in the future we can do, and many of the papers will focus on this one. So let me start with some reflection of the past 12 years. Since our last conference, the inflation landscape has shifted substantially after a long or some period of rising prices. We had the situation in which through decisive monetary policy actions, we were able to stabilize the situation, and encouragingly for Europe in June 24, after high level inflation, we started and had the opportunity to start to decrease the interest rates, and we came down from 4% to 2.25% now. And as you know, we will soon have our next meeting in Frankfurt in less than 2 weeks. However, as we know, the inflation surge and the subsequent development have also revealed new layers of complexity in maintaining price stability. Today, central banks must navigate an environment that is more intricate more than ever. Traditional tools often behave in unpredictable ways when they are used in times of global disruptions. During the recent inflationary period, the factors at the forefront of our concerns include disrupted supply chains, volatile energy prices, and the ongoing unwinding of unconventional monetary policy instruments. As we look ahead, I believe we must approach the current challenges in two distinct blocks. The first, the emerging trends that would have shaped the economic and financial landscape if the current tectonic shift emerging from the US had not arrived, so something which would have happened anyhow. And then in this context, I think we have to touch on artificial intelligence, financial innovation, and new insights on the natural rate of interest. Second, now a couple of months after the second term of President Trump presidency, we find ourselves faced with new challenges in a truly uncharted territory. Frequent shifting economic signals from the US continue to inject a layer of unpredictability and thus uncertainty, which further complicates the task for policymaking. What are the three big challenges shaping the future of money and policy independent of Mr. Trump? The first one is to draw the attention on the cryptocurrency sphere that has gained grown relevance and potentially systemic impacts. This is stablecoins. Unlike highly volatile cryptocurrencies, stablecoins such as Bitcoin, Ethereum are backed to a reference asset like the US dollar, offering greater price stability and edging closer of meeting traditional functions of money. Dollar-backed stablecoins such as Ether and USDC have grown substantially in both markets capitalization and global reach, yet, as highlighted by Board Governor Christopher Waller, this rapidly growing growth brings with it a serious regulatory and monetary policy challenge for all of us. And it was this paper, when I read it some 1 or 2 months ago, which alerted me. And in the meantime, I think the alert with regard to stable coins has become pretty widespread. Second, as in the realm of technology, recent developments in artificial intelligence have the potential to fundamentally alter the ways we live and the extension, the structure of the global economy. I suspect that most of today's audience have already interacted with AI in some form, whether through highly productive purposes or perhaps only more with experimentation to find out if one prepares a little speech to use AI to find out how well they're doing. And I have to say they're doing pretty well. Yet the broad implication goes beyond personal use of AI. And as a result of it, we have to have a very close look there. From reshaping entire industries to transforming the very nature of work, AI introduces both unprecedented opportunities and significant challenges. One critical issue of traditional economic indicators may fall short in capturing the true implication of AI, especially knowledge-based sectors. And about a month ago, we had in this biannual economic meeting, we had a discussion about AI. And frankly speaking, some of these predictions there are really, creating tremors in many of our minds, what the economy and what the particular labor market in the future may look like. And third, this is where many of the points I've raised are concerning coming together. The natural rate of interest, to our star, has returned on the stage as more recent developments have suggested a re-increase, modest so far with the projection moving on. On this part is what our star has brought down. This is this part of lower productivity and also lower labor force growth goes in the opposite direction. But what more recent papers have shown, and also I think in sync with what we have seen in the past, these are not the only ones. What is also shaping our star and the changer is the role of longer-term financial assets, particular government assets there. And here, if this view is correct, we may be in front of a re-increase, which of course matters, how we set monetary policy. And with Ernst Klan, that opportunity to prepare a paper for a handbook, and this had allowed us to really rethink it, and in particular to rethink A star from the monetary side with a fiscal A star, and they are to some extent closely connected. They are the linchpins for our work. Now, let me briefly also touch on the enormous global investment needs to fight climate change. We know the magnitudes, 4.5 trillion by 2030, if and as we want to keep climate at 1.5 degrees target. Closing the gap will be a challenge for public and private investment as we have it, but also it will something which will raise the global interest rate for this, and this, given when I talked before about our star, is quite likely to provide some challenge then for financing it. But on the other hand, it offers also a prospect for growth, especially in regions that has been untapped so far. So in this way, green transition can contribute not only to achieving the climate claim, but also perhaps contributing to macroeconomic stability. And finally, central banks, of course, are well aware of the changing world and thus engage in a thorough review of strategies. The Fed has announced its results to produce August, early September. I would assume along Jackson Hole it will be there. Canada has already produced its review, in particular also on this unconventional monetary policy that have been introduced. And our own review is ongoing as we speak. We had in Porto 3 weeks ago now, a great meeting there where we discussed the outcomes, but also prepared things like thinking about what will be our reaction function in the future. And this will give certainly quite some discussion what it is, but what seems to be unchanged, though the 2% inflation rate, how to say, nobody touched. And for Europe, moving from a slightly asymmetric to a symmetric inflation rate, I think was a great move, and this helped for stabilizing expectations. Now to the second part. So this had been done anyhow. What has the US administration provided? What kind of dramatic shift have they come in? So what are the ones that we have in mind? First, current US foreign and trade policies are triggering a series of events that continue to vibrate all over the world. And frequent shifts in trade policy announcement have fueled economic uncertainty, undermining stability, and resulting in tangible losses for all. As we found out, it's a topic everywhere. If uncertainty increases, everything freezes. Any kind of decision of investments and savings and other, and the result of it, we are, in particular in Austria, where the savings rate is not coming down. The result of it, the push we should get from consumption is not happening. A second part of it is also that President Trump has made a number of announcements of withdrawing from the international scene. What has already happened as regards to the World Health Organization, but also, as you may know, what is under review by the US administration is the participation in the IMF and the World Bank. The news is that the US has said, no, we don't want to leave her. We are more or less interested of retaking the helm there. The question is whether one should, how to say, prefer this one than leaving. I think it is. But the question is, how to say, how we find with them a way of working together. In some parts, I have to say, I even agree with them. You may have read the paper 2 years ago in which I somewhat criticized the IMF to move too far away. But the question is, what are the other elements the US wants to introduce in the current structure and programming? And the third part, of course, is what is the role of the dollar in the international setting, and given if the role of the dollar diminishes, what the role of the euro. This is certainly something which will occupy us at the policy level as well as the political level. How to say, is Europe big enough, strong enough in order to take on a little bit of this role, and how would the multi-polar part and multi-polar currency world live by? Because as we know, Triffin, trilemma, if and as you are a leading currency, you have to provide the liquidity, and providing the liquidity also brings with it a number of obligations, which, for example, even within Europe, we've already done. We provided liquidity for our neighboring countries in Central and Eastern Europe during the COVID crisis, and I think it was an important element of stabilization. And of course, the fourth thing is what appears as a major challenge for Europe is the commitment of US with regards to NATO, and here what it means then with regards to defense spending, how it is done, how it is financed, and this is a way also something we have to think how we will react to it at the ECB level if and as monetary challenges or financing challenges came up. Now, how do we think then about our monetary policy under these challenges that we have? And as I've seen, there are many there. Well, I think the first challenge is the challenge and commitment to a regular, very frank and open review of what we have been doing. And here, I think it's not a surprise. I think what we've been doing at ECB could have been improved. There has been very little critical discussions about unconventional monetary policy there. And I think this is something, if and as one wants to remain credible, one needs also to be credible in one's use. But on the other hand, what also remains is that our approach to policy making, what we have, the way how we're doing it, must remain transparent and open. And I think this is something I'm sure we can all commit to. And as a result of it, in order to open the discussion today, what the policy part, tomorrow the more academic part, it's a great pleasure to have a keynote speaker like Daniel Gross. Thanks for making yourself available, but also for who will from the Bank of England, alongside with other distinguished experts what we have here. I think the insights from the policy part, but also from the academic part, will help us to improve our policy setting and understanding. And tomorrow, we have what also characterizes central banks with more the academic part, in which members from different institutions then can rub shoulders with the academic colleagues in order to discuss interesting papers. So I wish us all a productive conference. I think the papers and the setting allows that. I wish those who are listening now, I'd say the best luck to just select the right papers and listening to them when listening to here. And I move now over to my second task I have, which is to introduce Daniel Gross to this conference there. So first part is finished, second part. Exactly. So the opening speaker, very happy that Daniel Gross could make it, and one could bring him up from sunny Bologna into also sunny Vienna here. It's a great privilege to introduce Daniel Gross. I would claim one of Europe's most influential economists and leading voice in policy-oriented research and debate. Daniel, who was renowned for his work we had been doing at the the Brussels think tanker, has moved now in his another career, not retirement, another career, down to Bologna. Bocconi University is now director and professor of practice of the Institute of Economic Policy Making. And I'm happy to see that the idea of professors of practice also has taken root in Europe. As I know, he had many opportunities to go to faculties and become a TAIC professor on one with his competitors, but he decided to stay in policy making and not go to academia. Now he moves somewhat back. I think that's a great move there. His distinguished career covers academia, think tanks, and high-level policy advisors. He holds a PhD from the University of Chicago and teaching positions in many institutions in Europe, Collège d'Europe, Goethe University, and Bocconi University itself. He was for 20 years, 2000 to 2020, director of the Center of European Policy Studies, one of the main think tanks in Europe on policy setting, and also a distinguished fellow and board member of CBS of SAPS. And Daniel's writing, which I'm sure all of you have at one moment come across, covers many things, has been always been very clear, theoretically based, but very policy-oriented. And I recall his writing when the question of sanctions come up, when he came up with a great idea, let's lose a sanction, use tariffs, was not taken on by the European Union. Nowadays, now they move back to this option there. So Daniel Gross, how to say, one of these outstanding thinkers in Europe in this area. I think he's the best person to introduce it on the policy part of this first morning. And it's a great pleasure and privilege for me to welcome him here. And I hope you do so also with a great applause. Thank you.
Yeah, dear Governor, dear Robert, many thanks for this introduction. I must say, I myself have fond memories of. Okay, I'm a bit shorter then. So, very fond memories of previous editions of your annual conference. And as you have heard, I go a long way back in Europe. That was even before the euro came. And I think it's a testimony also to the road that Europe has made over the last decades. And whenever you look back 5 years, 10 years, 20 years, you always see progress in Europe. And I think we should keep that in mind in these difficult times. And as the old proverb goes, a crisis always also an opportunity. Now, Robert, you already have talked about lots of the challenges that we are facing. Perhaps luckily for central bankers, they do not arise from whatever their own mistakes. They do not arise mainly in the monetary sphere. And that is also why I would like to emphasize now two particular points, maybe points which you didn't emphasize that much, which I think have a strong bearing on monetary policy. Indirectly, but still I think they provide the background in a way which maybe is not as widely perceived as it should be. There, what I would like to emphasize are two things. First of all, there's this global interplay between the three major powers, which is both economic and political. I will concentrate on the economic side. I think you all know very much the political tensions. And I would like to emphasize the different nature of the challenges posed by, let's say, the two overbearing neighbors here of Europe, namely the US and China. And you will see later why I think the challenge is very, very different. And also, I think one has to distinguish something that you mentioned already in your speech, namely between the tectonic shifts that are ongoing and the more what I regard short-term volatility. And my main message will be that actually the short-term volatility that Trump creates, especially on the trade area, the impact of that on Europe is actually limited. And I would submit to you that the more longer-term challenge, the tectonic shift coming from China, is the more important one. And let me see whether I can get through in my time through both issues. Now, let me start with what preoccupies us every day, what we read in the Financial Times and every minute. This is this uncertainty. You already have seen, I presume, this indicator of economic policy uncertainty, which for once seems to confirm the very often repeated assertion that today's uncertainty is unprecedented. This seems to be the case, although one has to see that we have seen ups and downs in this indicator, and there's a certain mean reversion. And for me, that is already a first implication for monetary policy, and of course other policies as well, that it doesn't pay to react to every, in this case this is monthly data, to every monthly development. This goes up and down, the level is higher, but one has to keep in mind, as I said, this negative autocorrelation, which in my view is already the first point that you cannot react to it on a monthly basis. Now, this is the broader economic policy uncertainty created by Trump. I will come to the trade part later, but of course it's not just trade policy, it's also, as we read in the Financial Times now, it is also the overall fiscal policy and other policies that are highly uncertain. By the way, there it's not just his personal preferences that count, which is the case in trade policy, but in fiscal policy there's also this interplay between Trump and the US Congress. And I think what monetary policy in Europe should mainly be concerned about is that there might be some disruptions in financial markets. These are, I think, for the time being, low probability events, but high impact. And the second uncertainty which is related to that is how would actually an attack on the dollar, let's say people no longer trust US fiscal policy, how would that play out? And it could play out in Europe in two very different ways. One would be a general flight into euro assets. That would lead to an appreciation of the euro. But European financial markets should remain rather stable. Actually, the stability might increase. The second way it could play out, and I think that's the more difficult one to deal with, is if there's a general selling of risky assets. So the famous risk-off generalized in financial markets. And then, of course, that can create tensions within the euro area because we have some weaker sovereigns. I was going to say we also have some weaker banks, but luckily, thanks, I think, to the very strict supervision of the SSM, European banks are pretty solid right now. So the question is, what can your monetary policy actually do? On the potential tensions in the sovereign debt market, we already now have, I think, enough mechanisms that could be activated if that were really the case. But that is when the event arrives. What can you do before the event arrives, and as you're basically waiting and hope it doesn't happen? Then I would say you keep your supervision extremely tight, even if banks complain, because you want to make sure that when something happens, our banking system can withstand any problems. And at the level of fiscal policy, you have to also keep debt under control, both by keeping deficits so low that the debt level is declining, because the level you cannot change too quickly. And then I think you also keep your powder dry. So in terms of the unconventional monetary policy of the ECB, I would say you sell your assets as quickly as you can, as long as the sun is still shining, or the sky is only cloudy, not yet a thunderstorm, because then you have the ammunition you might need in extreme case. So I think this is all one can do at the European side, because most of the potential financial market instability arises from the US. But I would say generalized caution and, as I said, keep your options open to as much as possible. But of course, we all know and read every day, the main source of uncertainty in the US is protectionism or trade policy. So if you look carefully at the title for this slide, you see this is about trade policy uncertainty. The previous one was just about generalized economic policy uncertainty. And it is even more true here that in terms of trade policy uncertainty, it has gone up in a level which is really not comparable to what we have previously, even under the previous Trump administration. So, but here even more, you see, this is high-frequency data, not monthly, but actually weekly. So you see that there's even a stronger negative autocorrelation. The more it goes up, and also the more it comes down, because we don't know where it will go from here. But I think that is another lesson for me, not to look too much at what is happening daily, but try to go look through the fog of war and see what are the trends and what are the implications for Europe. And this is what I would like to go into. So uncertainty might be with us for a long time, but actually, now in terms of also the trade policy uncertainty, which for firms could be similar to what you think about price uncertainty, right? How will the markets go? What price can I charge in the market? And here I think there's a very important distinction to be made between a temporary bout of uncertainty, which leads what we call the option value of waiting. So if you think in 90 days, you will know what the tariff rates will be. Then you say, stop, I don't invest. And after 90 days, Trumpian 90 days might be a bit more or a bit less, never knows. And then you will invest. But this would mean that there would be a very short but sharp impact that would then reverse itself. Again, for monetary policy that is looking at the medium term, I would say that's something you look through. A different issue is a permanently level of higher uncertainty. And here I would submit to you that actually the impact of a permanent level of higher uncertainty is very different. It could actually mean that you invest more. Think about the famous question how supply chains are more uncertain. Will you be able always to get your products? One way to react to that is to say, I build more factories, I build some excess capacity, so that when one country does something, I can still shift to another. So a permanent level of higher uncertainty could have a very different impact on investment than the very temporary one. And that's why I think we have to really be careful. How do you think about Trumps? Do we have 90 days and then we know? Or will it always be uncertain because every day he wakes up with a new idea? Right? I tend to let's say, to the former view, in a sense that not all, but a lot of the uncertainty will be resolved as Trump autocorrects, as you see the reaction of financial markets. and therefore I think we can looking forward to some sort of base case around which there will be some variation that looks like the hypothesis which I put up to you here. So let's say tariff rates around 30, 40 for China, and let's say 10 to 20 in this range on the EU, and actually similar for most of the rest of the world. Now, what would be the impact of that on the rest of the world, and in particular in Europe? So the first point is that actually most economists would assume that the trade policy does not have an impact on the overall current account deficit. That's basically the difference between investment and savings. Given you here the numbers for the US, 17% savings rate and 21% investment rate. I will say a bit more where this 21% comes from and to what extent there's any uncertainty about that. But if that's the argument that Trump doesn't change the US deficit, then the same thing should also apply to the EU and China and everybody else in the world. So that means that the Trumpian trade policy should reduce the volume of global trade, but not the overall balances. What will be affected are the shifts in bilateral balances, right? And there the shift can actually be rather strong because, as we have seen also with the previous Trump tariffs, it didn't have any impact on the US trade deficit, but on the bilateral one with China, there was a stronger effect. So I think we have to distinguish very carefully between the bilateral deficits and the overall ones. Now, what is the overall impact then? It means that global welfare falls, but most of the impact will be on the US and not on the rest of the world. One key assumption I'm making here is that it is mainly the US which increases protection vis-à-vis all its partners. Maybe the partners react, but that will affect by itself only about 15% of global trade. So the remaining 85% will remain open, if and only if of course the other ones don't start erecting trade barriers among themselves. I make a parenthesis here, something similar happened with the smooth Hawley tariffs of the 1930s. The US started, and the impact by itself was not so big, but then many countries started protecting themselves against the deflected trade. And so this is something which I would like to come back. Now, for Europe, I would actually submit to you that there are opportunities from trade diversion. And that is because my presumption is that there will remain a big difference between the tariff rates the US imposes on the EU and on China, with a large differential in favor of us. So I've given you here, let's say 40-20, right? That actually in economic terms you can view as a 40% tariff overall of the US with a 20% subsidy for the EU. And I think that gives you an idea why the impact on the EU doesn't have to be negative. Now, even if especially if you assume that China retaliates against the US, then economic theory always tells you that this will actually be good for the rest of the world net. Why? For Europe, if you look at single markets, EU exporters have no longer Chinese competition, which is the biggest bane. On the US market, which is large, and also they have an advantage over the US on the Chinese markets. So there, think Airbus versus Boeing. So the net impact of Trumpian trade policy could even be positive for Europe. Of course, we don't export to the US the same products as China exported to the US, so there must be some adjustment, which also might go via third countries. So that creates disruption in the short term. But it means that, again, if you're looking at the medium run, there's actually no reason to be so much concerned about trade policy, maybe some slight deflationary impact. but on the medium to long term, no loss of output. This picture, of course, gets extremely complicated if you think about different products, more than 3 participants in the global economy. But, and for that, you have to look at the big models. We have one expert here in Vienna, I don't know whether Gabriel Felbermeier is around. He already pointed this general theorem out already a long time ago. Here I'm taking some simulations done from the Kiel Institute on a big model which has many sectors, many countries, and they put in all the last tariff rates, maybe not the last week, but what was at a certain point in time. But many of their simulations yield a similar effect. The key issue is this one here. So basically 0 for Europe, right? And the biggest impact is, of course, for the US itself, somewhat China, and the rest of the world, which is also Canada and Mexico. So if there's somebody in the world who shouldn't be afraid of Trump trade policies, it's us. I just want to keep that in mind. And therefore, this high volatility I showed you, we should say, okay, let him damage himself, but that is not our key problem. So the trade wars, I think, are not our biggest problem. Of course, as I said earlier, if we don't react. Since I think time is running, so I was planning to spend some words on the electric vehicles special case, but let me not do that. I think you can see from this slide what I said earlier. So basically, you have this barrier here, which would mean more trade in this way and more exports there, right? So that's the basic picture. And then in different sectors, it plays out somewhat differently. But you can make some proximate calculations, which I do here. Let's say the exports of China to the US half. That's would be worth around 200 billion. Okay, if these are all deflected to somewhere else in the rest of the world, where would they go? Europe, are about 20% of the Chinese exports. So that means more imports from China of around 40 billion, right? Just to keep that in mind, the order of magnitude. If they are concentrated in some particular industries, of course, that creates problem, but overall. And how would that be offset? Remember, the model says it will be offset in the general equilibrium. Our exports to the US and to China, where we have on both sides a comparative advantage, amount to about 700 billion total, 6%, an increase in 6% of that, and so to speak, we are home free. So just to give you an idea of the orders of magnitudes that would be needed to bring about the model-based result and the near zero impact on the EU. Now, the main problem is that this 40 billion here might be very visible. Let me just go back here. The EU actually has already created, the Commission has created a cellule which will look at surges in Chinese products imported from us. And I think that's the wrong way to look at it, because there will always be some particular sectors where imports go up, but the increase in exports is less visible, less related also to China, and therefore it goes unnoticed. And I think that's the big danger of a policy mistake, which of course would, if it were to happen, would have also monetary policy implications. Now let me come to the tectonic shift. And that, as I said earlier, in my view, is much more important for the European economy and indirectly also for monetary policy. Let me perhaps summarize it in a couple of charts with a couple of data. And as I will emphasize, it's both the level that China and others have reached, and the rate of change over time that matter. Right? So the level determines a bit our position in the global economy, and the level of change, I think, has an impact on where we go and where things are moving. So first, something which probably you all know already, but I think the magnitudes are still extraordinary in terms of the value of manufacturing production. What you see here is actually that manufacturing production in the United States and the EU, it's almost the same, almost identical. Whereas in China, right, about almost 10 times in less than 20 years. And the level here, maybe I don't say that this growth rate will continue, but I'm just saying the level reached China is like US plus Europe together. And that's unavoidable that China dominates many sectors. It's just, the question is, of course, which ones now, and are there the sectors in which we are strong? That is the question I want to pose. But just to say that given this extraordinarily strong national base, it is unavoidable that China will become a major power also in trade. And here you see that actually here the increase in the share of China in global, and I underline here manufacturing trade, has not come to a large extent at the expense of the EU. And much more the US, which exports now very little manufacturing goods. It exports, on the one hand, services, software, and on the other hand, soya beans, right? Which is at the other end of this scale. That's why the US has become a relatively limited global trading power, as already mentioned earlier. So, keep in mind, as I said earlier, that in terms of manufacturing goods, the EU and the US are very similar in their both growth rates and levels. And now what distinguishes the US and the EU is, of course, the success of the US in the high-tech sector. Let me make a parenthesis here, which is not related to monetary policy, but actually policy in general, which is this is not due to public sector spending on R&D. Public sector spending on R&D is the same on both sides of the Atlantic, approximately 0.7. The difference is in business spending of R&D. And I would say even that didn't matter so much if it weren't for the different composition of the business spending in R&D. So it's both a scale effect or size effect and a composition. And I think for me, the composition effect is the more important one. And this here gives you an idea of the level, right, of the amount of business R&D in the EU, the US, and then I come back to China. And we have put together, let's say, industries in two different groups, high-tech and mid-tech. High-tech you can define as any industry where the R&D intensity is above 10%, and mid-tech is between 3 and 10. Just to give you an order of magnitude. You can also take official classifications of industry. It gives you a very similar composition. And what you see is, first of all, the scale of the total investment in R&D is very different. But even more importantly, the composition. The red bar here, which is automotive, actually you see is larger in Europe than in the US. So the European automotive industry invests totally more, not only in relation to GDP, than the US. But then when you look at the blue side, you see that this is 5-1. And if you look at the software thing, which is this one here, the ratio is 10-1. So this is the difference which is now, but it has persisted over the time. And that means that in the software sector, US firms have accumulated a know-how of not only hundreds, but thousands of billions over time. And this is not something that we can expect our companies to catch up. I'm saying software here, now we would say AI, right? It is this just one aspect of this broader tectonic shift that has gone on for quite some time. Let me just first of all go here. You see the software sector 20 years ago was very small. Right? It was already dominated by the US. The domination, if anything, has increased, but now it's much bigger. So in the year 2000, we could say, who cares? The US dominates that sector, that and other high-tech sectors. But these are the sectors that grow more quickly. And that is, I think, the key difference between the EU and the US, that you have this strongly growing sector. And you can see that also in terms of the composition of the industries, which here we have exemplified by taking the 3 biggest R&D spenders in both the US and the EU. And 2003, 12, and 22. So approximately 20 years. And I think you see immediately that in the EU, no change. Right? It's always the same sector. It's almost automotive. Actually, for the EU, the first 5 biggest R&D spenders are automotive. Right? And then in number 7, you have SAP, one. In the US, it's the opposite. Right? And it was very different in 2002. Right? So I think keep that in mind. There's this stagnation. We call it the middle tech trap in Europe. And in the US, there's this evolution. It's not a jump. It was an evolution that happened over 20 years. I haven't done it yet. If you were to do China here, you would find for China also that the 3 biggest R&D spenders are in high-tech sectors. Tencent, Alibaba, and Huawei. Right? Again, for China 20 years ago would be very far away, but 10 years ago you would have also found a very different listing for China. So very strong change, structural change. US, China, no structural change in the EU. And as I said, this comes about because there are these sectors. Now, I wanted to illustrate the tension that creates for the EU, and that's the increasingly important, strong position of China in the middle tech sectors, which I said are the key ones for Europe. I don't want to follow this route saying, many people say, oh, the Chinese will outcompete us everywhere. Right? Trade is about comparative advantage. But it means that within the middle tech sector, there will be shifts. There will be those sectors which are even face more Chinese competition, and some others that will be able to resist, perhaps. Okay, I think there's a movement there. I should finish soon. Okay, I wanted to give you now a picture of the middle tech sector as it is right now. And what I find interesting is that in terms of the R&D intensity, US, EU, and China are almost exactly the same level. So the Chinese do enough R&D in the middle tech sector, or as much as we do, as much as the US. Remember, EU, US, middle tech sector is the same. But there's a difference. In CapEx, EU, US, very similar, but the Chinese spend much more as a ratio of their sales. And the effect of that you can see in the profitability, which is lowest in China. And we come back, remember when we always say the Chinese get subsidies, it's the state. I think here we just see the fact that the Chinese have this savings ratio of 40%. We have one of 24 and the US of 17. And that is reflected in its profitability. So the Chinese companies, even without subsidies, because if there were subsidies, they would make perhaps a high profit rate. Right? But then you would come at the EU and say, oh, this is not just. But even without subsidies, before subsidies, Chinese companies can just take basically lower profit margins and outcompete European and American ones, on anything that's high capital intensive. And I think that should be a lesson for us, that the high capital intensive sectors are the ones where the Chinese have a comparative advantage that is very difficult to keep up with. Now, this is the level now, right? I wanted just to come to the change over time. Here, I take 10 years, and I take a difference to difference. So I'm asking myself, what is the difference of the EU versus the US? Maybe I should have said US versus EU. So it's EU's, US companies minus EU. And what you can see is that over the last 10 years, they have increased. So they have an absolute advantage. They have increased their annual spending on R&D and capex of 700 million. That is the strength of the US economy on the demand side, right? Because without that, the US investment ratio would be much lower. Whereas in mid-tech, no change, right? And of course, the backbone for this, or the result of that, was the extraordinary increase in sales over and above the sales of our own high-tech industry. So if you take this comparison, it's quite clear. It's the high-tech sector in the US that is really going ahead and basically creating also bases that are very difficult to assail. If you do the same thing then for China versus the EU, you see that the picture is between the two sectors the other way around. China is catching up also in high-tech, but even more so in mid-tech, and especially in terms of capital expenditure, so in real investment in these middle-tech sectors. So Europe is pretty much absent high-tech. We were or still are strong in mid-tech, but that's where the Chinese are now as strong as we are in terms of R&D expenditure, and they have caught up a lot over the last years. And I think that is the key challenge facing economic policy overall in Europe, and of course it also provides the medium-term background for euro area monetary policy. So sluggish growth, maybe some deflationary tendency, and then a continuous need for industrial adjustment, which might mean moderate levels of unemployment, and the sluggish growth means, of course, a low R there. And of course, the upshot is, as usual, that then there will be political pressure on the ECB to do something to create growth. But that's why the central bank was made independent to resist that. The pressure will be strong because there will be an impression in the political side that the difficulties come from the external side, from Trump, from Chinese subsidies. So something should be done. I would submit to you that most of the pressure comes from underlying economic forces, where the lack of development of a high-tech sector in Europe has put us in a position where the Chinese are encroaching more and more on the capital-intensive part of middle-tech industries. That is, I think, the tectonic shift that will preoccupy us for quite some time. Thank you very much.
Yes. Thanks a lot. As always, I would say you lived up to my expectations of bringing new ideas to the podium there. I know Mrs. Niesner wants to give her panel through, but she has more assets that we have more time, so we'll do some slight redistribution there. Three things I would like to bring in and then open to one or two questions there. The last point one, my sense is, I think a critical challenge for us and for China is for them to change the economic model from investment to consumption. If they don't do it, we will have a problem. they will have a problem, we have a problem as part of it. It's a comment, not I think that's the critical part, and so far I have not seen a lot in the Chinese development which really is thinking about it. I think this is one of the major global challenges what we have. Another topic I want to bring to the table, when you said, Europe doesn't have this software development. Here, my claim is we have it, but due to the lack of a really vibrant capital market, the money ends up in the US. And I take an example of an Austrian software firm, 1,400 people, having a software firm that writes software to repair software. What has happened, they went to the market in the US. The work is still here, but US then, how to say, what you read, they have the profits. We had the development there. We couldn't keep them here because going to the listing here in Europe was not successful or was not sensible to do. So unless we change that, we may do all the software development. If and as it becomes larger for them, for the software, it's more important to go there. And the last part, here I would like to have a comment when I said, okay, good, monetary policy, what one needs to do on this side, we have to now make room for next quantitative easing, so we have to sell now our assets there. Nice idea, but what it would mean there is it would further increase our losses, what we have, and the amount in this time would be huge. And if and as we would do quantitative unconventional monetary policy in the future, we would have again those losses there, if not some of the things were to change now to the review process there. So in this case, I guarantee you we would be underwater to a large extent for a long time, which of course would be a challenge to any kind of structure of central bank if we are heavily underwater the whole time. A little bit it's okay for some time, but heavily. So this is the challenge I want to put you, what you say to that, before I open for one or two questions. Thank you.
Yeah. The question about the lack of a development of high-tech sector in Europe has always two poles. One says it is a lack of ideas from the bottom, and the other says, as you said, the ideas are there, but the financing is not there. I'm very skeptical that the financing is the key issue. We have many American investment companies active in Europe, and why would they leave profit opportunities lying there without investing? I submit to you that there's another element which is very important, in my view decisive, but certainly very important, and that is the following. In the high-tech sector, the variability of sales, employment, developments is very high, especially for the startups and scale-ups. The typical venture capitalist will tell you 80% fail, but the 20% makes so much that compensates for that. Failure in the US has basically zero cost because you can just fire people. Failure in Europe means, in some cases, some countries, 30 months of salaries. Failure or readjustment. And these adjustment costs are particularly important for the high-tech sector, which is so unpredictable. And that's why one can understand why the same investment made in the US is more profitable ex ante than in Europe. So yes, it would be nice to have a financial market in Europe that's integrated, but I think one key issue is our adjustment costs in Europe. I won't go into the details of the losses. They're there anyway. They're there anyway because, okay, they're just distributed over time, But if you think about in terms of net present values, the loss is already there, and you just crystallize it today. And I'm always for crystallizing losses already today rather than put them over the future. By the way, that's what our banking supervision is telling our banks, right? But they don't apply the same principle to themselves. So I would take these losses on the chin just to be prepared. And if nothing comes, so much the better.
Okay, thank you for this encouragement. 2 quick questions.
One moment, please. The microphone is coming.
Ernst Knan, and then the second hand up there quickly. Yes. Thanks.
Thanks, Daniel, for the excellent presentation. 2 quick questions. Basically, there is a tension between your trade advice for Europe and game theoretical considerations. So, you know, the deal aspect, the counter pressure. And on the high versus medium tech backlog and outlook. So your analysis leaves us sort of hopeless. It is what it is. And so my question, what to do?
Let's hand over immediately behind him. Klaus Schmidt-Herbel, please, Klaus.
Sure, thank you and congrats. Very nice presentation. You did a very nice and sharp distinction between the negative short-term effect on investment due to Trumpian uncertainty and the potential positive effect in the medium term or in the long term. I doubt that the second one is really significant statistically. Basically, because all potential investors will exert their option for waiting until the next US presidential election. So this may be dominant. So everybody in the US, in the EU, in China or elsewhere may wait and see exercising a very strong effect and therefore having a very strong negative investment effect for 3 years to come.
Thank you. 2 quick answers.
Yeah, that's entirely possible. As I said, my central scenario is that the radical uncertainty between 150% and 20% China, that will be resolved into a much narrower corridor. Also for the US, EU, the corridor will be smaller. There will not be certainty, but the corridor will be reduced a lot. So some of the uncertainty, a lot of it will be resolved. To Ernst, I don't think it's hopeless, but what I wanted to say is we should not think that we can solve this problem overnight, right? Sorry, if I may say so, a la Draghi, 800 billion and we're done. That's why I showed this slow development in the US, or not slow, gradual. We have to create more seeds in Europe, right? So the seeds through more innovative policies, making our labor markets more flexible, maybe also creating better financial markets. All of these elements, I think, would then, with the seeding from public sector sometimes, then allow us to embark on a growth path where a second leg slowly increases in importance. We still have medium tech here, high tech here, but slowly over time it increases. That would be my policy prescription. And on the first part, the game theory. Okay, I think this is more a question of psychology than anything else. I have the impression that with Trump, it's not the classical game theoretic trade policy, but much more what can he claim as a win. You give it to him superficially, and I think he is now pretty much done with it. So that's my personal evaluation, in a sense that he can declare victory on almost any terms and get out. He's not much impressed by our countermeasures and complicated game theoretic calculations.
Okay. Thanks a lot on this positive note. Thank you very much. I think, give him a hand. I think it was a great presentation. Just the right opening there. And and ask now the first panel, Mrs. Niesner, coming up here. Thank you. And all the delay was my fault. Thank you much. Please.
So welcome to the first panel. Sorry for being pushy, Mr. Governor, but you had one excellent speaker. I have 4 excellent speakers, so I had to preserve time for us. Thank you. Welcome to the audience. Welcome to 200 online participants, as I've heard. And we will now deep dive a little bit into the tectonic shifts influencing the inflation landscape. We have a world where trade fragmentation is happening, globalization is in reverse gear, and everybody wants to find out what this means for the long-term inflation trends. I can offer to you a very research-intensive panel where deep thinking on this long-term trends is happening, and I also must make a little bit of advertisement to something what the governor has already mentioned. This is the ECB strategy review ongoing, which will also conclude in workstream 1 on inflationary long-term trends. And some people, including myself in the room, have contributed to this. So what we see now is that I think monetary policy has done a very good job on the last inflation surge. Also, of course, we can now also have the discussion whether the beast is entirely dead, but we see some long-term trends which go in either directions looming on the horizon, and as monetary policy makers, we hear to people like on this panel to find out where the structural shifts are leading. We will do this panel in 3 rounds. We will discuss in the first round how these panelists see the structural shifts. One was pointed out by Daniel Gross, where he sees a tectonic shift influencing going into the direction of deflation. We have a second round then on actual events. Tariff question, of course, is on everybody's mind. And the last round is the most difficult round for my speakers. What does it mean for central bankers? How should do they look through? How do they react to these diverging inflation trends on the horizon? Let me introduce the panel to you. Guido Ascari is the head of research of the Dutch Nationalbank, and he points out the difference between the short-term and the long-term trends. He says that long-term, long-run inflation is always a monetary phenomenon, but this is not very relevant. He says, however, in the long run, we're all dead, so that's not very useful. The short run is where the fun is, and in the short run, inflation is always and everywhere due to a misalignment between demand and supply. Welcome, Guido. Sarah is the head of the PAC division, Costs and Prices division at the European Central Bank, also involved in this European strategy review. She points out several structural economic developments, but she is especially worried about economists and policymakers that they need to ensure that the analysis and tools used for understanding and forecasting inflation remain fit for purpose. Welcome, Sarah. Then I would like to come to Marco. Marco is a principal economist at another very, very impactful institution for us, the BIS. And his focus is on the difference between the relative price changes, which he warns may translate into entrenched inflation. Welcome, Marco. And last but not least, a professor flying over to Europe. Thank you, Raphael Schönle, for doing this, a professor of economics at the Brandeis University. And he gives us, as a guidance, to go back to the sources of inflation. And he, a little bit like Sarah, is worried whether our models are fit for purpose. We should be mindful of the models we use and their limitations. And in the current circumstances, we need all hands on deck to provide good answers and make careful policy choices. Welcome, Raphael, to Vienna. So let me start with the first round. And here I would like to start with Sarah and ask you, which structural shifts do you estimate to have significant impact on inflation trends? And also, do you see a difference between services and goods inflation?
Thanks, Brigitte, and great to be here. So I think I would probably focus on 4 main structural factors that I think are particularly relevant at the moment for the economy and for inflation. And the first, of course, as I'm sure many people guess also with the first presentation, is the situation in globalization. The geopolitical environment that we face is clearly one of the most important structural changes that we're seeing at the moment. The second would be climate change. The third would be the technological changes that we're seeing in the economy. And then the fourth would be demographics. So clearly these factors at any point in time are always important for how inflation works. They kind of govern the deep parameters for how the economy functions. So they're always important. But what changes, of course, is the magnitude of the changes in these, the direction of the changes in these. So I'll discuss how I think these are currently shaping inflation. But before I go into the individual factors, I think it's important to reflect, which I think Daniel also alluded to in his presentation, that the effect on inflation can come in very different ways. There can be changes in the, let's say, the long run trends of inflation. There can be shifts in, let's say, the volatility that we face in inflation from these factors. There can also be relative price changes, which I'll come to at the end. And then also there can be just typical cyclical changes in how these factors affect, let's say, the inflationary environment via their effect on demand and supply and labour markets. But let me just then go through these 4 factors and how I see that they've changed or how they're influencing inflation, taking about a 5-year window. So if we think of since, say, the pandemic and what we faced. So clearly, I mean, I think a great introduction we already had is that one of the big changes is this rise in geopolitical tensions that we're seeing. We're seeing a clear shift towards more protectionist policies, more interventionist policies, which will lead to trade fragmentation, which we're really seeing now. And this is obviously, even over the course of this year, has become even more of a prominent factor. Now, of course, what the net effect on inflation will be the balance of a lot of complicated factors. But if you just look at, let's say, the distinct channel of trade fragmentation, clearly this will lead firms to have a lot of costs of like adjusting to this new world. So this could, at least in the short term, have some inflationary impacts. And then, of course, we go into all of the other effects as well that we would need to look at in the forecasts. With climate, we can see that definitely the preponderance, the frequency of these extreme weather events are becoming bigger. They're affecting inflation more. The effects of these really are on the upside. So we have estimates at the ECB from colleagues of mine that show, particularly for food inflation, these climate events can be quite consequential. So I think that's the great volatility, but also upside pressures there. With respect to the technological changes that we're seeing, so clearly I think over the last 5 years we've seen a big shift towards generative AI, so obviously ChatGPT and DeepSeek more recently in China. Now, these will affect both the demand and supply side of the economy, so how inflation will respond will be obviously a result of the balance of these things. If they, we could think of productivity gains that we'll see from the adoption of these technologies, depending on how quickly we adopt. This could have, let's say, downside effects on prices. But of course, there could be energy implications. These technologies actually require a lot of energy, investment needs, which could be inflationary on the other side. So this is why it's always important when making monetary policy that you work on this 6-weekly basis. No, you're always assessing what's going on and taking the different factors into account. With respect to demographics, so this was also, I think, touched on in the first part of what we heard this morning. There has been, like, let's say, growth in population in Europe from migration, but let's say the picture is the same as it was 5 years ago, that we're, let's say, struggling or challenged with an aging population. Now, on aggregate, again, this would probably lead to a reduction in higher savings, which would lead to lower natural rates of interest, which would be deflationary. So I think we heard already this morning about the demand implications of this. Now, of course, there can be frictions in the labour market caused by this, like, let's say, labour supply issues. So again, as with a lot of things in economics, it's really a balance of all of these factors. I think to speak to the last point that you asked, Brigitte, about the relative effects on goods and services, I mean, here I would say just in general, I think these factors the bottom line would be, without going into each individual one, they can certainly affect relative prices. So if you think of something like, just to give one example, aging. So you have an aging population. This will lead to a change in the demand in the components, like if you look at inflation. So probably higher demand for healthcare services, for services in general with an aging population. Of course, this will have inflationary impacts. Now, for monetary policymakers, again, the idea is that you react to these changes, of course, over time. So these are let's say, slow-moving changes in the back of the economy that can have, let's say, shocks. And I think we need to be really focused on both.
Thank you very much, Sarah. Yeah, I think a key word was the balance of all those factors. Yeah? Let us see how Raphael sees the big structural shifts.
Yeah, well, first also, thank you for having me. It's great to be here. So actually, I think there's a big overlap with the trends that you mentioned, Sarah. So I think there are 4 broad structural shifts that central banks should watch out for. So definitely there's AI and digitization. There's climate change and adaptation to it. There's certainly deglobalization and geopolitical risk. And I think there's also rising income and wealth inequality. So if you want to understand how these shifts affect inflation, I think let's just take a step back here and think about very systematically where inflation is coming from. And I think just so we're also on the same page here, inflation for me is a broad sustained movement of prices, not a one-time shock that comes because of a few specific good prices. So I think where's inflation coming from? I think there are 2 sources. One is, as Sarah sort of mentioned as well, transition dynamics. The economy responds to shocks, and we go from one state possibly to another, and prices adjust in that process. And these transitions can be due to either shocks on the demand side, so we know that very well. These are so-called, this gives us demand pull inflation. There's a lot of demand for goods that pulls up prices, or the supply shocks, which pushes up the costs, so we think about cost push inflation. And the second source of inflation is a more systematic one coming from underlying trends. So this can be choices about the inflation target, for example, but it can also be more fundamental. I think there's a lot of other stuff on the program that talks about productivity growth and these technological side of cost drivers. And there's obviously the specifics of structure change that affect how any of these shocks are transmitted into the economy. So this can affect the overall mechanism and how inflation looks like. So I think what I want to say is, if you want to assess the effect of these shifts on inflation, you've got to really think about to what extent do they materialize as demand shocks, as supply shocks, possibly both. And are these sort of limited effects? Are they more long-term trend shocks? And then how is the actual transmission mechanism affected? So this is sort of my framework stepping back. But I think I also have some specific answers, which I have to keep short. So perhaps my takeaway message here is it's really a complex answer. You said balance of different factors. I can just delineate just some specific aspects I think that are relevant for inflation here. So the first for me is, and I think this is important, that a lot of specific prices are going to be a lot more volatile, either because of deglobalization and geopolitical risk, but also because of more volatile extreme weather or any other sources of heightened volatility. And this does make inflation more volatile, the headline inflation that we measure, but also core inflation is something we've learned that these specific shocks propagate through the network and affect the core as well. Then let me add something also on climate change. I think adaptation to climate change is a costly structural shift. It's going to drive up costs and will raise inflation. But in my opinion, this is more one of these transitory shocks. So it will be more a transitory phenomenon. You know, I think my takeaway here is also perhaps we'll be more immune to certain things like volatile energy prices or geopolitical risk from it in the medium term. It's all very hard to time here. And I have also one particular point about AI and digitization. This is super hard to predict what AI is going to do. But I'm also really sure AI will lead to massive gains in productivity and also the quality, in particular for services, since you asked about that. I think we've all started to experience this. I think AI can produce massive quality gains when you think about expert advice for medical care, diagnoses, for legal matters, for tax advice. I think there are many examples how AI can improve quality and possibly bring down quality-adjusted prices. So I think this is going to be really big, and in particular for the service sector, which has been very stagnant in terms of productivity growth for a long time. I think there's one issue with this prediction for inflation. Quality adjustment for quality is very hard to do if you've ever thought about it when you actually calculate inflation. So it might be easy if you get a computer chip that's twice as fast and costs the same, then you sort of can come up with an equation. But normally quality is not so easy to measure. So I think there are some very serious measurement challenges ahead for research, statistical agencies, and central banks in terms of inflation. And maybe in my last minute, I don't think we talk much about income and wealth inequality, probably not as much as we should, but I think they are drivers of some very serious, possibly coming structural change, and we're also seeing some manifestations in the roots of political uncertainty. This is coming from somewhere, and it's obviously all connected here. I can't make any serious prediction. For me, this goes a little bit more into political science. But I think there are some economic mechanisms that are quite interesting also for inflation. So we know, for example, that the rich tend to consume different goods than the poor. In particular, these goods, at least in the data, tend to have more sticky prices. Sort of, they adjust much more infrequently. So if you think about redistribution, this obviously has an composition effect on the aggregate. So you might think that if you redistribute from the upper to the lower percentiles, the overall process might become a little more sticky, a lot more volatile. So this could affect the overall inflation process. So I think there are lots of interesting questions, but I'm out of time. So.
Yeah, thank you, Raphael. It was super rich. It does not make it for our audience easier to say we will see higher or lower inflation in the long run, but you guide our thinking with new categories, and you added a fifth tectonic shift, looking at inequality as well. Thank you. Marco.
Yes.
Where do you go?
So, well, thanks a lot. I'll try to tell you where do we go, but on my own behalf and not on behalf of the BIS, obviously. So, and I think for this question, my answer depends on the way we frame it, right? And I thought. When we think about inflation trends, it comes with a premium to take a granular approach and look at what specific goods and services are driving the aggregate trends that we see. And here, I'm thinking about specifically how different trends in different prices give rise to different relative price trends. Now, obviously, the easiest category to look at is that of services versus goods inflation, right? And let me take a step back and just briefly recap what has been happening in the goods versus prices services over the past 3 decades. Now, in goods prices, we've seen strong disinflationary forces coming from the globalization and technological progress. And that's something that my institution has been writing a lot about. The fact that the low inflation era that we had up to the pandemic was actually facilitated by the tailwinds of globalization, right? Now this somehow concealed the fact that services prices were increasing at a higher pace compared to goods prices, and more importantly, that the pass-through of wages to prices in the services sector has been higher than in the goods sector. And this is something for which there is evidence both in the US and in the euro area. And it brings me to one very important driver, in my view, of inflation developments and the inflation outlook that we're going to face in the future. That is labor markets, wage determination, and how these structural changes that you have described actually have a structural impact on labor markets and wage determination as well. Okay, so in the 70s, let me recall that the Great Inflation was triggered by a supply shock in oil prices that, if you want, is akin to the supply bottlenecks that we faced in the aftermath of the pandemic. Now that said, the reason why in the 70s that turned into a wage price spiral and therefore in sustained inflation is at first sight that inflation expectations were not anchored, but that to me doesn't really explain much. And one reason why inflation expectations were less anchored or less easy to keep anchored was that labor markets were very different at that time. Workers' bargaining power was much higher. Wage indexation was pervasive in several sectors, which made it really difficult to control the wage price spiral. Now, the current situation is very different. Workers' bargaining power has receded. But to me, the question and what we should keep an eye on as central bankers and policymakers is whether these structural changes, I have in mind more the political ones, will have a bearing on workers' bargaining power. I'm thinking in particular about curbs to migration, less international interconnectedness, less competition, less chances for firms to move their production lines offshore. And I'm wondering to what extent this is going to bring us in a configuration in which labor markets will become again the central the core of the inflation process. And so in that case, whether we will actually see more price pressures coming from labor markets, from wages, from labor market tightness, including in specific segments or in specific industries. So to keep it short, and if you want a short answer, labor markets and workers' bargaining power is something we need to keep an eye on and to understand how these structural changes that we mentioned will have an impact on. Thank you.
Thank you, Marco. So you pointed out that those big abstract tectonic shifts, they transmit via the labor market to future inflation developments. Thank you for pointing this out. Yeah? Guido, you have the disadvantage of being the last one in the first round, but you can comment on what the tectonic shifts the others mentioned.
Thank you very much, Brigitte. Thank you very much for having me on the panel. I'm very happy to be here. Yes, so I probably will not add much to what has already been said. Let me actually go 2 steps back, if I can, try to put some order on what has been said. I've been working on trend inflation for quite a while in my academic career. And so one thing that I think is important to distinguish is models versus empirics. So in our models, trend inflation is really the inflation target. And it's basically equal to expectations. And there are no trends that are going to affect that level. Then when you do empirically do kind of trend cycle decomposition, then obviously it's a very different matter. And you just look at the low frequency component of inflation, and of course there are these tectonic shifts or structural actually factors that are going to affect the trend in inflation. But still expectation is going to be the main determinant of the trend in inflation. And that is very important. So I have a paper, published paper with Luca Fosso that is now at the SEB, in which we actually do for the US trend cycle decomposition, multivariate VR, try to actually identify the role of all these factors. And the reason why trend inflation is going up and down, up in the 70s and turned down, is actually due mainly to expectations trend. And that's, I think, a great achievement that the central banks we should celebrate, thanks mainly to the inflation target. This is related to what Marco was saying, also about wage spiral and why the recent episode didn't translate in actually a persistent increase in the inflation trend. So that's, I think, it's a very important point that we need to always take in mind. Now, in that paper, we also look at globalization, how globalization affects the trend inflation in the US in the post-World War period. Labor markets trend through the wage inflation. So we have both labor demand trends, automation. We try to get an automation, which is not really artificial intelligence, but it's kind of close. And that's because if you look at the trend in employment and the trend in employment manufacturing, Of course, they have very different dynamics in developed economies, not only in the US, but also in Europe. Employment is going up while employment manufacturing is going down. And that's mainly true because of improving technology trend and automation. So, and then demographic is also affecting all. We have a labor supply trend, and then we have we don't have climate there, but I do believe, like I think Sarah said, that climate, if anything, is going to affect more the volatility rather than the level of trend inflation. These shocks are going to probably be more frequent, and that's going to be true also for developed economy, especially also for Europe. You have seen many disasters happening, like in Spain or Germany or whatever. So what analysis shows is that actually that globalization, just focus on that, the paper in particular, and I will go back later on this point regarding the short-term dynamics. But regarding the long-run trends, globalization did exhibit, a deflationary pressures on U.S. trend inflation. And this is actually faded, so it was very important when it was called China shock in the 1990s, and then the entry in the WTO in 2001. But it was starting fading already at the end of the sample. We stopped actually in that paper before. No, actually we focus on the inflation surge also. And the reason is because of this globalization, right, or reshoring of firms that is already happening after the global supply chain and the uncertainty due to the trade shocks. Regarding demographic, we didn't find any, deflationary or inflationary effects on trend inflation. You would expect there was something, the deflationary effect coming up from the baby boomers, as you would expect. But actually, like the Goodhart book, we should expect, but we didn't find this to be reversed. Actually, labor supply, because of the aging population, should actually contract in a sense that should or might have inflationary effects on structurally on the trend of inflation. This also can be mitigated through migration, as Marcus said, and has important effects on the labor market. So this is just just to try to put together what has been said so far. There's a difference between the model and the empirics, unfortunately, and the two things. I think we should make an effort to make them speak a little bit more together. And trend inflation is mainly a monetary phenomenon, and is mainly determined by inflation expectations. So looking at inflation expectation as the ECB does, it's and not only the ECB, but more the central bank do. It's very important.
Mm-hmm. Thank you, Guido. You really added to this first round with the importance of inflation expectations, and being humble about our models is also. We will then come to the second round. Before we switch to the second round, Daniela, now would be the time for the first slide. And this is something what Guido has just mentioned, that it's not only about where inflation will go, but what kind of inflation volatility we will see in times of higher uncertainty. This is again an advertisement for the strategy review, and I have special permission by Christiane Nickel from the ECB to show this. This is an upcoming ECB working paper estimating the effects on inflation volatility from high uncertainty, and you see here that services move the most. So this is a little bit to your point again. Thank you very much for showing this slide. We already heard that models have to be fit for purpose. Now we see these huge erratic policies coming from the tariffs announcements from the US president. I would like to start here with Raphael, who sits closest to the US president. No, I mean, but how do you accommodate these tariff announcements into your analysis? How can you deal with this kind of uncertainty? And what is your, again, coming back to this geopolitical dimension, what is the outcome for inflation in times of breaking supply chains and materializing geopolitical risks?
So this is more the third
On
question.
the tariffs, no, it's a tariff question.
Yeah, so I think I think we actually understand pretty well how tariff shocks and this works in our models. But maybe I can add a little bit of.
But do the basics again, or explain us.
I will make 2 points here, I guess, and I will give you a little bit of the U.S. point of view, which is closest to me. I'm not sure how close I sit to the president, so probably not too close. So I think there are two views or 2 points about tariffs. The first is very straightforward, right? Basically, tariff shocks are cost push shocks, meaning tariffs push up our cost, and that means higher prices that firms pay for the inputs in their production, but also that consumers pay for their imported final consumption goods. And this is obviously a bad cost shock for consumption and for GDP. But we also know from our models this is not as bad as it could be, because generally firms, but also in the second stage retailers, do absorb some of these very high cost shocks into their margins, and these actually have been pretty fat since COVID. So consumers don't feel the full pass-through of costs into their prices. And on the firm side, firms can obviously substitute into other domestic sources, sort of smoothing out these shocks as well. And we have seen this also with the last big energy price shocks in Europe, right? Everybody was worried, and there was a discussion how much substitution was going to happen, but there was a lot of substitution. So I think all these adjustment mechanisms exist. They are in our models, and they have been verified again and again in the data. So in fact, some very recent ongoing work with the Boston Fed, so we talked to firms, and I find that firms also at this very moment are not intending to pass through all these cost shocks fully over the next 12 months, maybe just like a 30, 40, 50, 60% pass through. So you can go on about the implications here, and globally also, maybe the European side, and for exchange rates. But I think Daniel Gross made a similar point earlier. This is really not so much about the level of tariffs going up. This is the real problem is the uncertainty shock that we're experiencing here. So how large are these tariffs going to be? How long are they going to last? What tariffs will last? How long? And this is a more general issue of policy uncertainty. So I want to emphasize, Daniel made a really important point there. And again, stepping back, why is this uncertainty bad? It's been said, right? Firms want to see what's happening, so they hold back investment, which is obviously bad, and it's in particular bad for employment. So the theory is very clear about this. And it's also bad on the consumer side, because when you're uncertain, you want to buffer save a little bit. So your consumption goes down, it drives down demand, prices go down even further. Interesting for inflation, when you put these two things together, this tariff shock and this uncertainty shock, it's not so clear how this is going to pan out at which point, right? One is exerting upwards pressure on prices and having higher inflation, while the other one is more like a negative demand shock driving down prices. So this is very hard to predict. And in the data, if you look at this from the US point of view, we're not really seeing as quickly as you would have thought a large recession yet, following this immense increase in uncertainty. You do see that consumer sentiment is abysmal. You're starting to see that CPI and PPI readings in the latest data are pointing to some prices going down. Also, the housing market isn't doing, the first house prices are coming down. So what's going on? Our models, like if you think about some models in the uncertainty literature, say yes, they have really, really large uncertainty shocks. So I think they're there, at least for the tariff policy economic uncertainty. So I'm not quite sure what we're missing. That's a little bit of a puzzle for me. My guess is this classic uncertainty shock is, it's my best guess, it's just delayed. So firms are potentially also, there's some evidence they're pulling forward some investment. If you look at the last investment data in the US, there was very large growth in investment that's related to imported investment, equipment and software. So perhaps this is something very specific to these tariff shocks. We have to wait and see a little bit here to understand this better. And I think this was also mentioned earlier. If you think about tariffs, this is my last bit here. what is one man's burden is another man's benefit, right? So if you think the US is somehow reducing its demand for imported goods, so on the global scale, if there's some short-term fixed supply, say, let's call it in Chinese goods, then that means there's less slack in demand, and it's going to mean lower prices for these imported goods. And that's obviously a benefit for the EU in some way. If you think about lower inflation, that could possibly even mean slight deflation from the import side. So how long that's going to last depends on this hard to predict uncertainty. So I think we understand these level and uncertainty effects pretty well in broad strokes. And I think it all says it's not going to be good for the economy, but there might be some delay in when this materializes.
Mm-hmm. Okay, thank you. There was, I would have expected for the US a more clear answer. Yeah? So even there, the effects are they're ambiguous, yeah? Because uncertainty may play out more strongly than the actual trade effect. Yeah? For Europe, yeah? Guido, do you want to start? How do you incorporate tariffs into your analysis?
Yeah, of course, I guess most central banks, we had some simulations of what happens with the tariff shocks, and then depends on many things like retaliation, the amount of retaliation, etc. And as Daniel said, it depends also if this is a supply or demand shock, and it's not clear, right, in a sense, because it's obviously a supply shock regarding intermediate goods that are imported. They're going to cost more if there are tariffs, but it's also an opportunity, as Daniel said, and can be actually a demand shock for European exports with a positive one. So then the reaction on monetary policy in short term would depends, which going to be the effects on due to if it plays out more as a supply or a demand shock. Surely going to be inflationary from that point of view, because it's either a negative supply shock or a positive demand shock. But it's not clear what is going to affect or happens to Apple. This is similar actually to a global supply chain shock that has been analyzed in the past quite a lot using the global supply chain index, the New York Fed or some others. And in that context, what comes out is also that the effects of a global supply chain, or if you want also a tariff, would depend on how much a country or an area like the euro area is exposed to global trade, and in particular global trade in intermediate goods rather than global trade in final goods. And the optimal response to monetary policy depends on the degree of integration, and the degree of integration of intermediate goods rather than final goods. So of course, the more it plays out like a demand shock, the more monetary policy forceful reacts to offset that. The more it turns out to be a supply shock. So the more an economy is going to be integrated, the more likely this is going to be a supply shock, I would say. Then actually monetary policy should be more cautious. Uncertainty plays out in many dimensions here, trade policy uncertainty, monetary policy uncertainty, fiscal policy uncertainty. In the US, I think is very big. This is actually a big topic. I don't know if we'll have time to talk about that. But I think fiscal policy is going to play a big role in the future developments of domestic and global inflation. And also in the models, actually, if you think about models of monetary and fiscal policy interaction, that's the only factor that can affect steady-state inflation, apart expectations. We're going to have uncertainty regarding, how the partners retaliates or reacts. So, but how this is going to affect longer inflation, going back to, I think the main topic of this panel. And again, I'm sorry to repeat myself, this is going to affect longer inflation only to the extent it's going to affect expectations. And that I think we should have it very clear. With the exception of, as I said, fiscal policy, I don't have, I think, time to go too deep into it. But what is happening, for example, in the US today, the long part of the yield curve, or in Japan, for what matters, should worry, actually, the central banks in that jurisdictions. And the other thing that might happen affecting long-run inflation is time, meaning that all this reshoring or globalization that might happen because of tariffs or global supply chain restructuring to get productive capacity more close, it might take time. It's not something that happens overnight, and therefore this can translate in a very persistent effects on inflation, therefore affects the slow moving or low frequency inflation dynamics.
Thank you. Thank you, Guido. That comes back a little bit also to the time inconsistency you were pointing out now in the data. Sarah, your job at the ECB, now with the tariffs, can you tell us a little bit how you accommodate for the volatility and the recent developments?
Sure, yeah. No, I should say I'm only speaking on my own behalf and not the ECB's.
No, everybody is free here on the panel, yeah.
No, thanks. I mean, I think already Raphael and Guido kind of highlighted the main, let's say, channels that we look at, of course, and the difficulties of forecasting. I mean, we have a classic idea of how these things should map into the economy, but then at the back of all of this being exacerbated by the usual uncertainty is also, it's not clear, are we at the end point yet? Where will tariffs be, next year? Is there going to be more sectoral dynamics? So to build on what's already been said, if you take, say, that classic demand channel, so obviously from a euro area perspective, if we expect more tariffs, we'd expect lower demand for our exports, and this, we would have thought has a downward impact on activity and inflation. But as we heard this morning from Daniel, we're operating in a world where it's not just affecting, obviously, the euro area. It'll depend on all the net effects, our competitive changes relative to all of the other areas, which will obviously be a challenge and will take time to see. And of course, we've seen in Q1 already, our exports have actually been quite strong. Now, probably because people are anticipating more disruptions in the future and front-loading a lot of activity in that respect, and we wouldn't expect that to continue given also the appreciation of the euro that we've seen. So I think just to add to all of these channels, because I think we've heard a lot already on, say, the demand channels, the global supply chains, one additional challenging factor which was mentioned is this sectoral aspect. And of course, I think Raphael mentioned, it'll depend also the capacity of each sector to be able to absorb all of these shocks. So some sectors, some companies have healthy margins where they can absorb some of these shocks without passing them on, others less so. So this will obviously have a big impact on inflation. We also don't know with respect to, like, let's say the pharmaceutical sector, what's going to happen there. Obviously they've signaled that they're going to do something there. So this will all remain to be seen. I mean, I think the financial market effects are clear for everybody to see. And they, of course, we've seen big equity losses, a lot of volatility there. Obviously oil prices have also reacted. So it'll really be, as already said, a balance of all these factors. And then, of course, at the very back of all of this is the retaliation, of course, what's going to happen thereafter and how the countries respond. So, I mean, it's obviously a complicated environment. And I think that's why it's good always also to take this meeting by meeting approach also with respect to the impact of tariffs on inflation and output.
Yeah. No, I mean, that's really the daily life, and we feel this world in the discussions of the MPC, and one obvious reaction is to go more towards scenario where we can't sometimes even agree on the baseline. Yeah, so that's the difficult. Marco.
Yes. So thanks. I think my job in this question is facilitated by the fact that the BIS does not produce a forecast, so we don't have to do something practical. We can just preach about what people should do, and this is what I'm going to do here. And let me hook to what Guido said in the previous round, actually, about the risk of a disconnect between the modeling side and the empirical side. Okay, so the way in a model-based textbook world, the way one should think about the tariffs is a cost-push shock, both in terms of the effects, I would say, and in terms of the policy response that this elicits, right? And I think there's even a recent paper by Ivan Werning that precisely makes this point. And I think this is very compelling, and there's very little to discuss around that. But that said, to me the question is whether what we are seeing is really a tariff shock, or is something broader, as Raphael alluded to. So in the world of the models, a shock is a one-off thing that occurs once. It's typically evens out over time and does not induce changes to how agents in the model believe. Now, then my question is, is this really what we are seeing now? Or what we are seeing now is more a reflection of it's more the reflection of a broader shift in the policies, in trade policies that materialize as uncertainty, changes in tariffs. But this is something that's very different from a model-based shock, and that's something that has a reflection and a bearing on how agents in the economy behave. And here I have in mind explicitly how firms behave and how firms set their prices. Now, this typically would depend on the degree of competitiveness across different sectors, to what extent firms are able to pass on their rising input costs to consumers or to the downstream sector, or rather they want to sacrifice their margins to preserve market shares. And of course, in more competitive sectors, there's more the chance that firms will decide to partly offset the rising costs to preserve their market share. So inherently, a more competitive environment is one where these shocks should have less of an impact on the prices. Now, the question to me is whether this brand new, less interconnected world with more barriers to trade and everything will be also one in which there's less competition across firms, and not only in the sectors that are more exposed to tariffs, but also to the other ones. And therefore, whether this new environment will be inherently a more inflationary one, and one that is more subject to see these shocks that may idiosyncratically affect only some sectors, propagate to the others, and therefore morph into broader aggregate pressures. So again, to keep my answer short, on top of what I said earlier about keeping an eye on labor market developments and wage determination, another thing we should keep an eye on is firms' pricing practices and how these structural shifts are likely or less likely to affect firms' pricing decisions.
Mm-hmm. Thank you, Marco. Yeah, there was another new factor, the competition in a fragmented world. I would like again to show a slide, number 2, Daniela, before we move to the policy question. And this comes back to, I want to show this for 2 reasons. I mean, first of all, it was mentioned by Sarah that the sectoral effects is something where we have to dig into. And I think also that it is really the task and the mandate of central banks and of forecasting institutions to give guidance to the real economy on what the impact will be. And careful, those are growth impacts, but of course growth impacts translate into different inflationary scenarios for different sectors, and it's for Austria, and it's the pharmaceuticals, Sarah, you were pointing out, where we expect something bigger coming along. We all don't know exactly what will materialize, but we went out with this blog to help the real economy understand where the hit will come for the Austrian economy. And I think there's also this kind of guidance we should be able to give to stakeholders. Thank you for the slide, and that already puts us into the last round. I would like to start with Raphael and ask him on what does all these, the different channels, the different probabilities of playing out, that they interact with each other. What does this mean for policy making? Should we just put our hands down and lay back because it's so complicated?
That's a very good question. I think it really depends on how you account for these shocks, how you're going to optimally respond. So I think it's worth going back to my initial framework here that I mentioned and think about, are we really going to face more temporary shocks, or is this more fundamental shift in the actual trend that are permanently different. So for these, how should you respond for these temporary shocks? I think we have three very clear lessons from a modeling side, although then it gets complicated. I think a theme that came up is the interconnectedness of the economy. So in a network economy, you know when you use others' inputs as output as your input, that there can be propagation, and these sectoral shocks, they can actually have an aggregate effect that leads to inflation or possibly even deflation. So COVID has given us just really a lot of prime examples here, particularly on the supply side. There's great work out there. For example, there's I just mentioned one paper by Hassan Afrouzi and co-authors that sort of really neatly walks us through an energy price shock in this network economy. I think that's a very useful model for policy if you want to look at that. It's all been worked out, and I think models like this get this gist of propagation right. If you want to account for some of these specific shocks that we're going to face. But here's also something you mentioned earlier and has come up. I think we have to do better with our models if we want to know how to react, and I think it's worth investing both on the academic side and for central banks. If you work with these multi-sector models, and this came up with Marco, for example, there are a lot of heterogeneities, differences on the firm side, on the sectoral side. So you showed this in your slide that come in when you have these multi-sector models. And worst of all, they can all interact, and then there's the consumer, the heterogeneous agent side too, which can also interact with this. So this is, this is important to have in your model because all of these shocks matter differently if you have different ingredients or not in the model, or if you have just a few in there and you're ignoring others. So you want to know how that pans out to react optimally to these trends. So I think we need to learn a little bit more and think about this very systematically in a quantitative way. I think this has just evolved over the last decade and more recently since COVID that we think about these sectoral heterogeneities. So I think there's work to be done. I think also Guido mentioned this earlier a little bit, and you want to think about this sort of the second lesson in response to these temporary shocks. That one policy just doesn't come alone, and in particular monetary policy needs to take into account these reactions of other fiscal policies, and those can be sector specific too. So if you have an energy price shock, you can have energy production or consumption subsidies. You saw some of this in Europe in the wake of the Ukraine war. And obviously that matters a lot for the response of prices and inflation. So that can totally change how monetary policy maker thinks about it. So you want to take that into account also. I think we learned that also from COVID more broadly. You want to think about this monetary fiscal policy interaction. And I think the ECB started looking at that a little bit more systematically. And I think also another lesson for policy is we learned that these specific choices, they don't come alone. Okay, this is usually something that comes together. You have perhaps differently persistent shocks, or they occur in different times, and that can lead to more persistent overall inflation as the whole process. They can also, we learned this too, add up in a nonlinear fashion. So you end up at different points in your Phillips curve. So I would think we have to be very mindful of all of these intricacies of the models here, and especially if you take on these multi-sector views. And then I think the broader answers, and I think this is something I should probably leave more to Guido, what happens when these trend shifts are more fundamental. For example, we have a change in productivity growth. Guido, you're just the expert on trend and trend inflation. But my 2 cents on your work is actually, I think firms in response to these temporary shocks, generally the economy becomes more forward-looking, so that we don't react so much to these temporary shocks, but rather forward guidance or so gains a little bit more value. I think that's something for central banks to keep in mind. And then this is not a realistic constraint in how we think about the world, but if there's indexation to a very large extent, this whole thing also changes. But this can arise endogenously, right? If we lived in a very different world, and you mentioned this earlier. And then I think if you have more trend-specific shocks, I think you should never try to undo these fundamental shifts in trends. You should sort of accommodate them, but you should accommodate them from within your models, where I think you have to invest a little bit more. And you have to do this very carefully, interpret how they show up, and is this actually sort of a long-term shift, or what's the extent to which this just takes a temporary manifestation. So that's a very interesting job to have these days.
Yes, Raphael, and it was a very careful but also complex guidance you gave us. Thank you. Yeah, I mean it's basically it's about working more on the models, coordinated policies. Yeah, not having the narrow mind of only central banks matter. And it was high time that on this panel the term nonlinear model effects came up, which are back now with a vengeance, I think. But let me come, Guido, do you want to go? And you were already addressed.
Thank you very much. So, yeah, let's...
and don't confuse the policymakers as much.
Well, I'll try. So I completely agree on Raf that key insights that we learn from buoyant recent literature on multi-sector and network economy regarding what are the effects of these changing relative prices. And for example, the SUB has this chump network that I think I should mention that has done a lot of work on that, and we learn a lot. So, but again, I would like to distinguish, step back between long-term and short-term, right? So regarding long-term trends, so we're talking about long-term trends in relative prices. You know, these are real things. Monetary policy should not do anything. In classical models will tell you that you know, the 2% inflation anchor should not be affected by this long-term trend. Of course, this is not completely true. For example, papers by Klaus Adam and Henning Weber shows that when you have nominal rigidity, these long-term trends can actually justify, for example, having an inflation target of 2% or not zero, right? So for you know, a reason that more or less is like greasing the wheel of the economy. But bottom line, I think from the long-run perspective, monetary policies don't matter. Of course, then when you look at the data in the short term, that's a different thing, because in the short term, these things do matter, as we have seen, for example, in the recent inflation surge, where the reallocation of sectors did actually ignite inflation quite a lot. And also empirically, you can find, and we have done some work on European data, a relationship in the short term between the skewness of the distribution of price changes and the level of inflation. And what turns out that the recent inflation period, this relationship was really outside the bands. And so at the DNB, for example, we start looking at the full distribution of price changes quite closely from 2002 and 2022. And what you could observe, you can make a movie, as you would expect, you know, you get a mass on the right of this distribution. These are the energy prices increasing. And then at a certain point, this mass starts shifting and dragging the whole distribution. So that's, it goes back to the famous debate, how much is this broad-based? It became broad-based, and the answer is why. And this didn't happen in the past. In the past, we did have you know, distributions that were skewed to the right, but it didn't trigger an increase in inflation. So understanding why that was the case in this particular period, I think it would be very important. And then what you see is that then you start having, you know, mass on the left-hand side, negative price changes. Again, these are the energy prices that started to become negative. And then the distribution is dragging, the whole distribution dragging to the left, but it takes time to move these distributional objects, and that's, you know, increase the persistence of the initial effect and the initial ignition. Last thing that I can add was something that we didn't talk about so far, which I think is very important for all this, is also the exchange rate, especially for European economies. Right? So there's an exchange rate effect also that is triggered by the reaction of monetary policy, right? So for example, during this inflation surge, there's a very nice Vox column, for example, by Giancarlo Concetti and Riccardo Trezzi about this, that what happens is that since, well, maybe I don't know if I can say, but monetary policy was a bit late to the party to some extent. then what happens is that the euro depreciated at the beginning, and that actually did amplify the effects on inflation at the beginning quite a lot. I don't remember the number, but because intermediate goods that were the price of the intermediate goods in terms of euros actually increased quite a lot. And on the other hand, by the fact that then the monetary policy did react quite swiftly in Europe, even more than catching up, and then the euro actually started appreciating with respect to the dollar. That actually helps quite a lot this inflation. So also the exchange rate channel is very important, I think, for Europe, and that is going to depend also on the reaction of monetary policy. This also relates to tariffs. So this is a demand supply shock. The monetary policy is going to react in a different way, and also the exchange rate, and that the exchange rate obviously can compensate or amplify any effects of tariffs. Thank you.
Thank you. So the message is, know your price movements well, look at the exchange rate as well, and have a forceful monetary policy in the short term.
That's very important for the short term.
Yeah.
Shouldn't worry about long term.
Yeah, exactly. Yeah, thank you. Marco.
Yes.
You can preach to us again.
Yeah, I will. That's the most relevant for me part of the preach, because I'm going to leverage on work that we have done in the past at the BIS, in particular in our annual economic report in 2022. And there the report was about the view of inflation through the lens of two regimes. Now, our key point, and what I want to bring here, is that, as already been mentioned, the textbook response to a relative price change is to look through that, because it's temporary, it's a shock, but here the key word is temporary and distinct from long-run inflation or pure inflation, whatever you want to call it, that remains anchored at whatever the central bank says it's the target. Now, this is what happens in the stylized world of the models. In reality, things may be a bit more nuanced, and that's how we try to read in our chapter the inflation process through the lens of these two regimes, right? So a low inflation regime is one in which inflation is so well anchored around the target that is self-stabilizing. This practically means that all relative price changes, they reabsorb each other. You would see movement in the CPI numbers that we get, but this will be due to relative price changes that will even out over time. The wage determination will be largely based on productivity gains rather than on past and inflation developments or past shocks. And therefore, in this environment is very benign for central banks because we have quite a lot of flexibility in that world. We just need to keep inflation expectations well anchored by communicating that we stand ready to act whenever bad things happen. But in general, we can look through all this price changes that materialize in CPI, even if that means overshooting or undershooting the inflation target, even for some time. To the extent that this is due to this temporary effects, that's more than tolerable. Now, the other opposite is a high inflation regime in which, of course, inflation expectations are not well anchored or are poorly anchored. And in that case, the CPI numbers, they get under the spotlight and they become sort of a coordinating device for firms setting their prices as opposed to setting the price based on their the cost of their inputs, and for workers to demand wage increases to compensate for expected inflation looking ahead. So that's a regime that it's of course way less comfortable for central banks. There it's something you want to stay out of. Not least because, as we know from the historical experience of the 70s and the 80s, moving back from a high inflation regime to a low inflation regime is very costly in terms of output, as we have seen in the 80s. So here the question is, of course, what happens between one regime and the other, and whether as we were writing the chapter in 2022, we were facing the risks of transitioning to a high inflation regime. That's something, of course, that I said would have been very costly, and so we were calling for central banks to be mindful and take decisive action in showing that their commitment to keep inflation in check was not only about stating your inflation target and your wishes for the inflation path in a forward guidance world, but also taking action in terms of raising the policy rates and tapering asset purchases and rein in the inflationary pressures that we were seeing. I think that was largely successful, so we should congratulate each other, I would say. And in general, this doesn't mean that in the future, looking ahead, we will remain in a low inflation regime, especially in the face of big shocks like the ones that we could face that could originate in specific sectors, but then propagate quickly through the others as it happened in the post-pandemic world. So that's my...
Thank you. That was a very good word of caution for the policymaker. Thank you, Marco. Sarah, I know that you're here on your own behalf, but you're still representing the most important policy institution here. What is the appropriate policy response to the current inflation trends or the long-term inflation trends?
So I would, a lot of what's been said, I think I would agree with. I mean, let me just maybe as a wrap up, because rather than repeat some of the things that be said, what I feel is important for central banks to keep in mind, probably 2-3 blocks I think that are important to keep in mind. So first of all, on this issue of whether these structural factors and the impact on relative prices are a significant challenge. I mean, I very much believe that central banks need to set a clear target, and it needs to be credible. And as Guido, you said, I think it's all governed by expectation. So, of course, and I think, if we see these big relative price shocks, we do know that they can feed into aggregate inflation. And I think, Raphael, you mentioned the Frusi paper, which I think is a nice model to look at to see how this works. So it's really the central bank's job to be able to guide expectations, of course, in an environment like this. And then also something maybe that hasn't been said so far in this session, but I think Governor Holtzman alluded to it this morning, is the importance of the strategy review. So of course, people, financial markets, everyone needs to feel that we're credible and able to respond in different contingencies. And so this means having a broad framework in which we can react. And as you said, Marco, to communicate and then actually act on the basis of that. So I think that'll be, in addition to the, let's say, meeting by meeting changes in policy, having a framework that's credible and robust to different contingencies is really essential. And then just finally also, maybe I can reflect on some things I think are important for central banks, for the ECB, but probably more generally. I mean, it's echoing what we already heard on sectoral models. I mean, these are becoming more important. I think we already heard that from Guido and also Raphael. That's something that's emerging. Also models with nonlinearities, as you mentioned as well. This is on the modeling side. But there's also, I think, an important point, and I think Guido touched on this, about the data that we're looking at and we're collecting. So at the ECB, and I know in many other institutions, we're looking now more at micro-pricing data, higher frequency price data, so that we can see in real time, if we have a shock, what's the distribution? Because this is very consequential for what we're going to ultimately see in the numbers. Are we seeing, let's say, an increase in the frequency of price adjustments, which could mean that the shocks are not as maybe transitory as we thought? And this can help us then in calibrating our monetary policy response. And then also on the wage side, to echo what Marco said at the beginning, we've done a lot of efforts at the ECB to collect microdata on wage developments, because what you can see is that particularly in the euro area, there's very different wage dynamics across countries. Some you've got these long-term wage contracts that are set, and others they adjust more quickly. So I think even Austria, they adjust much quicker, and Belgium, we have indexation. And this is extremely consequential for how we would expect to see shocks transmitting through to inflation. And so being on top of all of that microdata, looking at the aggregate is often not enough. We need to be looking at really these, let's say, sectoral rigidities as much as possible. And then also, I mean, clearly in a world where we've got this preponderance of like sectoral shifts and supply shocks, we need to look at the measures we have for inflation. So obviously underlying inflation it's important to look at these measures more carefully to be able to guide the calibration of monetary policy. And as I'm sure many of you know, this became a very key criterion in our reaction function and in our calibration of monetary policy following the big sectoral supply shocks we saw. So I think these are challenging times for central banks, but if you have a robust strategy, if you're constantly assessing not only your models, but the data that you're looking at, the measures that you're assessing, there's no reason to think that you can't control inflation in this environment as well.
That was super clear. There was really giving a lot of hope, clear ways forward. Thank you, Sarah. I would like to take 3 questions and then really I know that you could discuss more and there are many questions. Mr. Governor, I first would like to know, do we take online questions? Just not to discriminate against the people sitting in their offices? Are there any online questions? No, there are. Okay, I take 3 questions from the on-site audience. Mr. Holzmann first, please.
First, thanks, great panel, great persons, great answers, great staging. Reviewing it, what we hear a lot about inflation and we hear about monetary policy in the way, well, if we have inflation well anchored, then we have no problem, and if it's not well anchored, then we have a problem. What doesn't show up neither for the discussion of the models as well as how inflation is created. We hear a lot about shocks, but what doesn't enter at all is money quantities. We have had a major increase in our balance sheet, almost doubling it. And this was done through specific monetary policy, but apparently this has nothing to do with inflation. And maybe it's the age and my, learning about it, that both are not linked, surprises me. And fortunately, we have some application at the BIS Borgio of last year and the year before, which alludes to that and throws some pretty strong conclusions there. But for the rest, that's something, a puzzle I would like to have to say interesting.
We have heard this question several times from you, and now we really throw this question at the panel. Who would like to take the question? Yeah.
So thanks. This is actually a great question, and I wanted myself to make a point around that line. Not so much on the role of money, but a broader point about we say many times the word inflation expectations. I used it myself, but it's not 100% clear to me how these are formed in practice, not in the world of the models. In the world of the models, long-run expectations are whatever the central bank says. So that makes it very easy if you take that at face value. We just have to go out and say that we want 2% and 2% will happen somehow. Now, in the real world, I'm not quite sure how this actually works, and I have myself some research on how households' expectations are formed or are shaped or not shaped by monetary policy. So I think this is a bit the holy grail, and that's something we should pay quite a lot of attention to, how really inflation expectations formed and how we can, and to what extent we can steer them and shape them through communication or through action. This is also a bit of a mysterious point. We have to act, raise rates, and cause damage to the output and to unemployment, whatever, to keep inflation expectations anchored, right? So that's to prevent de-anchoring. But how does that exactly work? That's a bit unclear to me.
It is a very relevant point. I think you avoided the question.
No, but money.
We give a second. No. I see the point. Yeah, I give a second, and then I really want to have 2 other questions. Guido, you want to try?
No, I think the question was about money, and I think the BIS work was mentioned, so that's why I thought Marco avoided to quote some BIS work. But anyway, so. Unfortunately, our model are cashless, for starting from wood for the idea. So no, this is a joke. But there is actually empirical evidence that recent empirical evidence actually that there's still, if you want a long-term relationship, since we're still talking about longer terms of inflation between money and inflation. My way of saying, of seeing this and why, especially from the long run, our models are cashless and don't talk about money, is a bit like, when I teach the ISLM to my undergrads, then so you can either use the nominal interest rate or the money supply. There is a one-to-one mapping. And the same is for, I think, a long-run inflation target. I say 2%, and obviously then the money supply becomes endogenous in the sense they have to pump in the money that is required in order to maintain this 2% inflation target. So in a sense, the fact that we didn't speak about money doesn't mean that money is not influential. I don't know if that answers.
Good. Let us leave it and go for the dinner and the coffee and the breaks. Thank you. 2 questions, short questions. Ernest, you were already in this first one. I see a speaker. If nobody else, then I take Ernest, the speaker there, please, and the question from Ernest. No, the gentleman in the middle of the right side, please.
Ralf Kromer, Austrian Economic Chamber, and also member of the Fiscal Council, where we're colleagues there. I was happy that Sarah mentioned that there are differences in the indexations, for example, in the euro area. Marco, you mentioned also the differences in wage setting. So we have a diverse, let's say, landscape within the euro area. And I know it's an easy question, a difficult answer, but I would like to know how ECB is going to take that into consideration, this diversity, when it comes to policy setting. Thank you.
That's a super. I'll take the third question, and we can see. Sorry, that was clearly for you, but Ernest, you're waiting for the mic.
That was a very interesting panel. Thank you. I want to follow up on Guido's last point, expectations formation, and on the points that were made in the panel earlier, that there is going to be more inflation volatility, and there is going to be more relative price changes and volatility. And my question is, how might inflation volatility, relative price volatility feed into inflation perceptions if inflation perceptions are formed in an asymmetric way?
Yeah. That was super. Yeah, Sarah, do you want to go first on indexation? And
yeah, sure. No, happy to. Thank you for the question. So, yeah, you're quite right that when you're looking across 20 economies, you have a lot of diversity there, and there's a number of ways that we try to factor that in. So clearly in our forecasting process, so we, as you I'm sure know, have 4 forecasts a year. 2 of those are actually done with all of the national central banks involved. So there we're able to, like, let's say, integrate all of the natural or the national idiosyncrasies, all of the differences, and so we take into account in price setting and in wage setting the different structural features basically in the economy. Also, of course, the fiscal measures. I know you yourself probably are knowledgeable on these. These are extremely important following the invasion of Ukraine, when you had this energy spike and there was a lot of fiscal measures. So I think these are taken into account really in the day-to-day business of forecasting. So twice a year, it's really a broad exercise, or twice a year, coming up in June and also December. It's really all of the national central banks. So yeah, we're constantly thinking about these, calibrating our models with respect to these. And then, as I said, also internally, but also I think in the Eurosystem, there's a lot of modelling work that goes on to try and improve our models as we get, let's say, more data, more understanding of these sectoral developments. So, you see different rigidities, let's say, in particularly in labour markets and how these are set. And this will clearly impact how monetary policy transmits. So, you can imagine if you're a firm and there's been a monetary policy shock and you just set your wage the previous month for the last 3 years, you're to some extent not able to adjust in terms of your labour costs with respect to that shock, be it on the up or the downside. And so it's always important to be able to, you know, take these key factors that are always embedded in all of our economic models and be able to take them to the data and see, well, are we seeing differences in investments in firms depending on all of these characteristics? So I would say it's both, I would say, in our day-to-day forecasting, but also in our kind of research work that we're always trying to improve these models, that we take it into account.
Thank you very much. I would like to ask Raphael to have the last word on the quite sophisticated question on inflation expectation against.
Yeah. I actually also want to add a little bit to Sarah. I think what the ECB is doing is really great, trying to gather much broader data sets on the micro data, especially on expectations, which have been emphasized here. I think we're still learning here, actually, and this came up, right? What is the right model of expectations formation? And that is very important. It's a central variables in our models, and I think we understand that consumers aren't fully rational, but how to do that, how to model expectations is very difficult, and I think that's why it's really great that we're getting better data, and I think getting more real-time readings is important for policymakers just to understand what's going on. I've worked a lot with surveys and expectations. The more you work, the more you see. I think you see in particular that what you can pick up is not so much sort of level reading. Sometimes they're a little bit hard to digest, but the changes are informative. So I think that is important. So what's volatility going to do here, among other things, and perceptions of key variables? I've actually worked on some models on formation of expectations, so I can say something about that. I think a key novel element in how we think about expectations is actually related to shocks, to unexpected shocks, to large shocks. Something that's sort of state dependent and triggers sort of memories that we may or may not have. So there's a very behavioral element, I think, that is actually in the data, in particular about inflation. So, you know, if you have experienced the 70s, you know that on average you tend to have higher expectations, but in particular when you have some shock, it can be a very specific price shock or very general inflation shock, it can bring back these memories. So if you have a very volatile process, it can bring back a lot more memories that you wouldn't recall otherwise, and then we see in the data that people actually update their beliefs accordingly. This is more behavioral, it's outside the classic models. But people who haven't had these experiences, they don't update so quickly, and you never step into the same river twice, right? So everything you say, everything you communicate, actually is another experience that people have, and that they have also about how you're going to react. And so I think there's a lot to learn, and volatility definitely affects the process of belief formation and recalling these experiences. So I think this is a very important item to watch for policymakers and to work more in research.
It doesn't make our life easier, but it's very relevant. Thank you. Thank you, Raphael. Thank you to this great panel. Everybody really contributed from his angle, her angle. Thank you very much. Thank you for listening to us. And let's have a coffee.
Hi, everyone. Welcome to the second panel of the day. We heard this morning the presentation from Daniel about how Europe is lagging compared to the US in terms of research and development and productivity. This is a well-known fact for a long time. This is kind of the Sorgenkind for Europe: productivity, innovation, and growth. And it is a well-known problem, and usually central banks do not talk about it or do not care about it, because we learned that central banks are about nominal variables, money growth, for example. It's not also something that we do not mention. But this perspective that the central bank takes care only or can influence nominal variables only has been challenged or has changed or evolved in recent years. And I, for example, have been part of an expert group in the Eurosystem, within the Eurosystem, that has been looking at the question of where the monetary policy affects productivity. And whether it is the short run and the long run, the jury is still out. But in this expert group, which was part of the last strategy review 4 years ago, we found that there are significant effects of monetary policy on productivity. Of course, this is only one piece of work, and we are not the holders of the truth, and that is why we invited this panel, this distinguished panel, to discuss more and to show more about this question. And I think that I really have an excellent panel to discuss this question, because first, Felix has been doing something that is very similar to what we did in the Eurosystem. We're still doing it. I mean, there's follow-up work, and here at the Austrian National Bank, we kept working on that. And Phyllis is doing something that is very similar to what we are doing, with the advantage that she has the OECD perspective. So we work only on Euro area data or on Austria data, and Phyllis has the big advantage of doing much better work that we were doing, and of course, looking at other channels and the OECD perspective. Then I have Kasper Zimmermann, who has been also working on this for a long time, and he has, I think, a very interesting aspect that he's bringing to the conversation, which is also, I think, touched upon in the keynote this morning, and it's about how innovation. First, how monetary policy affects innovation and what that means in terms of financial markets. I'm not going to give away what you're talking about. But I cannot help to mention that although it is a very new topic for us, it is a little bit of an old topic in the sense that what you're showing, had been shown already in Jackson Hole. So that shows a little bit how Europe lags the US in terms of topics and in terms of thinking about new ideas. Then I have Michaela in my panel, and when we started this project in the Eurosystem about monetary policy and productivity, we were looking for, of course, the theoretical foundations of how can we justify this relationship, and Michaela has done a lot of work on this, and this neo-Keynesian endogenous growth models, and that was a big inspiration, and this was 4 or 5 years ago, and Michaela kept working on that, and she's presenting today, I think, at least 2 new papers that she's very productive, and I think this literature is very crucial for understanding the idea of monetary policy and productivity. And last but not least, Gallo, who his research spans, you go from. It's so wide what he has done. He has published so much in very different topics, and I think that he's really the expert that can wrap up everything that the others are going to say and give some policy prescriptions. But then, of course, we will challenge the policy prescriptions that that Gallo is giving us, and then we will have a round of, after the presentations, we will have a round of challenging each other, and then, of course, we will invite the audience to participate in the discussion. Phyllis, yes. The floor is yours.
Thank you. Thank you, Maria, again for the great introduction. Good morning, good afternoon, everybody. And I'm very happy to be here. It's an honor to talk to this crowd. As Maria mentioned, I'm going to talk about some of the recent research work that we do at the OECD, particularly on monetary policy and productivity, but I will also touch upon some of our broader findings in terms of the drivers of investment and productivity, also in the context of monetary policy, which I think it would be an interest to this crowd. Okay, so it's not a surprise that productivity has slowed down, particularly in Europe, significantly across most advanced economies. Now, of course, there are many reasons for it. There are some structural ones, particularly that we have been focusing on: sluggish innovation, weak diffusion of technology, the differences between the frontier firms and the laggard firms that we identified. And in traditionally, from the perspective of monetary policy, we tend to think that the changes in monetary policy stance typically works to mitigate the short-term fluctuations for businesses, for investment, and therefore it shouldn't have implications for the medium or long-term growth. And part of this idea is also that the longer-term growth or the medium-term growth tend to be rather immune from changes in interest rate. However, some of the recent research work actually point towards that maybe this is not the case, and maybe it's time to rethink about this. And in particular, when we look at the tightening episode, you may think that the credit conditions tighten. This is what monetary policy is supposed to do. But at the same time, it may also lower innovation. We know that especially small firms, younger firms, or the firms that typically also more productive because they need capital, reach out for the financial markets to access this type of important capital to start their businesses, to innovate, or even to adopt technologies. If there are not enough financing opportunities, let's say because of tighter financial conditions, this may become a problem for innovation and therefore having an impact on longer-term growth. At the same time, we also have seen some new work coming out based on the idea of a much older idea of a hysteresis, that when the economy is too much of a downturn for too long, there could be some labor scarring, which then have an impact on the capacity of the labor force, and therefore, and with the prolonged unemployment rates, there may be some losses in the productive capacity of the economy. Now, of course, if the firms are going to cut back on innovation, cut back on investment, and even some of them will not be able to survive in the economy, this will have an impact on the productive capital in the medium term. From the allocation side also, ideally, we expect that the finance flows to the most productive firms in an economy, but we know that there are frictions and there are rigidities in this channel. And at the more basic level, of course, when the monetary policy conditions are much more accommodative, this cheap and indiscriminate credit can go to the firms that are not productive and that should potentially exit the market, but they stay. So we also know that this happened in certain episodes of very easy monetary conditions, creations of zombie firms, and how low productive environment they bring out. On the other side, when the monetary policy is tightened, maybe a bit more than what it should, it could choke off the capital to the young firms and therefore bringing their investment and innovation to the levels that are not desirable. So what do we do in this work is to look at these and looking at both in terms of the within firm productivity, so how the firm's incentive and ability to invest and innovate can change, but also the reallocation across resources, reallocation of resources across firms. So this is a broader analytical agenda that we move forward. Here again, so when you think about the link between monetary policy and productivity, of course, you need to think in terms of what affects firms' ability and incentive to invest and innovate. And there we have identified 4 different channels. Credit channels, I mentioned before, typically access to external finance affects younger firms more. In terms of the cost channel at the end, you see that the firms that are operating with very low liquidity buffers may be relying on too much on the external financing for their own production. Therefore, if there's an increase in the cost of this financing, it's a direct operational cost for them, which means that they may need to cut back on production. It could also be that, of course, the monetary policy changes in the monetary policy will affect on aggregate demand, which may have potential impact on the firm's expectation on to invest, particularly on the more interest-sensitive demand goods, such as more durable goods. For the exchange rate channel, of course, we know that the monetary policy changes will have an impact on the appreciation or the depreciation of the currency, depending on the move, and especially for countries potentially more for the outside of the euro area, these differences with the trading partners may have important implications. So again, this affects mostly, I talked about the within firm productivity of tightening. However, when you look at on the flip side of it, on the easing, can we say that monetary policy easing actually makes the financing conditions much more beneficial for younger firms? The answer may be yes, but there we need to be very careful with the reallocation of these funds not to go to inefficient firms. So it could be that monetary policy easing episode actually allows younger firms to access to more credit, which will always, of course, be very beneficial. However, it may also be the case that these firms that access more credit now are not the beneficial ones, but just have they can just access more credit now because maybe the frictions are less in the economy, and therefore we create this inefficient group of firms. So there's a darker side of this that on the impact of policy easing on the firms that we need to be careful. On the tightening side, again, on the reallocation, you may say that there may be some cleansing effect, but this cleansing effect shouldn't imply that, again, young firms cannot access the credit and therefore be cut from the innovation. And of course, on the right side, you see all these different framework conditions, financial development, structural policies, and what are how is the economy's business cycle could affect these relationships, especially that if the economy is already in a downturn, of course, tightening, introducing another negative monetary policy shock have more impact on negative implications of productivity, or the other way around too. If the economy is in upturn already, easing monetary conditions are not going to bring productivity benefit that I mentioned before. Okay, so what we found in the paper is that we checked both the easing and tightening episodes for about 6 million firms across 24 OECD economies for the last 25 years. What we found is that 25 basis point tightening of monetary policy shock decreases firm productivity about 0.7 percentage point over the 5 years. So you may ask, what is this? How should we interpret? Is this a big number, small number? So assuming that the productivity growth for the OECD economies over the last 15, 20 years is about 1.5 percentage point, it's about 15% of lost productivity coming from monetary policy shocks. So now, again, what we found is that there's some differences between easing and tightening cycle, especially that monetary policy easing could bring misallocation by directing more resources to inefficient, unproductive firms, and is about 7% over the 3 years this inefficiency shows up. But again, this impact depends on the transmission channel that we are talking about, as well as the financial development and the competitiveness in the economy and the pro-cyclical or counter-cyclical alignment of monetary policy. So just to go through some numbers, I will skip this. We are taking the monetary policy shocks from a recent published paper. So you see here that there are actually quite a bit of action, even the period that we look at, which is from mid-90s. And in terms of the distribution, we have a bit more easing episodes, but we also do have tightening episodes in the sample. So looking to the within firms effects, again, so this is with a 25 basis point monetary policy shocks, we see a decline in firm productivity about 0.7. So this is, for the last 20 years, this amounts to 15% of productivity loss for the OECD economies. Here we look at what type of transmission channels we can identify in this impact. Particularly what we found is that the credit channel is very strong. So industries, the sectors dependent on external financing are substantially more affected. And also the firms that are relying more on the external financing. So in this graph, you see that in fact the firms that are relying on external finance in the first graph that are very much highly affected, about 10% point more than the rest. Again, so as a second transmission channel, we also look at the cost, whether the low markup firms or the firms with lower liquidity will have more affected with the monetary policy changes. And this is also seems to be the case that when the firms don't have that much of a liquidity buffers to face with the shocks, they are hit much more with the monetary policy shocks. And for the demand channel and the exchange rate channel, we do actually find a weak responses to monetary policy. So in terms of the framework conditions, what can we say that what type of country-specific measures, features that we can think could play a role on this? The first one is on the financial development. Of course, all this idea that the monetary policy shock could tighten the financing conditions for small firms or younger firms or more productive, almost assumes that the financing, there's an issue with the financing, the frictions, and the financing capital markets are not deep enough. What we show is that in the case of the very developed financing markets, actually this effect we don't see, both for tightening and easing. So that means that for countries that are with very developed financial markets, the reallocation impact of monetary policy will be much smaller. And also, again, whether monetary policy is responding in a pro-cyclical or counter-cyclical way also matters in terms of managing the impact of monetary policy on productivity. Just very quickly on reallocation, as I mentioned before, it implies about 7% loss in the efficiency, particularly for the easing episode. So for the tightening, we don't actually see an improvement or the cleansing of the low productivity firms. But for easing episode, we do have a bit of in some ways in the easing episode, we see an increase in within firm productivity, however, a decline in the allocation of resources across the economy. So there's something to be careful of. And then again, in terms of the employment stuck in zombie firms, we see that actually both tightening and easing episode could impact that, and with about 10% increase in the employment stuck in zombie firms or less productive firms. This is for the reallocation channel, again, to show that high financial development or whether the economy is in a downturn or not have an impact. So again, this is consistent with our within firm findings. Also for the resource reallocation, it matters whether monetary policy is counter-cyclical or pro-cyclical. And so I will stop here. I think I'm done, and I will look forward to your questions. Thank you.
Yeah, thank you very much. I think that Carlo can also say that some of your results are very much in line to some of your results and the results that we had. So I think we're in a good way. Please. The floor is yours.
Right. So as Maria already mentioned, so most of my remarks, or what my remarks are largely based on a paper that I co-authored for the Jackson Hole Economic Policy Symposium, in which we were asked to think about the question of, like, can current economic conditions basically affect the long-run outlook of the macroeconomy. And for us, it felt very natural to focus a bit more on this question on monetary policy and innovation, where very much the traditional view has always been, at least since Friedman's very famous AA speech in 1967, that we have this monetary policy having short-run effects, but potentially being neutral in the long run. And the other view that that we put out here, but also that has been put out before our paper by theory, is very much that monetary policy through innovation can have longer-term impact. Not necessarily long-term impacts, but longer-term impacts. Simply because we know monetary policy affects demand, monetary policy affects financial conditions, and we know that both demand and financial conditions affect innovation, and then in turn we know that innovation has potentially long-term impacts. So we have a sequence of statements. And what we basically uncovered while we're working on this is that there was very little evidence or very little thinking about this question. And I think it's great that we have this panel here and that so many people have picked up on the topic or have been already working on the topic, but have been underappreciated by us probably back in the days. And so I think it's great that this topic has very much been put forward now. For us, one of the key findings back in the days that got us thinking about this was that we looked at the venture capital industry, and this was right in the tightening cycle, because the venture capital industry basically during the zero lower bound period had basically this massive expansion in the US. And you all have heard about this boom in VC spending that rose on average like 20% a year for this like first 10-year period, but then had basically a massive contraction starting when the cycle tightens. And that got us thinking about, if we think about the VC industry as one of the harbingers of innovation, at least in the United States, maybe less so in Europe, but at least of the adoption of innovation, that is potentially a thing that we should be worried about if that co-moves a lot with monetary policy. All right, and so what we did in our paper is basically take the standard toolkit that many of us have used before in understanding the effects of monetary policy and throw that at this question using a variety of measures of innovation. Yeah, in measuring innovation or productivity can be very hard. It can be very hard in macro setting, firm setting. So we thought let's provide a basket of things where we think about like spending on innovation, where we think about output measures of innovation and see if these all move together, don't they move together, etc. And we do this with the traditional Roma shocks. We've also done this with other measures of monetary policy, and our results are largely robust to that. All right, and what we basically find is that both spending and output, so in the output measure for us is patenting in particular, is basically decreasing when monetary policy tightens. Yeah, in particular, we find that like following a basically 100 basis point tightening shock, we see that like an aggregate innovation index basically declines by up to 9% over the next 2 to 4 years. And then if we basically, given that we know how this aggregate innovation index correlates with subsequent productivity growth, output growth, we know that output might be, again, another % lower, or TFP another 0.5% lower, another 5 years later. Yeah, so I think the key thing that makes it very difficult is that, of course, we all know that from going from innovation to output or to TFP can take considerable lags. We all know that since Solow, this famous idea of I see computers everywhere but not in numbers. So it takes quite some time for things to show up. So that's also maybe one of the reasons why people have missed a bit on this connection before. All right, let me quickly run through the things that we have done here. So on the first thing is obviously the first thing we can do is look at GDP and look at like spend R&D investment in R&D basically from national accounts data, and you see a decline. The same thing you can do also at the firm level. This is using CompuStat data. Again, you do see a decline. Of course, yeah, measuring R&D at the firm level is very difficult. We only have probably good data from very large firms. We can't really do this from small firms. So for small firms, we want to do maybe something else. For example, what we do here in our paper is look at venture capital investment, and we see this massive decline. Yeah, so for VC, for example, we see a 30% fall after 100 basis point tightening in the monetary policy shock. Yeah, so a very large effect on the VC industry, and this is true both for early stage and late stage venture capital investment. Yeah, so it's not only the late stage that is bring close to being marketed to the market or bringing to the market, but already the early stage VC industry that sees these considerable declines. All right. The third thing we can do is basically look at the output measures of innovation, and here we basically look at patenting, and we basically can zoom in on like what people in the literature call important technologies. So this is like following the definition by Nick Bloom and his co-authors that basically identified key technologies and patenting those key technologies, and we can also look at other technologies, and we basically see a decline in innovation activity in both of these measures in patenting. Though, like all of this is happening with a lag. Yeah? It's not an instantaneous thing, but it's like more, think of this as like a 3-year effect where we see the effects, and then it would take another lag to see the effect on output. All right. Yes. Again, we can do this on subsamples, thinking about public firms, non-public firms, thinking about industries that have like low beta versus high beta. We see somewhat more stronger effect for the high beta firms, somewhat strong effect for the non-public firms, but it's very much a thing that we do see across the distribution. We see this decline in patenting activity. All right, and then finally, given that it's very difficult to come up with a good innovation measure, so Kogan and co-authors have constructed this measure of innovation activity where they look at patenting approval and the stock price reaction to this patenting approval. Yeah, so the idea is if you see a stronger stock price reaction to the approval of a patent that is associated with like a bigger innovation. And we can basically use their index to basically, again, estimate the effects of monetary policy. And here, again, we do see a 9% reduction in this innovation index. Yeah, because the problem is, of course, how do we weight these patents properly, or the individual patents? Before it was counts, and now this is based on stock market data. All right, yeah, so we basically identified these two key channels that we thought about. No, one is basically this demand-based channel where monetary policy leads to a reduction in demand, and therefore it might be less profitable to innovate. And here the idea is basically that potentially you have a stronger response in these high beta industries where you do see like stronger declines in demand. But however, you do also see this strong decline among large public firms. All right, and then which is also going against this financial conditions idea, yeah? While on the other hand, you see this tight financial conditions mattering. If you think about, for example, the early VC response, yeah, early VC investment, there's not very much thinking about the current macroeconomic climate. No, if you think about the current VC investments, they are thinking more about a longer-term product, not so much about a product that they can bring to market within a year or two, where you would potentially expect the monetary policy effects. All right. Yes, so let's go back to basically current economic conditions and how has this world of VC changed since we wrote the piece in 2023. So now we have seen this decline, as you can see here in the graph, and so I have created a tentative data point for 2025, which is basically on Q1 of 2025, which is, I think, very striking. Which is basically showing us a strong bounce back in VC deal size. Yeah, so this is basically taking the Q1 deal size in the US and scaling that up to the annual level. And there you see basically a huge bounce back in US, in the US venture capital industry. But here I basically want to give you quickly a breakdown because I think this is quite informative. So this is basically just showing you deal size over size and this broken down by sector. And as you can see, if you look at the US 2024, that's the very last bar here, you can see that almost the entirety of this deal size in the US is coming from the IT and more specifically from the AI sector. So it's essentially the VC industry in the US is essentially only doing AI investment at the moment. And all of this bounce back that we see in this massive deal size is coming basically from more late-stage investments. So it's very much the ChatGPTs of the world. They're making these big rounds and collecting a lot of money, and a little bit more like the smaller startups are a bit left to the side. And in line with that, we don't see as much of a bounce back in Europe, where the level of venture capital investment is still depressed compared to its historic heights. I will quickly go back to this slide because as I come always from this trend perspective, I think one thing to keep in mind is not that like how limited the effects of monetary policy are or like financial conditions are. Namely that like, if you think about the big technological revolutions, should we be worried that we kill the AI revolution if we impose a too tight monetary policy or something like that? And that is the thing that, if you look at the big revolutions, all of the big revolutions went through in very bad economic climates. Yeah, so if you think about the second industrial revolution, that it was a revolution that was continuously hit by big shocks, crises, wars, etc., and still all of these big, amazing companies still survived all of that. Yeah, so they struggled. But if you think about these very, very high good investment opportunities, they are usually not affected. Yeah, it's things on the margin that might be affected. And similarly, if you think about this third industrial revolution and also the boom of the service industry, there was a thing that basically happened and was jump-started exactly during the high inflation era and exactly during bringing inflation down period where you had oil price shocks, high inflation, and very high interest rates. And still we profit from that today. So I wanted to bring that up. And then I think we have a bunch of things that we have, of course, not figured out yet. And I think maybe the others have figured that out by now. We can figure that out in the panel later. So one of the obvious questions is like, should monetary policy on average be more accommodative if we think about that innovation has an effect? And here, of course, so I personally take the perspective, like permanent easing can certainly be counterproductive. So we know that from the famous work by Friedman, Lucas, etc. But I think where we have more of a case to make is thinking about the countercyclicality that monetary policy should face. So should monetary policy be on average potentially more countercyclical? So that is a thing where we could start a debate, I think. And another thing that I want to bring up here is that like if we think about monetary policy, having innovation effects, potentially we have another monetary policy, fiscal policy interaction that we want to push forward, where fiscal policy steps in with innovation subsidies, etc., when monetary policy tightens. All right, so let me summarize. So we basically found it very surprising that there was this lack of research in this era, except for, like, we found quite a bit in theory, in this endogenous growth literature, but I think it's great that now empirics is picking up very much on this. Now, given that we have this link between monetary policy and demand and financial conditions, and demand and conditions and innovation, and then like connecting the dots felt very natural. Yeah, so it's great to see that a wealth of studies now comes out that confirms this link and pushing forward to this. Yeah, and I think where we can do better, of course, like measuring innovation is very hard. We all struggle with this. So that's why we present a basket of measures here in our paper. But if we can do better, of course, that's great. And then I think a bunch of other things to think about, especially for me, this like sensitivity of the venture capital industry is particularly striking, and I would love to learn more about that in the future. All right.
Thank you very much, Mihaela. The floor is yours.
Yeah, thank you very much again to Maria for the kind introduction and in general for having me in this very interesting panel. So I think from the two previous presentations, we don't really need to introduce this general topic any further, so I'm going to jump right away into the results from two projects that I've been working on lately. So one is empirical on the firm level evidence on the transmission of monetary policy to innovation. And the other one is theoretical and focuses on the basically on the role of monetary and fiscal policy in this setting when aggregate supply is no longer fixed but driven endogenously by endogenous innovation in the end. So about the first one, it's a joint project with Olga Goldfein-Frank and Tobias Schmidt. We're focusing on basically three things. We're studying the systematic effect of euro area monetary tightening, like the most recent tightening on firm level innovation. We're studying exogenous monetary policy shocks. And we're generally also studying the role of forward guidance in this environment. And how we do this is we have a firm-level data set coming from the Bundesbank online panel of firms, and we're employing a survey approach in this environment, as well as some survey experiments to identify the effect of innovation investment in this setting. Now, the first block of these results is focusing on how the systematic euro area monetary tightening over the last years has affected firm-level innovation. And here we're showing a pronounced investment in innovation and reduction over the short term. So we can show this in this table here, for instance, where in general we see that there's about 60% of the firms which were not very responsive in terms of their innovation investment, 9% expand, but about a third of the firms cut, and those that cut, they cut a lot, by on average 67%. So this gives us across the firms an average cut on innovation investment of 20%. And this is a substantial cut if you think about it, especially if you link it to potential productivity effects in the setting. And what we're also showing is that this is not just a transitory effect that firms, for instance, sit and wait and see where the path is going, but they really cut innovation investment in a persistent way. Meaning that the cuts also extend over the medium run, meaning in the end a very persistent slowdown in innovation activity in the euro area, which can be attributed to the monetary tightening. Then, I mean, of course, this is a systematic monetary policy change, but we're typically interested in monetary policy shocks, and we're also interested in changes in either direction, because in this literature, the question whether tightenings, where contractionary monetary policy shocks can have a similar effect as expansions, this is still very much debated and at this point unclear. So what we're doing here is we're also comparing systematic change, basically hikes and cuts of the same size and its impact on the firm level. And what we see is that on the baseline assumption at 4.5% policy rate as a starting point, we see a rather symmetric response. So hikes and cuts transmit into rather similar effects on innovation investment. However, we can show exploiting firm level variation in this context that this might also be related to the high starting point of the policy rate, which we refer to as a potential state-dependent asymmetry of the monetary policy response. And the logic is basically that at this high rate, many firms that are usually innovation active have already cut back their innovation investment. So if you raise the policy rate further at this point, you may not see that much of a response to hikes anymore, but to cuts. So this is something important to take into account, that this level of asymmetry between hikes and cuts might also be dependent on the current level of the policy rate. Now, what also has not been very much understood in this environment is forward guidance. So while we have a lot of evidence on how forward guidance transmits over the short run, its impact on the longer run investments, it's not very well understood. However, it can be, given the long-term orientation and also the uncertainty around the policy rate path, can be very important in terms of the longer run investment decisions of firms, as typically innovation investment is. And what we're showing here directly from the survey approach is that you can have that monetary policy is substantially amplified if it's combined with forward guidance announcements. That means we're showing directly from the data set that forward guidance can have longer term and supply side effects in this setting. And especially the role of the resolution of the uncertainty about the future policy rate is a key transmission mechanism in this setting. So when you take together the evidence from these results and also combined with the other results that we have seen from the literature, there are at least 3 things that I think monetary policy should take away from it. And that's, first of all, that monetary policy transmits through technology growth and through longer-term aggregate supply. So this is already at odds with what we typically think in the new Keynesian model, in which the longer-term output path is fixed and strictly exogenously given. This seems to be not consistent with the most recent empirical evidence in this point. Then what we also are flagging in the paper is that monetary policy may indeed be long-run neutral as a result of this, and that the national rate of interest, or STAR, might be policy endogenous and also not an exogenous concept. And so more generally, I mean, we have talked a lot about the effect of monetary policy on innovation, but there's also growing evidence on the role of fiscal policy on innovation. So I mean, from the monetary side, it's rather clear that monetary policy has at least medium-run effects transmitting through innovation, but also similar results also emerge from the fiscal side. If you take this together and confront it how we typically think of monetary and fiscal policy in this environment, it's still the case that existing wisdom as to the policy implications are usually all derived on frameworks which completely ignore the link between monetary and fiscal policy and growth. So much what we have learned on the implications for debt sustainability, for the risk of fiscal inflations, it's all based on the constant exogenous trend assumption. And in another project, which is joint work with my co-author Nigel McClung, we're building a framework in which this is no longer the case, in which we depart from this assumption and study monetary and fiscal policy coordination under an endogenous trend path driven by endogenous innovation investment. So again, like there's currently a strong debate on high debt, and especially in an environment of high government spending and in light of the recent inflation episode, but these frameworks are all basically set in the exogenous trend assumption. And for debt to GDP, this means you focus on debt to GDP from the numerator side, ignoring the demand growth linkages which we have seen are prevailing in the literature. And generally, the standard results as to monetary fiscal interactions imply, as to the risk of fiscal inflation, always strong fiscal inflation in the first place, and if fiscal deficits are not funded by the fiscal authority, and that in such an environment, also the central bank basically needs to give up its usual stance following, you can no longer follow the Taylor principle in this environment, for instance, because this might lead to explosive path of inflation and public debt. And so what we show in this work is that there's another link, and this comes from technological innovation, long-run growth, and monetary fiscal policy coordination in this setting. And I don't have time to go through the results, but basically in much technical detail, but basically in a nutshell, what is novel in this setting is that we show that technological-led growth can help stabilizing public debt and respond to fiscally unfunded deficits. And here I'm plotting basically the difference between the standard frameworks in which we do not account for R&D, in which we do not account for long-term output path dynamics in the blue line, and then endogenous, and then the model, the otherwise exact same model with endogenous growth. And what we see here is that fiscal capacity, the capacity to pay back public debt, is no longer exogenous, but it's endogenous. And specifically, we see a link between an increase in demand, the expansion of R&D, and expansion of the long-term technology growth, and through that long-term aggregate supply. And that means that the innovation-driven output expansion can help the initially unbacked fiscal deficit through the supply side, and basically to pay back the initial deficits with less fiscal inflation than you would typically usually face, and also reverting public debt back to steady state, back to its initial value in a quicker way. And we refer to this mechanism as a growth financing of public debt, which also reduces the extent of fiscal inflation in this setting. Then here, I don't have a lot of time left, so I want to be quick here, but how important is this mechanism? So this is basically plotted in this chart. So what we're emphasizing here really is that for any reasonable, even if it's small, role of this demand growth link, you actually see a substantial share of public debt which is stabilized endogenously through an increase in growth. And for the benchmark calibration, which is based on previous micro estimates on this demand growth link, for instance, we see that about 50% is stabilized through growth and 50% of fiscal inflation, which is much less, because typically all the adjustment is concentrated to fiscal inflation, which would give you this 100% on the extreme end on the right-hand side. So, and here in general, what you can also take away from this work is that in countries which might be having these strong links between demand and growth, and an important role of the R&D sector, not any country especially as well, but countries with a strong role for that, you might see that technology-led growth can lead to an expansion in both monetary and fiscal policy space in response to a fiscal expansion. Other results that we are flagging from the theory side is that we have a policy endogeneity of our star. Our star is no longer fixed. Both monetary and fiscal policy can influence R&D and growth. And also, we're deriving, which we formalize as a growth-augmented Taylor principle, we show that the central bank should pay attention to not only to the adjustment of the real interest rate, but also to the dynamic adjustment of R compared to the adjustments in the growth rate G. And lastly, what's important to emphasize, I said it already, this capacity for basically supply-backed fiscal stabilization is likely to be subject to big cross-country heterogeneities, where in particular countries with strong R&D sectors and strong responsiveness of the R&D sector to changes in demand might be subject to that feature, whereas others might not. And also differently to, for instance, the general argument on R minus G smaller than zero as launched, for instance, by Blanchard. This is not a story about a permanent fiscal free lunch, because our setting is about R exceeding G throughout the model. And again, like also the model still features also the possibility of fiscal deficit-driven inflation surges. And to conclude, so what we've seen is that monetary policy can affect innovation and technology growth, both through systematic monetary policy changes, through monetary policy shocks, and through forward guidance. And that the conventional wisdom on monetary fiscal interactions omits one potentially important additional mechanism, and this is through the policy transmission through the supply side, through R&D and through innovation. And the one point that I would like everyone to take away, so as well as fiscal deficits, can also lead to demand expansions, which also raise innovation-driven productivity growth and trend output. Through that, you can have a partial self-financing of through the supply side, which mitigates inflationary pressures, and this at the same time also permits a more aggressive response, both from fiscal policy and is crucially also monetary policy in this environment in response to inflation than previously assumed. Thank you.
Thank you very much. So, Galo, the floor is yours.
So thank you very much. I mean, again, as the previous presenter, thank you very much for the invitation. I think that this is a pretty cool session discussing a topic that I mean, obviously find very, very relevant for central bankers. So as Maria Teresa was saying, my kind of ambitious aim today is to wrap up what the previous presenters have said and coming back with a kind of so what. So I mean, the previous presentation, I think that quite convincingly have argued that, one, monetary policy affects innovation, capital misallocation, and finally, TFP. One important thing that is always not entirely clear, I mean, it's entirely clear if you read the papers, but it's an important distinction, is whether this impact is on TFP level or on TFP growth, but let's leave that point for further discussion. And the question there is, okay, fine, but then what should central banks do? Should central banks start stimulating the economy with the hope of creating an open AI in Europe? I mean, that is the kind of policy conclusion. Then, as most things in economics, the answer is not going to be so obvious, unfortunately. But just, I mean, revising not only, and then I take, I mean, let me take a little bit the glow from Kaspar. The fact that monetary policy affects TFP is relatively well known for more than 30 years. So you can read, I mean, there are papers by Evans, Bernanke, and Mihoff analyzing monetary policy transmission that they already show how monetary policy expansion increased TFP level, monetary policy contraction decreased TFP level. And that evidence has been revisited over and over again with more advanced methods, from a standard VAR with kind of basic identification schemes to local projection with super cool high frequency monetary policy shocks with hundreds of years of evidence. So that is a point that with granular microdata. So in a way, I think that we can at this point kind of safely, as long as something can be safely in economics, support the point that monetary policy, I mean, contraction and monetary policy shocks reduce TFP. There are, as Phyllis was explaining, there are different theoretical mechanisms through within firm incentives to invest in R&D, capital misallocation. So, I mean, on the one hand, I think that we more or less are on safe ground. But the question is, what does it matter? I mean, what should we do as policymakers in terms of designing policy? For that, I should move one step back and think, what is the current standard? I mean, let's look at the standard kind of New Keynesian model, which is the workhorse for most central banks. And if you take Jordi Galís or Mike Woodford textbook and start doing half an hour of relatively simple algebra, you end up having the basic trade-off. I mean, the Kidler and Prescott Nobel Prize. I mean, the trade-off between inflation volatility, and output gap volatility. And that, in a way, summarizes the key trade-off that central banks are facing, or think that they are facing, which essentially is that you need to stabilize both inflation volatility and output gap volatility. The underlying reason in the model of why it is the case, we can also leave it for later. And then the monetary policy prescriptions are also relatively well known. The central banks should react differently to demand and to supply shocks. In the case of demand shocks, the central bank, I mean, when you have an expansionary demand shock, given monetary policy being a demand policy, you should tighten in a way that, in the simplest model, the real rates that the central bank can steer should mimic the path of the natural or the short-term, let's call it neutral rate. And then essentially you can attain this kind of divine coincidence by which you are able to reduce inflation volatility and output gap volatility. However, in response to supply shock, a trade-off appears because now inflation is going up, but output is going down. So then in that way, the central bank should, up to a certain point, accommodate. This is what people refer to by looking through, which means not reacting, but not reacting as aggressively to supply shocks as to demand shocks. And by the way, that seems to be the case not only on the theory, but there are several papers in the context of the revision of the strategy of the ECB has been work done on that, but also BIS colleagues has also done on that, showing that actually, if you look at the actual behavior of central banks, like the Fed, Bank of England, or the ECB, this is the way that they behave. So central banks react differently to supply and to demand shocks. Okay? So far, so good. Now it comes the secret, even within the model. If you open any of these textbooks, you will see that after the first two terms, there was something that they typically call TIP. TIP stands for terms independent of policy. But if you unpack those terms independent of policy, you will see that if you do the math, you get two extra terms. One is the volatility of inflation, and the other, the volatility of TFP, of productivity, and the other is productivity themselves. Here you see things, the central bank minimizes that. So essentially, the central banks wants to maximize TFP and reduce the volatility of TFP. However, that is never taken into account, because in all these models, as Michaela was explaining before, TFP is exogenous, so you don't need to care about. In a world in which TFP is endogenous to policy, then the trade-offs of the central banks become more complicated, because now the central bank not only has to balance a trade-off between short-run output gap stabilization and inflation, but now it's like kind of this middle-aged jugglers that is moving three balls at the same time. Inflation stabilization, output gap stabilization, and productivity stabilization. And productivity stabilization operates in two ways. First, you don't want to run policies that produce too much volatility. And second, the linear term, what it means is that it introduces a new timing consistency motive. What is a timing consistency motive? Everyone understands the point, the timing consistency associated with output gap, which is this temptation that the central bank can have to boost output gap, to boost output via demand expansion in the short run at the expense of creating too much inflation, and how these kind of policies are self-defeating, because if the private sector anticipates those dynamics, you can end up in a wall with higher inflation expectation, higher nominal rates, the same real rates, and no output stabilization at all. So this is the kind of policy in which you can cheat the people once, but you cannot cheat the people recursively in order to implement it. Exactly the same problem emerges with productivity. You can surprise once running this kind of policy shock to the market in order to boost innovation once. But this is not a sustainable period-by-period policy. That is a one-off option for central bankers. So it does not seem to be a very appealing policy. But even if we leave aside this purely timing consistency associated with innovation, it still remains the problem that the juggler has to play with the three balls: inflation, output gap, and TFP. Then, now we get into the world of the models. So far, what I've said is kind of general. Now, what I'm going to say is specific to a particular model in a particular paper. So everything then should be taken with a grain of salt. The point that comes from a paper with different co-authors from the ECB, the IMF, and the Bank of Spain, in which we implement kind of a state-of-the-art heterogeneous firm model calibrated with granular microdata at the firm level. And essentially, we make the question of how to run optimal monetary policy in that setting. And here, what we are comparing is the model, that this heterogeneous firm with misallocation, I mean, the kind of thing that Phyllis was talking before, in the baseline. Then the textbook, what is called complete markets, is the standard textbook 3-equation Keynesian model that you can find in any monetary policy book. And let me skip for a second what is the yellow line. In the case, if we compare the red with the blue, the key point is that when you look at the panel of TFP, the red, and what we are looking here is about a supply shock. Okay, I will talk about demand shock later. So if you look at the red line, let me start with that, the red dash line. Actually, within the team, we always have I mean, one of my co-authors says that this is orange, but I mean, let's not discuss about that. I still see it as red. But the point is that this is what you find in the standard model. TFP does not change with a supply shock. TFP is constant. And then what you observe is what I was describing before, this looking through. Essentially, this is what Jordi Galli calls lean against the wind, even if that term then has been captured by the macro people and now creates more confusion than it helps. And essentially, the idea is that the central bank, who, let's not forget, in this kind of model, the central banks, there are not inflationary or deflationary shocks. In this kind of framework, the central bank controls inflation fully. So the central bank is not a victim of inflation. Inflation is created by the central bank. However, the central bank tolerates inflation because by tolerating a rising inflation in response to a cost push shock, it dampens the falling output. So essentially, the central bank is a little bit like St. Augustine. It is, I mean, he wants to fight inflation, but I mean, let me live with a little bit of inflation for the short run in order to dampen the decline in the output gap. Okay, that is the red line. Now let's move to the yellow line. The yellow line is what happens in a model, in a more sophisticated model with this endogenous productivity mechanism. If you run the same policy that is optimal in the standard textbook New Keynesian model, then what happens? Then the path of inflation in the red and the yellow line coincides. However, the problem is that now the path of the natural rate and the real interest rate and on output is different because an amplification mechanism is created through the endogenous productivity. So if the central bank now tolerates the same inflation as in the other case, TFP goes down. TFP goes down due to the supply shock. And then as TFP goes down, output goes down even more. This is not output gap. This is, I mean, this is purely output. So then the point is that if you run that policy, you are creating a significant volatility of TFP and an enhanced decline in output volatility. So then the optimal policy in this case is for the central bank to look a little bit more through the shock. So to tolerate a little bit more of inflation and then to try to dampen a little bit the decline in output and the decline in TFP. That's all. So in a way, this is kind of a refinement. Is it qualitatively changing the standard prescription in response to supply shock? No. Does it mean that central banks should systematically try to stimulate innovation by running a hot economy? No. What it means is just the central bank should also factor in its reaction function the impact that each reaction or external shocks can have on productivity via these different channels. And now let's move to demand shocks. Again, textbook, I mean, simple model, very simple model, only price rigidities. Then what is the standard textbook prescription? In response to demand shock, you look at the red line, and the red line is you keep inflation constant, you keep output gap constant, you keep TFP constant, that is, and then you just play with the interest rates. So essentially, interest rates are moving in order to dampen the effect of the shocks and then attain this divine coincidence. Okay? Now, what happens if I operate with this policy in a model with an endogenous productivity channel? That this policy is not optimal anymore. Because now, if you keep inflation constant, so if you are really the hawkiest of the hawks, what you are going to create is output volatility via endogenous productivity volatility. So then, again, you need, even in a demand shock, you need to look through slightly demand shocks. So you need to tolerate negative demand shocks, a little bit of inflation. I'm always talking on this kind of inflationary, but then you need to reverse exactly the same picture through deflationary things. I mean, just to be clear about that, this is symmetric. So then, essentially, that is I mean, with that, I kind of summarize what I wanted to say. So the point is that I agree with all the previous presenters that those channels are very important, that this is something that has to be factored into that, but again, that should not open the door to kind of reinventing time inconsistency, and in the 70s thinking that central banks should try to micromanage the economy in order to keep full employment by systematically surprising the economy, and 30 or 50 years later, we should not rethink the same thing with innovation. However, that means that the business of a central banker is even more complicated. Because, I mean, if you really take seriously all this evidence, and I think that this is very serious evidence, then central banks should feature a discussion about its own decision on innovation and productivity much more than is currently being done by most central banks. So that was my conclusion. Thank you very much.
So thank you to all four panelists. I'm going to, I was hoping like a more clear, optimal monetary policy from Galo, but you managed to complicate the answer and complicate the discussion. So, I mean, what you said, and I think that that is also something that comes up from the panel, that we do have a lot of evidence, we can discuss whether it is robust or not, that there is an effect of monetary policy and productivity. And as Carlos said, I mean, this is also not a new thing. I think it's not really accepted by some central banks, but there is a lot of evidence, and the evidence is very old, and it is also, I think, I mean, I think that what is going on right now is that we have much more granular evidence, which makes it a little bit easier to identify. So my question to the panelists, and I will ask the order, like we did the panelists to answer, okay, so do we have enough robust evidence? And would you dare to say what that means for central banking, for policy making? So, Phyllis?
Thanks. It was great, great panel. I think we do have enough evidence on this, that by now both the theoretical work and empirical work is indicating that monetary policy does have an impact on productivity and innovation. So in that sense, I think we shouldn't shame away to say that monetary policy does have an impact on the medium-term growth. Now, I want to make a difference between long-term and medium-term. At the end of the day, we don't have that much of empirical evidence for the long-term, right? So, but at least we can, I think, bring the discussion to medium-term, which I would think that could be defined as a period of time where the investor, where the firms sort of can adjust their factors of production, does the investment decision, and maybe take some new decisions on innovation and investment or adopt new technologies. So that is there. But again, I think there are reasons to be very cautious as well, as the panel indicated earlier, particularly Gulo. So one of the reasons is that, of course, timing consistency, it's there still, so we should be careful. But our research also shows that both what we have done at the OECD and outside, other policies also have an impact. Of course, Mihaela also mentioned the fiscal policy. What can we do for investment? What can we do for firms? In some ways, is also the business of fiscal policy, and also importantly, structural reforms, right? So that we know that the regulatory conditions play an important role. We know the insolvency frameworks play an important role in firms' productivity. We know that how competitive is the market play an important role. Financial development play an important role. So all of these other elements are also there. So also the countries need to get their house in order first to all these structural elements to be in place, and which in our research, for example, it also shows that when all these structural conditions are solidly established, the impact is much smaller of monetary policy on productivity. So this shouldn't be ignored. Also that just one thing, the sectoral distribution of productivity also matters. We have seen in Europe, in Spain and Italy, for example, before the global financial crisis, very accommodative monetary conditions, but very low growth, very low productivity. Also in my own country, Turkey, very high growth, but very low productivity, all the money going into the construction sector. So for all this, to monetary policy, for a central bank to have an excellent view on where the financing goes in the case of an accommodative monetary policy is a very difficult task. Apart from very well-known challenges of how to know in real time where is productivity. But I would indicate again that I think the medium-term implications of monetary policy should be taken into consideration, especially for investment, because we know that investment have an impact on, of course, the productivity, innovation, and more broadly for employment and living conditions of people. So this, I think we shouldn't ignore.
Okay, thank you. Casper, do you want to?
Yeah, so I really like Galo's image of the juggler, and it's very hard. Like, I guess if you have 3 hands, you might start to juggle with more balls. I can only do 3 balls at the same time, and that's already struggling for me. So I'm always worried, if we have too many objectives at the same time and we're trying to follow too many things at the same time. Yeah, I mean, I guess in an ideal world, we would just push it to the fiscal authorities and say, can't you do something counter-cyclical? But I guess they all also have even more balls that they have to fly at the same time. So not sure who's the right institution to take up the challenge. I certainly think that the evidence is very much pointing in this direction. There are, I think, dozens of papers coming out of central banks a year now that I think are collaborating evidence in the same direction. I think 95% of them show evidence in that direction. So I'm given the confidence bands, etc. So that should give us some credibility. But I think I personally think we haven't fully figured out yet who is the optimal actor in response to this. Yeah, and like how should we very much think about the response to this and how this should fade out. Of course, yeah, so I agree with Galo that we don't want to permanently try to stimulate the economy. I hope I made all that clear also in my introductory statement. Yeah, we might think a bit more about like stronger counter-cyclical response functions and so on. And there has been some evidence that countries that respond with stronger counter-cyclical forces tend to have higher long-run growth. So I think that points a bit in that direction, that a stronger response to output gap might be something that we could consider as a first principle.
Thank you. Mihaela?
So I was thinking for the question about some practicalities. So I mean, if we believe the empirical evidence that we have been discussing, there's still a key challenge in practice that, already TFP is unobservable, so it needs to be estimated. So how are you estimating that share that can be influenced by monetary policy or fiscal policy in practice? So this is a really big task. However, both from the empirics and also from the empirical side, we know, or we can defer in any case, that the measures that we're typically using for assessing slack for measuring potential output may not be correct as they are, because there's a bias coming from the technology side which can be influenced through policy in some form, and working on how to identify this in practice, and ideally as simple as possible, I think is a big gap in that area more generally, thinking of time series methods or simple production function approaches in this case, which may not be able to fully fix it, but in any case may be able to go in this direction as far as possible based on what we have. And some ways of working around this could be also, in order to avoid policy mistakes coming from biased measures of slack or potential output, could be to go, for instance, to pay closer attention to technological specific time series, for instance, thinking of R&D series, thinking of measures of technological adoption that we have available. That could be one thing that may need to be close attention to be paid to. Another nice way of doing this in real time, because there's of course also always the lack with the availability of the statistics, is to go more in the direction of survey data from the firm side, where you can basically get a grasp of what's going on the firm level with respect to investment and technology enhancing investment specifically, more or less in real time. So I think this is a quite promising area, also for policy. And and similar concerns also extend to how we measure and estimate our star, I would say. Or at least to basically give this additional warning that our star, as complicated as it already is in measuring, might be even more complicated for these reasons that we have been discussing today as well.
Okay, thank you. So I don't know, I have more questions for the panel, but maybe at this point I open the floor for questions. The light is, I think Jakob said, Jakob, and then Klaus, and yeah, let's start with Jakob here.
Who was the first?
Jakob.
Thank you very much. Very stimulating panel, but I'm still not convinced. Perhaps, I'm not a central banker anymore, but I'm conservative anyway. So, talking about innovation, it's not that I personally would address you, but suppose that the central bank had not increased interest rates, because there's a reason that central banks were, increasing interest rates, because, inflation was getting too high. Suppose the central bank would not have done that, and inflation would have been at a structurally higher level. And we know higher level of inflation comes also with higher volatility of inflation. What would then be the impact on innovation? Yes, shouldn't you take that into account in your model as well? Now you only focus on the policy shock as such, and how does that affect innovation? But I think you're missing one part of the story, namely why is this contractionary policy in place, and what would have happened if that were not in place? So the second question I have is about your result about forward guidance. I've done a lot of work on central bank communication, and we know that in general, financial markets clearly respond to forward guidance, obviously. But firms and the general public have no clue about monetary policy. They have no clue about forward guidance. So how can it be then that they respond in terms of the innovation policies? I don't understand it.
Yeah, let me take that one, I guess, right away. So as to the first question, this is not model implied. This is purely empirical, so we're not making any assumptions. What we're doing is we're documenting, we're identifying this effect from the firm level data, and that's it. This first paper that I presented has nothing to do with a model in the first place, so that I can say, then of course, what it means is that result that we have established does by no means apply that there shouldn't have been a rate hike. We don't make any statements about the counterfactual of what would have happened in the absence of that, but this is what this paper is not doing. It's about documenting how firms responded to the systematic change. End of the story. For making a welfare assessment or a counterfactual, you would need to set up a theoretical model and do that. We leave it at that level. We document that that change led to average firm level innovation adjustment by -20%, and we're estimating productivity effects based on that. The rest we have to leave to future research. About forward guidance, well, the survey respondents we have are the CEO and the CFO of a firm. So typically, I mean, this has been established that at least those persons answering the survey should understand what's going on, and they do pay attention to monetary policy and to forward guidance. Otherwise, we would not have identified this effect as well. So, and I mean, especially if you think of the innovation decisions with long-term outlook, with very uncertain planning horizons and these type of things, of course, firms pay attention to monetary policy communication, I would say, especially if you are communicating with experts who actually make the decisions on these questions.
Okay, does somebody else want to?
Just on the last point on forward guidance, I mean, at the end of the day, firms do not need to understand what's going on, right? So, but they go to the bank understands what's going on, and it is reflected in their borrowing cost, either in terms of the premium that the bank charges or in terms of the quantities that banks allow them to lend. So even if you are not necessarily following the market, you know what the bank charges you and how much it lends you, so it affects you ultimately.
Yeah, that's true. Caro, you want to the first question about?
The first question is a good one, and then I think, I mean, it's a nice thought experiment, but then, I mean, in order to answer the question, the answer would be, imagine that inflation has not happened, and I mean, it has happened, and the central banks does not react. And then it's a question about essentially what does a monetary policy shock in models or in empirical work versus how do you translate that to the real world. In the real world, banks, central banks, are assumed to have a certain reaction function. That is, I mean, a proper central banker should react in a systematic way to the different contingencies. If, of course, the central bank reacts in a total random way, then the market incorporates that. But then the point is that if the market assumes that you're not reacting to inflation because you systematically are not going to react to inflation, that is one world. If the market perceives that you are going to react to inflation, but that something has happened in this particular instance that is not going to happen again, but that for that reason, I don't know, I mean, imagine that the episode could have happened and due to geopolitical consideration or whatever, there will have been a request to the central bank, or the central bank will have decided not to, I mean, even central bank independence will have been suspended for 1 year. I mean, I'm talking about totally crazy scenarios. Then in that case, the answer of what would have been the impact on inflation, output gap, and TFP would have been different. Because the key point is that in one of the cases, that would have been something similar to a monetary policy shock, because what is a monetary policy shock? A monetary policy shock is that, for no reason, the central bank deviates from its own reaction function. So then the point is that reading from what is the impact of a monetary policy shock into TFP, inflation or whatever, to how a systematic reaction function from a central bank maps to inflation is very different in this setting and in general in macroeconomics. So this is not, I mean, this is a point about bridging the theory/empirics to the real world. But then my 2 cents on that particular point is that in that crazy state of the world, in the second state of the world in which people would perceive that it was something temporary that is not going to have happened, then innovation and TFP would have been higher vis-a-vis a world in which that craziness does not happen. But in the first situation in which what the market perceives is that for some reason the ECB or the central bank has been captured by a bunch of kind of daft that don't want to, that are willing to tolerate a lot of inflation, that would have immediately prop up inflation expectations, all the kind of premia, and the whole yield curve will have shifted upwards with the real curve not having changed. And then there would have been zero impact on, or if not negative, through all the misallocation introduced by operating in a high inflation world. So then, I mean, the point is, I mean, pick your poison. It's depending on what is, I mean, why that is happening, the impact on inflation and the impact on productivity would have to be entirely difficult. So it's not that easy to frame that as a scenario if you don't see the underlying causes. I hope that answers the question.
I hope also. Klaus? And then afterwards, Oscar. Here.
Thank you. Great panel. One question for Gallo on your very nice presentation. Take your standard dynamic DSG model, add an endogenous TFP equation, have the TFP feeding back into the numerator and the denominator of your output gap, and do not modify your objective function. Juggle 2 balls back instead of 3. Isn't that a cleaner way than juggling your 3 balls?
No, I mean, that is actually what you are describing is the proper way to dealing with the 3 balls. So in that wall, the output gap, so the output gap is never very, I mean, with exogenous, is how do you define the output gap? The output gap is the deviation from observed output from a counterfactual output that would be, I mean, to be very academic, in a counterfactual world without nominal rigidities, okay? The question here is now, that is not enough, because in that counterfactual world without nominal rigidities, this channel through which monetary policy is affecting TFP disappears. So then you would need to define, I think that this is what you were thinking, that the output gap is defined as the potential output that would be in a wall without short-term nominal rigidities, but in which TFP evolves as it is going to evolve in your current wall. And then you are affecting both the numerator and the denominator, as you've been correctly pointing out. So that would be the right way to set the objective function of the central bank. That is the proper way. But that does not. First, then you make this unobservable objects like the output gap even more, even less observable than it is nowadays. But then, having said the right objective is like 1/2 of the question. The other half is then how to implement the proper reaction function given that objective. But yes, the short answer is you are totally right.
I hope that answered the question. Oscar, back there.
Thank you. Thank you very much for the very good panel. Okay, better. Thank you very much. This was very, very stimulating. So 2, 3 very quick points. First of all, yes, it is very tempting to think that tighter monetary policy has a particularly high negative incidence on innovation and these kind of firms that are super innovative and drive TFP growth and so on, because yes, they are more risky and so on. Well, all of us have grown in this tradition of thinking that these kind of activities were more sensitive to monetary policy. But is that hypothesis true at this moment? I'm asking this just based on a simple correlation. I mean, over the last few years, we have been a significant tightening in the monetary policy of the major central banks around the world, but this has taken place in parallel to a huge boom in investment in the most innovative technologies like artificial intelligence. So would you say that this last round of monetary policy tightening had a dampening impact on the most innovative firms in the business? So for me, it's not that obvious. Second issue, I find super useful this effort to try to quantify the impact of monetary policy on productivity and so on. I must recognize that whenever I see this micro-based evidence, I have to then switch my mind to try to understand the order of magnitude of what you find. No? And in particular, Phyllis, but also I think Kaspar presented some figures that at first sight, to me, look a little bit large. I mean, if I remember well, Phyllis, you said, well, a 25 basis points shock in monetary policy, I guess in the short interest rate, may trigger an increase in TFP by 0.7 percentage points after some time. Well, that's a lot, if you think about it. I mean, we have not been able to get this impact on productivity, at least in the EU, after investing billions and billions of public and private money. So I'm not sure that we central bankers are so powerful so as to induce such a big impact on TFP, just moving our modest tool just a little bit. No? But maybe I'm missing something there. And final question, I mean, from a practical point of view, okay, we know that monetary policy is, tighter monetary policy is always painful. We know that it destroys growth. It destroys investment. It dampens demand. It dampens future supply because investment is lower. It destroys jobs as well. Yeah, it's painful. We know that. But if I read all this new evidence, my basic question is, okay, so are we really missing something new and quantitative important out of all this discussion? Thank you.
Thanks. Who wants to take that question?
Yeah, let me clarify first.
There were three questions, by the way.
Yeah. On the impact, so 0.7 percentage point cumulatively over the 5-year period. So this is about 10% of the productivity growth that we observed on a regular basis. So 10% loss, let's say, associated with monetary policy shocks. I can start, but I know Gaspar didn't talk, so if you want, you can go first.
Yeah, I can quickly talk about the high innovation firms. No, like I showed you a couple of graphs on venture capital, and if you think more like venture capital is exactly going towards the high innovation firms, there is very much the case that we have seen a massive collapse in the VC industry. It has, if you talk to people in that industry or something like that, it has been very, very challenging for firms to refinance if they had to refinance exactly at that point in time when the monetary policy cycle started. And no, of course we know that OpenAI still had very big rounds and collected a lot of money. No, and that's what we usually think about. But if you think about the whole VC landscape and the number of unicorns and so on, there's a reason why we now have the term the zombie unicorn, yeah, which is basically this firm that has suddenly run out of money because it was basically unable to collect additional rounds of funds. And we had innovation in this VC space, not only in AI. The fact that it is now so concentrated within this one industry should potentially get us worried, that we are not making as much progress anymore in healthcare and in other sectors, because the VC landscape was before very, very broad, and it has very much concentrated towards this one field with this one tightening cycle.
So just to add on this, so what we are learning with this new type of research, and it also goes back to your first question on the tightening and VC innovation. What we see is that now we are refining the research in a way that how we can quantify the impact of monetary policy on productivity under which conditions. So one of the findings that we have is that monetary policy tightening brings a decline in productivity if it happens in a downturn. So the economy is already in a downturn, and monetary policy shock is a tightening shock. So it's almost like contracting the economy even more and brings inefficiency, and reasonably speaking, it brings a decline in productivity. I don't think that's the case in Europe following COVID. We are not in a downturn and we are tightening. So I think it's important to realize that if the monetary policy stance in some ways reasonable, is countercyclical, these negative impacts on productivity could be much less, and this is one of the recent findings that we show in this research, as also with some other policies like the structural policies, more financial development, market competition, etc. So I'll stop here.
Maybe one very short in response to the first, to the first and third point of Oscar. I should say as a disclaimer that he was my former boss, so I will never say anything to upset him. Then, having said that, I disagree with the first point in the sense that. That what has happened in the last 3 years has not been a contractionary monetary policy shock by the central bank. If any, could be interpreted as an expansionary monetary policy shock, in the sense that the reaction function of the central bank prescribes a necessary monetary policy tightening, and if any, and I'm not saying that it is the case, but it's open for all of you to think about that when you are alone at your room, whether the central bank has been, if any, more expansionary during the last 4 years than what would have been prescribed by its own monetary system. So then, if you buy that, I'm not saying that is the truth, no, I'm not even saying that it is my opinion, but if you, and much less the one of the Bank of Spain or the Eurosystem, but if you buy that point, then what we will have observed is an expansionary monetary policy shock perfectly coherent with an expansion in productivity. So that simple correlation, I think, is not the right mental experiment to address that point. And then about the third point, about the monetary policy tightening, we know that it is painful. And then, I mean, the only point that I tried to convey in my point is that this whole issue is not a qualitative change from the standard mindset of central bankers. This is not saying you should react differently to demand and supply shocks. It is a quantitative point, is that maybe you should be a little bit less painful. Maybe you should be a little bit less painful because there are these side effects via productivity. Or in the other way, maybe you should be a little bit less expansionary. I mean, let's take both things. It's not only one way. Maybe you should be less painful in one way. Maybe you should be less expansionary in the other way because it operates symmetrically. That was my point.
Okay, I will close the panel with a disclaimer that this is my view and not that from the governor. I think that what has changed a little bit is like when the governor started his period 6 years ago, the topic was more that the very accommodative monetary policy was detrimental for productivity, and I think that was more like the storyline, the narrative at that time. And I think that what you have shown is that this is not the case. I mean, there was the zombie firms. Of course, there was the narrative of the zombie firms, but with time it has evolved that the very accommodative monetary policy was not that bad for productivity, and actually it could be good if done in the right quantity. But of course, there will be another strategy review, Oscar, and we can think about that for the next strategy review. Lunch is served, I think, so we will reconvene, I think, at, somebody help me, I guess in an hour, at 2:30. So thank you very much. Thank you for the panelists, and thank you for your questions.
Ladies and gentlemen, I hope you have enjoyed lunch, and I'm honored to welcome you to our second keynote lecture. It's about monetary policy, taking a walk on the supply side. You might notice the reference to a Lou Reed song, and I would have been happy to play it when you come back, but unfortunately, due to legal constraints, we are not allowed to broadcast it. You can do it, probably afterwards. Our keynote lecturer, Hugh Pill, doesn't need a lot of introduction. I mean, he's chief economist at the Bank of England. And some of you, like me, who have been involved in central banking for quite some time, know him already from his time at the European Central Bank, as he was head of monetary stance division and Deputy Director General in research. So I'm very happy that you followed our invitation, that you are here. Yeah, and the floor is yours. Thank you.
I always say when I get clapped at the beginning is that the real test is if I get clapped at the end. So it's a bit higher stakes when you get clapped at the beginning. So first of all, good afternoon, everyone. It really is a delight for me to be here this afternoon, and I'd like to thank the organisers of the event, both at SUERF and at the OeNB, for inviting me. And of course, thanks to the Österreichische Nationalbank more generally for preparing such a great event. Really, it was an outstanding set of discussions this morning. If you'll indulge me just for a second, it's a particular pleasure for me to have the opportunity today to meet up with so many friends and former colleagues from my time working at the European Central Bank. And I should say, I think you can be both a friend and a former colleague, so I hope those two groups overlap, at least in part. On both policy and research dimensions, the Eurosystem and the wider European system of central banks have advanced significantly since I left the ECB, now more than a decade ago. I hope they haven't advanced because I left the ECB. But both staff and leadership, which are well represented in this room, I think should take enormous pride in that development and the progress that's been made. So at the Bank of England, as we grapple with the challenge of updating our monetary policy framework in the context of the recommendations made in the recent Bernanke review of the Bank of England's forecasting and monetary policy preparation, we have a lot to learn from our friends on this side of what we sometimes rather parochially call the English Channel. The promise of continuing collaborations between the Bank of England and other European central banks, particularly in the field of macro modelling for policy purposes, shows the value of inter-central bank cooperation and exchange. That's something that I've really highly valued throughout my career, and I hope can continue afresh, and I think this is a great example of what that can achieve. So in that spirit, and I don't want to raise expectations for my own contribution today to unrealistic levels, I also trust that the Bank of England can contribute to, as well as benefit from, that collaboration. So let me turn to the issue at hand. The topic of this conference, monetary policy and structural tectonic shifts, could hardly be more timely. Whether you look back to the impact of the COVID pandemic or the Russian invasion of Ukraine in the recent past, or you think about confronting pressing contemporary challenges of uncertainty in the global trading system and the possibility of wider changes to the international economic and financial governance, or you look ahead to the many potential geopolitical, geo-economic, and financial risks that might arise in the future, it's hard to escape the conclusion that the world is being shaped by precisely the tectonic shifts that we're considering here today. From a monetary policy perspective, the key feature of these shifts is not just that they're larger than what we've experienced during the great moderation enjoyed in the decade from the mid-1990s, although I think a very good case can be made that they are indeed larger, nor is it that these shifts are more unpredictable than what was experienced during that great moderation, although again, I think a very good case can be made that they are indeed more unpredictable. Rather, I think this was illustrated by the discussions this morning, rather the key feature, for me at least, is that these tectonic shifts have embodied a combination of interrelated demand and supply shocks to global and national economies, which are difficult and maybe even impossible to distinguish in real time. In this environment, and for reasons I hope to discuss in my remarks today, monetary policy making has proved challenging. Since I rejoined the Bank of England staff in the autumn of 2021, the bank's Monetary Policy Committee, of which I'm now a member, has faced some of its most difficult times, not least when UK headline CPI inflation, the measure of price developments that we target at 2%, temporarily rose well into double digits. I think a crucial thing to recognize is that recent inflation experience doesn't just challenge recent policy choices, understood as the timing or the magnitude of specific bank rate decisions. Everyone needs to recognize, and I think most people do, that in a context of these tectonic shifts, it is pretty much inevitable that the large shocks seen of late, which by nature are both big and unanticipated, would increase the volatility of inflation outcomes, especially when data uncertainty and the infamous long and variable lags in monetary policy transmission are taken into account. I think instead, recent inflation experience is more importantly seen as raising questions about the effectiveness of monetary policy frameworks or strategies within which policymakers formulate those individual interest rate decisions. And that is why framework reviews are currently in vogue across the central banking community. Reassuringly, experience in dealing with the recent pandemic and invasion-induced inflationary shocks to the global economy has, at least on my reading, largely restated the importance of core features of the monetary policy frameworks, including that of the Bank of England and indeed the Euro system. Among these I'd number a clear price stability mandate for monetary policy established in legislation, operationalization of that mandate in the form of a quantified target for inflation, independence of the monetary policy making body, in the Bank of England's case, the MPC, institutional separation of monetary policy from other policy domains, notably fiscal policy, and procedures to ensure transparency and accountability of monetary policy decision making. These features have helped central banks prevent a disanchoring of longer-term inflation expectations akin to what occurred in the 1970s. And as we heard this morning, maintaining that anchoring of longer-term inflation expectations has avoided a much longer and a much more costly inflation episode than what we have in practice experienced in the past few years. But I think there are open questions for monetary policymakers, but these largely revolve around the practicalities of formulating policy decisions within this rich web of everlasting verities governing the policy framework. This challenge may be especially acute at the Bank of England. The MPC's inflation targeting regime, adopted in the mid-1990s, placed inflation forecasts and the fan charts that surround them at the heart of both the internal formulation of bank rate decisions and the public presentation of the rationale for those decisions. Crucially, the inflation forecast was collectively owned by policymakers on the MPC rather than by the staff who had constructed them. The forecast and the policy decision were two sides of the same coin. A monetary policy framework that placed a policymaker-owned inflation forecast at its heart naturally comes under challenge when forecasting inflation gets more difficult. And these recent structural tectonic shifts have created significant problems for economic forecasts, both because they constitute large and novel shocks, and in particular, because distinguishing the supply and demand effects that comprise them is difficult. As the Bernanke report has demonstrated, it's not the case that the MPC's inflation forecasts were notably worse than those of other central banks, nor, as my colleagues Derek Kaninska and Tim Willems have shown, did the Bank of England's inflation models prove noticeably less reliable than those of other central banks, at least once the erratic behavior of the external variables such as energy prices, global demand and supply, on which these inflation forecasts were conditioned, are taken into account. Rather, inflation forecasting became more difficult because the shocks to the UK economy were unprecedented and profound. They were precisely the structural tectonic shifts that we're here to discuss today. So what I want to do in the remainder of my comments is explore the implications of these tectonic shifts for the firm and household behavior that drives price, cost, and wage dynamics, and channeling my inner Lou Reed, as has been said, I invite you to take a walk on the supply side. So for all of you in this room, I don't think I need to go into too much detail about how different types of shocks can have different implications for monetary policy. And I'm fortunate that that was already discussed in the second panel this morning. So I'm just going to assert that one of the key things that is relevant in this discussion is that we do need to make this distinction between the various components within these tectonic shifts. We need to distinguish between demand shocks, which, as was said this morning, lead to some sort of divine coincidence, where there's no real deep trade-off that monetary policy faces in the manner of Blanchard and Gali. Or do we face some component of these big shifts that reflect supply shocks or cost-push shocks that do induce a trade-off in a manner that creates challenges for monetary policymakers? I think the implications of that were well described this morning. Crucially, one implication of that is that we have different monetary policy responses appropriate to different types of shocks. When you get multiple types of shocks at the same time, the key question is, can you work out whether you're facing more divine coincidence or more trade-off, how you get the balance? But what I think is also important to emphasize, and this is something that also came out this morning in some way, is that there is a danger that because it's easier to deal with demand shocks, because they don't generate these trade-offs, there may be a tendency for, particularly under pressure from external sources like markets, the media, and politicians, to interpret these big tectonic shifts as really being demand shocks and neglect their supply components. And I think that's akin to what the Orphanides' explanation of the great inflation was. What Athanasios Orphanides said was, the great inflation in the 1970s was not created by venal behavior on the part of central bankers at the Fed. If you look at the documentation they were looking at, the Fed continually thought that the supply side of the economy was stronger than it turned out to be. And as a result, the Fed continually ran a monetary policy that was looser than it otherwise would have been if it had known the truth. And it was that process that, if it didn't generate all the inflation, it certainly accommodated a lot of the inflation. Now, I think Orphanides is making this point in a positive sense. He's not really attributing any sort of normative aspect to this. But I do think this is one of the challenges which reinforce the need to maintain independence in central banks, given the pressures that we are under, is to recognize that distinguishing supply and demand elements is so crucial. So what I thought I'd do today is try and link that to now. This rather complicated chart shows results from the Purchasing Manager Index Institute survey, the PMI survey for the UK. And I break that down into a set of real indicators shown in yellow and nominal indicators shown in grey. Now again, you can look at this chart and draw different conclusions from it, but for most of the history, it looks like those yellow and grey indicators are positively correlated. They move together. That would be consistent with demand shocks driving most of the thing. When you have strong real indicators, strong demand, strong activity, you tend to push up on prices and inflationary pressures. But what is interesting is, and this is somewhat distinguished in the UK relative to other jurisdictions, there in the most recent data, and we're talking about the last 18 months data really, in the most recent data, they seem to be negatively correlated. Despite weakness in the real indicators, we're actually seeing the nominal indicators remain strong, and in fact, if anything, rise further. And I think that's why this is a particularly acute issue for the UK at present. So what I thought I would do, and I fear this may initially sound a little bit backward-looking and a little bit parochial, but I think it does illustrate a number of points, and then I'll conclude more generally at the end. What I thought I would do is just take a brief, short history of how inflation targeting has worked out in the UK and what lessons that has for us today. I think it's good to look back because history is the only basis we really have to learn from. And although it is a little bit parochial, it avoids that I trespass on other jurisdictions, which probably is not appropriate for me to do in this context. So back to what I have called the halcyon days of inflation targeting in the UK. So this was from the mid-90s until the beginning of the financial crisis, really. That was a period where UK inflation targeting was seen as very successful. It was seen as cutting edge, and crucially, it delivered inflation at target with very little volatility in output and employment. And of course, central banks and the Bank of England were riding high in that context. It was the great moderation, what Mervyn King has called the nice decade. And there's a debate in the literature about whether that was due to good policy, and I think it was in part due to good policy, or was it due to good luck? And I think it was also in part due to good luck. So the relative weight of those two things. But crucially, in the context of what I was just saying is that you had to sort of work out were there supply and demand factors driving the economy, what their relative weight was, and crucially, how predictable they were. So if you look at the supply side of the economy, what was assumed at the time, and I think what turned out to be true, was that trend growth in the UK economy ran at somewhere around 2.5% a year, real growth. That's much stronger than what we're experiencing now. And that's quite a favorable environment for a central bank when growth is doing well. But crucially, it wasn't just growing relatively strongly, it was growing relatively stably, It was more or less a linear trend. And as a result, in part, it was very predictable. So an inflation forecasting central bank, or inflation targeting central bank that was basing its decisions on a forecast, could reliably make the view that over the forecast horizon, the potential supply side of the economy was growing at 2 to 2.5% a year in a relatively straightforward way. And at the same time, there were indicators, like the PMI I just showed you, which were available in real time and which were very good predictors of what economic activity would be 6, 9, 12 months ahead. So my former colleague on the MPC, Ben Broadbent, was working at an investment bank in London at this time, and he claims, and I think it's true, he was able to forecast UK GDP 1 year ahead just using the PMI indicator and the sterling trade-weighted exchange rate. So if you think about what the logic of this was, using those two indicators, you could form a view of activity. Because supply trends were very stable, the variation in activity at that horizon was all driven by demand. The gap between what activity forecast was and this very stable trend gave you a good measure of pressure on resources. Pressure on resources at a year's time gave you a pretty good view of what inflation would be in 18 months' time. If you think the lags in monetary policy transmission are about 18 months, that gave you exactly the information you needed to set interest rates today in order to stabilization in inflation at target. Of course, other things would happen over that 18 months. There would be volatility in inflation, but you could do the best you could do because you could forecast well. And that led to a virtuous circle where the bank was seen as doing the right thing. It was delivering inflation close to target with low volatility. That built the credibility of the framework, it stabilized expectations, and a self-reinforcing virtuous circle was produced. But no good thing lasts forever. And maybe if I've learned one thing in central banking, that's what I've learned. So what happened is challenges emerged to this very benign environment. And of course, the first one of these, or a significant one of these, was the financial crisis. So when the financial crisis hit the UK economy, that led to a quite sharp decline in labour productivity growth. And I'll show you in this chart what that looks like. Prior to 2008, UK labour productivity had grown at a rate of about 1.5% to 2% since the late 1970s. And in fact, I mean, again, if you draw a long enough chart, everything looks predictable, but you can go back to the late 19th century and it looks like productivity through time is on a very stable trend. But in 2008, that trend seems to have broken. And if you see that if we had continued to follow the trend, the UK economy would be about a quarter bigger now than it actually is, right? So that tells you that compound interest or compound growth rates work very, very powerfully. Now, if you look at that chart, and you put yourself in the position of a policymaker in 2009, you're going to ask yourself, is it that this very stable trend we're going to go back to, or has something changed? With the benefit of hindsight, it looks quite obvious that something's changed. But in 2009, it wouldn't have looked so obvious. You might have thought the natural thing was to go back to trend, there would be more potential growth in the economy, and that would allow you to run policy looser. So I think the supply side environment changed quite dramatically. And of course, once the supply side factors are changing, then those indicators that measure activity, like the Purchasing Managers Institute survey, well, they begin to be affected not just by things that are demand indicators, demand-driven, they become also supply-driven. So that nice split that we can rely on the trend rate of growth of potential activity and so forth, that began to break down. So what did the Bank of England do? It said, well, we don't know what productivity is going to be. If we want to try and find where the slack in the economy is, we can't look at GDP, we can't look at measures of aggregate economic activity. We should look at measures of slack in the economy that are not affected by this uncertainty about labor productivity. And the natural one would be to say, well, let's just look at employment. We know more about the NERU in the language of starred variables that came up this morning, we know more about the natural rate of unemployment U star, because that isn't affected by productivity, directly at least. And we have good data on unemployment. So let's focus on looking at the unemployment gap as a measure of slack, as a measure of domestic resource pressure, as a measure that's telling you something about UK domestic generated inflation, because that tells you something that is really about what we need to know to set UK monetary policy. What was the pro of that? Well, it took some of the uncertainty out of the system. What was the con of that? Well, labor market indicators tend to be later in the cycle. So we were less able to look so far ahead. Monetary policy, to some extent, became less forward-looking. And as a result, I think inflation volatility began to rise in the early part of the 2010s. So this reliant on late cycle indicators, they may be more accurate, but they come to us later. So that creates a sort of interesting trade-off I'll come back to. But of course, if things can get bad, it doesn't mean they can't get worse. And again, that's the second thing I've learned in my career in central banking. So we did have the whole experience of the last decade of moving into the pandemic. We also had Brexit in the UK, of course. And this raised a further set of issues. So in the UK, the pandemic was a massive, unprecedented shock. It created lots of uncertainties. It had big demand effects, it had big supply effects. It was, I think, a seminal example of these structural tectonic shifts. And on top of that, we had lots of dysfunction in financial markets as well at certain times. For the UK monetary policymakers, that led to a number of practical concerns, which I list here. The first thing is the quality of our data deteriorated quite significantly. So we construct unemployment like most people do by having a household survey. People during the pandemic, first of all, you couldn't survey them. Second, even when the lockdown ended, they no longer opened their doors, they no longer answered their phones. And so the quality of the data really deteriorated. We were used to having response rates around 50%. Response rates fell to about 15%. So as a result, the data was very corrupted. In particular, we did not have good data to distinguish between people who were unemployed and inactive. So to the extent that we were relying on this sort of attempt to look at the unemployment gap, unemployment was an indicator that was particularly ill measured. Of course, this had knock-on effects on the labor market. We didn't quite suffer from the Great Resignation, which is kind of what's talked about in the US, but we had very aberrant, in some sense, behavior of inactivity in the labor market. So when the pandemic ended and the economy was opened up, in all the other European countries in the OECD and Canada, inactivity in the labor market fell, and actually fell quite rapidly. So people went back to work. In the US, it was more like the UK, but the UK was a country where people had left work and they had higher levels of inactivity, even as the economy opened up. So again, we were faced with this issue of saying, well, is this something that's just permanently changed? This is very different from the past. Is this something that the pandemic has altered? Is this something arising from the welfare system, from demographics, the type of issues we were discussing this morning? I think all those remain quite open questions. What's more, if you look across the behavior of potential GDP, the movements in productivity over the last few years have been pretty erratic. So the left-hand bar here shows this nice decade, this great moderation. Productivity growth in the UK is north of 2%. But in the period after the financial crisis, it's much lower, it's more volatile. In recent years, it's actually turned negative. So although the UK had quite good potential growth in 2024, this has largely been driven, even though we're out of the single market for labor, it's largely been driven by immigration. And of course, as in other European countries, that is a politically contentious issue. And as we look forward, I mean, there are uncertainties of a political economy type about that. We are assuming that productivity growth returns to its lower post-financial crisis norm. But actually, there hasn't really been productivity growth at that pace for most of the last decade. Is that because of one-off effects, like Brexit, like the pandemic, or is it a more lasting structural phenomenon? These are the types of questions that it will require an econometrician many more years of data to know the answer to, but we nonetheless have to make decisions in real time. So how did we deal with this? What we did was we recognized that what we had been doing, relying on the unemployment gap, well, the NAIRU was very uncertain, the natural rate of unemployment was certain, and we couldn't measure unemployment very well. So those became difficult issues. What did we do instead? Well, in practice, what we set about doing was look for indicators that were even later in the cycle. We thought that we would look at key indicators of what we called underlying persistence in UK inflation. And in particular, we flagged services price inflation. So this is something that's very much UK domestic economy, and I think we measure it quite well. We continue to look at measures of pay growth, but as I've said, pay growth was subject to some of the same challenges of measurement that I've described. And we looked at tightness of the UK labour market using indicators like vacancies and so forth, not just relying on unemployment. So we tried to broaden our assessment to a wider set of indicators, but we tried to focus it on things that were indicators of persistent inflation in the UK. These are all very late cycle indicators. So services inflation is about 60% of UK CPI inflation. So by looking at services price inflation, we're setting monetary policy for achieving an inflation target, looking at inflation itself. And that by nature is reacting to contemporaneous inflation rather than forward-looking inflation. So I think the kind of argument we made at the time was these indicators are trying to pick out those persistent components by their nature are the ones that will still be there in the future. So that maintained some forward-looking element. But again, we come back to this, there's a trade-off between more reliability in the indicators and their forward-looking character. So what are the lessons we should draw from this experience, which I've tried to summarize for policymakers? And I'm going to kind of draw three. What I've tried to argue is inflation forecast-based targeting is quite challenging when you have these structural tectonic shifts. And it's challenging in part because inflation forecasts are hard to do when you have big shocks, unprecedented shocks, and trying to break them down into things you know more about, supply shocks and demand shocks, becomes difficult to do. So what should monetary policymakers do? I think there are sort of three possible choices. First thing you could do is that you just rely less on those inflation forecasts. And that has really been the practice at the Bank of England, as I've tried to describe. I don't want to speak for others, but I think the movement of the ECB to this reaction function with other elements than the forecast is a bit in that spirit too. So I'd be interested to know what other people think about that. But it does create this situation that you do end up with this sort of problem that you're looking at late cycle indicators, and there's a trade-off between reliable indicators of inflation, the most reliable one being inflation itself, and the fact that this means that you're going to be slower to react to innovations because you need to be forward-looking given the lags in policy. But I think it's also true that we have to think, and this came up this morning, about other elements that move us beyond the inflation forecast. So one that was discussed at some length is inflation expectations. Now, in the inflation forecast type baking philosophy, inflation forecasts and inflation expectations end up being the same thing. But I think, as was discussed this morning, in practice, when we have big shocks, we move away from the comfortable place where these are self-reinforcing, as was the case during the Great Moderation. Then the question of where do inflation expectations come from becomes a big deal. And so quite a lot of research has been done at the Bank of England on whether inflation perceptions and expectations are more driven by specific salient prices, like food prices or energy prices, or whether the experience of high inflation has generally made households and firms more attentive to inflation developments, and so made shorter-term inflation expectations more volatile. But I think, and this was uncoordinated, just to be clear, but I think it's also the case that the question of if you try to break out of this very self-referential world of a dynamic stochastic general equilibrium model of inflation or inflation forecast targeting, I think it does raise questions about, do you need what in the old days used to be called a nominal anchor for monetary policy? And we did talk earlier in the previous sessions about the exchange rate, and the governor raised money. And I think one of my small number of achievements in my time at the bank over the last few years is to ensure that we do have an analysis of money every year in our monetary policy report. And I think that has the potential, at least, to be an important anchor for expectations in difficult times. I think another thing we should probably have to think about is that in these more straitened circumstances, we have to think about how to evolve our communication to recognize that there probably is going to be greater volatility in inflation at the sort of 1 to 2 year horizon. That doesn't mean we've given up on achieving our target over the medium term, and the medium term orientation and a symmetric point forecast seem to me to be very important things. They are eternal verities in our framework, in the language I used earlier. But recognizing that there may be greater volatility around that forecast, I think, could be important. So, yeah, there may be reasons to think about making inflation forecasts less prominent. The second thing is, well, let's keep going with inflation forecasts, but just make them better. And that was a little bit the topic of the first panel we saw this morning. Now, how can we make our inflation forecasts better? Well, if we had better models of structural changes in the economy, any forecast error, any shock, is dependent on what the model is. If we're making big errors, we're having big shocks in our existing models that underplay the role of these structural tectonic shifts, then maybe we should have more modeling of the shifts themselves. And I think that begs quite an interesting question about how much we should rely on traditional economic thinking and how much we need to rely on other disciplines to give us insights into these structural tectonic shifts. So the governor made a comment on volcanoes when he was introducing the conference this morning. And that did remind me of the events in 2010. Mrs. Tumpel-Gull, I think, was also at the ECB at that time, where this volcano exploded in Iceland. I couldn't pronounce the name of that volcano then, and I certainly cannot pronounce it now, so I won't even try. And I was hauled in to the office of the president of the ECB at the time, Mr. Trichet, and he told me, all your short-term inflation forecasts are very bad. And I said, yes, that's because this volcano has exploded, and we can't have import certain things and vegetables, there's no flights, etc. And he said, well, why can't you forecast that? And I said, somewhat unwisely, with the benefit of hindsight, I am not a volcanologist, I am an economist. So there is a question, should we be employing volcanologists? I don't know. But I think facing forward to the political economy issues that were coming up around trade policy and other things that were discussed this morning, I think there is a question about, do we need more expertise in that geoeconomics space? That's obviously very topical right now. Although, without wanting to make too controversial comments, you might say, to understand policy decisions, you need to know more about anthropology or psychology, as I think other people said. But I think there's one thing about sort of trying to identify shocks better. There's another thing about understanding better how they propagate through the system once they happen. At the Bank of England, we have been doing an exercise called the supply stocktake to make sure these supply issues are included in the thinking in our forecast, and we do that once a year. But I think that exercise has tended to focus on how have those long-run trends in labor productivity, the types of things I showed in the chart earlier, how have they evolved? Well, the answer is, as with any trend, from one year to the next, they don't change very much. So I think that exercise has not been very helpful in dealing with the challenges we've been facing of late. And I think what it points to is that we need to recognize there are some shocks, some disturbances, which have supply effects, which aren't trend effects, that have big effects relatively quickly. And the obvious one in recent times has been the disruption of supply chains following the pandemic, which might be very relevant as we go forward in the new trade environment. So increasingly, and I think there's a bit of an experience, I took this a little bit from things that came up this morning, particularly Sarah's comments. I think we're moving to a world where we're taking deeper dives into key supply issues, which are more episodic rather than periodic. So we're going to do it when we need to do it, and there will be emphasis on making it timely rather than regular. And that's motivated a lot of activity of late in the environment we face. And one of the key elements of how we can make that useful, and this also came up this morning, is to exploit more cross-sectional data, to explore more micro data, much more of which is available now than was the case even 10 years ago, let alone 30 years ago. Look at cross-sections to try and understand the behavior across firms or across households. And in particular, and I think this was implicit in what was said this morning, use surveys where we can survey key decision makers quickly with very tailored questions to the circumstances at hand. So we have a network of agents across the UK who visit firms regularly, and they can be asked to ask anything at any time. So that is quite a flexible approach to doing this, but we also have an online decision-making panel survey, which we have used to do similar things. And then, of course, we can also do some econometric work, and this was, I feel, a little bit under the guidance of Guido here, because this is his thing, but we can estimate time series models. Self-citation is a terrible thing, but this is from a speech I did last year, trying to say, can we use sign restrictions to distinguish between drivers which have more supplying character, more demanding character in the current environment? I mean, it's very difficult to see in this chart for being flashed up ahead of you. You should read the speech, which is a great speech, but it does suggest that there has been quite a big supply effect in boosting inflation in the unexpected ways beyond what our forecasts have said. But then thirdly and finally, one of the things that's very much putting the Bank of England in the frame at the moment is that we can also do what we call what-if experiments. So at the heart of a lot of these tectonic shifts is the question, has there been a structural break in behavior? As I've already said, if we're asking the question, has the, say, bargaining processes in UK labour market for setting wages, determining costs, and thereby setting domestic inflationary dynamics, have they changed fundamentally post-pandemic as a consequence of changes in institutions, changes in labour participation, and so forth and so on, some of the points I made earlier? Well, we have 30 years of data looking backwards. We have 13 quarters of data now. It's very difficult econometrically to identify a break with that information. When I was a graduate student and I was being taught time series econometrics in the early 1990s, we were still arguing about whether there had been a break in productivity in 1973, 20 years before, right? So we're going to have to wait until, hopefully I'm retired, before we'll get a definitive econometric answer to that question. But policymakers don't have that luxury. They have to make decisions in real time. And I think, as also came out in a couple of discussions this morning, what that leads you to think about is, how robust is your decision? And the way we are thinking about doing that is exploring the robustness of different policy choices using scenarios. Now, I fear this is another example of self-citation, and I gave a speech earlier in the week. I'm not going to get into this too much, but what we are trying to do is explore the consequences of potential changes in structural economic behavior. This chart is difficult to interpret, again, just being flashed up. But what we do here is say, let's assume it is true that the estimated intrinsic persistence of UK inflation based on wage bargaining in the UK, which has a level of 1.3, if you estimate it in this framework along the bottom. If you do the equivalent exercise for the euro area, that number is 1.5. So let's assume the UK becomes more like the euro area, just as a choice. But then let's explore that if the policymaker makes policy on the basis of different assumptions, which are not truth, so they go from, actually the UK has become more flexible, to the UK has become yet more persistent or yet more inflexible than the euro area? How does the policy cost of those policies with the wrong basis evolve? So the bars here show what happens to inflation, and the more restrictive you are with policy because you think things are more persistent, the lower inflation volatility becomes. But because of the types of trade-offs that were apparent in the last panel, the actual cost of doing that begins to rise. That's why there is a trade-off between volatility in output and employment and maybe in innovation and lowering inflation volatility. So when you choose a policy that's based on the true value of this persistence parameter, of course that creates the minimum. That's the 1.5. That's like if the UK is the euro area. But what I think the interesting thing about this chart is that for this exercise, if you err on the side of having a kind of pessimistic view about inflation persistence, that it stays higher for longer, which is not true, but you're making the mistake in that direction, the cost you generate in terms of welfare is smaller than if you make the equivalent mistake on the other side. And it's sort of this type of exercise that we're exploring with scenarios, at least internally within the bank, to try and work out that if we're going to make mistakes, which type of mistake do we want to make? And that's one of the sort of rationales that we're exploring for using scenarios in the design of our policy choices. So I've given you 3 ways that we're trying to deal with this challenge. Let me conclude with a few overall remarks. I think the key thing here is that there are eternal verities, independence, medium-term orientation, focus on price stability, that we need to preserve and protect in challenging times. And I think that's true generally, but I think some jurisdictions are more subject to pressures there than others. And the central banking community probably needs to show some mutual support. There is strength in numbers on this dimension. But that has to be set against the need for, in the face of these big tectonic shifts, we need to show some flexibility and agility. And that's why we need to have these reviews. That's why we need to have a certain amount of open-mindedness to the type of difficult discussions and issues that we're being engaged in this morning. For me, the conclusion I would come to, which might sound vacuous, but hopefully has some content, is we need to remain principles-based, but we need to avoid dogma. That puts a big weight on having the right principles, and I think that's what central bankers need to think about more. So let me stop there.
So thanks a lot. Thanks a lot. I enjoyed the speech a lot because I always prefer speeches that talk about the difficulties of monetary policy compared to those that explain to us how easy it is and that the people know everything. I know that we ran out of time, but still I would like to give the audience the opportunity to ask some questions. And here in the 3rd row, we have the first questions. And in the 4th, here in the 3rd row, yes, the gentleman here.
Yes, thanks very much, Hugh. David Marsh here. I don't know if you know that today is actually Sherlock Holmes Day because it was the birthday of Sir Arthur Conan Doyle. So I thought I'd ask you a question about the dog that did not bark. You didn't speak that much about Brexit, but we have had this rapprochement over the last few months, not just in the last few days. Is it allowed to put into your scenario analysis some kind of analysis of that, even though it's very, very threadbare for the time being? You know, is it really going to move the needle? And then allied to that, you've spoken a lot in the past also about immigration. You mentioned it here and there. Of course, that's been incredibly volatile. We've had the new figures out today. In your view, how much of this very large net immigration we've had in the UK has really been economically significant to the extent it really has an impact on the labour market? And there's been a lot of Ukrainian refugees and people from Hong Kong and so on. I don't know whether you could just sketch over those thoughts, please, Hugh.
Shall I? Do you want to take the question?
Yeah, let's take the second question. Please.
Yes, thanks, you. Very insightful speech. I have a comment, and I would like to see what you think about it. So you distinguish and you say at a certain point that you should rely less on forecast, or we should rely less on forecast. I tend to disagree on this in the sense that maybe we want to distinguish between stable and unstable regime. Forecast that the ECB in the last 2 years has been spot on. And that, you know, it kind of normal then when you have large and persistent shocks, then your forecasts are bad. I mean, that's, and in fact, they were bad for everybody, not only for central banks, as you said. So what actually we should do, as you mentioned, and also Sarah mentioned, should look, use a lot more data, all the data that are available, timely, tailored surveys, etc., to actually detect possible shifts that you know, make our model suffer from the forecast perspective when you have either large shocks or tectonic shifts. So from this point of view, I think trends and the stars, and I would like to see what you think about it, are actually very dangerous objects. That's, you know, my own view. They are very difficult to pin down. And it's very dangerous to set policies based on those. I'm new in policy making. I would say that you should do policy making on observables, because you don't know what these guys are. They're all over the place depending on the model. And that's also very related about the supply-demand thing. Again, that's more a narrative or thing. Like, so it might be that you have a big shock, like you know, the post-pandemic shocks, that moves the potential. Supply is impaired. You have an excess demand because you try to get consumption or output at the same levels before. So that's excess demand. Is that demand or supply? I don't know. It's just the supply is impaired and you know, demand is bigger than supply, and that's you get more inflation.
So I think, I mean, those are two very good questions, and if I will try and answer them with one answer rather than two answers, because I think they're very complementary to each other. So I have a lot of sympathy with the idea that monetary policy needs to be forward-looking and monetary policy needs to be based on observables. And I think those two things, to me, suggest that we need to find indicators that support making the right policy choices that we can observe today that lead to the right outcomes in the future. I think there has been a tendency, and I think the Bank of England's inflation forecast base was to say, let's forecast and feed back from the forecast. And I think that has been something that has been challenged by recent environments, because then it does matter that the forecast is bad. It might be the best forecast you can have, but I think it has a little bit, you know, brought into question external credibility, but it's also complicated the internal discussion in ways that are not healthy. So I think very much in the spirit of what you're saying is trying to understand what we're seeing, what we're living through, at least that. I share the view that, particularly if you have problems with data quality, but you also have uncertainties about what's going on in the structure of the economy, relying on forecasts based on certain fixed assumptions about the famous starred variables, R star, the NERU, potential level of activity, things that are not observable, but play a big role in some types of models, many types of models. I think that's a dangerous game. And that, in a way, brings me to David's question. So I think you're pointing to a number of events, one now a little bit in the past, although its consequences and de facto implementation are probably more recent, and one which is almost literally contemporaneous. And I think these are things that it's very difficult to know in real time what the implication of those set of issues is for the type of starred variables that our model have and our policy in some sense is being derived from. So one thing we can do is think about, can we find policies that are robust to variation in things that we just cannot know in real time? And the second thing is how can we improve our understanding of those things so there's less uncertainty around them? I think it's worth investing in both of those elements. And that's why I think, at least on my conception, some of these what-if exercises are useful. Because what, from the perspective today, I think we have to do is set a monetary policy for the UK that, say it's the case that there's lots of immigration that makes the labour market much easier and brings down resource pressures in the labour market, reduces wage growth and weighs down on inflation. We don't want to be setting monetary policy in a way that if that's the outturn, we end up in a very strongly disinflationary, deflationary potentially dynamic that could have longer-term consequences to the downside. But equally, if it's the case that the type of migration we're seeing or the type of impact of changes in our trading arrangements, be that with Europe or the US or other parts of the world, is having a impact in the other direction. So for example, for every person who's immigrates here, they are also on the demand side, not the supply side. Do those things balance out, or are there more people demanding than there are supplying, at least in the short term, because there needs to be some orientation, or the demographics are such that, that there's a lot more, people who are being schooled or are having to be looked after in care because they're old or whatever it might be. So there's no guarantee in the short term, at least, that there's a balance between. And in particular, if there are fixed assets here, like housing or something, you might well see that that pushes up on inflation. So again, for me, that's a very difficult thing to know an answer to. That's a very difficult thing to know in real time. That's a thing you should be exploring, getting the most of data you can in the way that Guido described. But I think it's also something that you can say, well, let's say the net effect of migration is pushing up on demand for housing and a wash in terms of the demand for goods or food or whatever it is. That's going to be inflationary in the UK. We want a policy that doesn't allow that to run away over the next 3, 4, 6 months, 2 years, in a way that could be destabilizing to inflation expectations and so forth. So I think, at least for the internal discussion amongst policymakers, where these issues arise, you want a structured way of thinking about the what-if question and try and find a policy that avoids bad outcomes across a plausible range of what could happen.
So thank you for this excellent speech and answering the questions. Thank you for the audience for the questions and your patience with us. I think now we have another break for about 15 minutes. Do we stick to the timetable? Yes, I have an indication. So you have a break of 15 minutes, and thanks a lot. Thank you.
Ladies and gentlemen, welcome back to session 3, the last session of today, which will deal with monetary policy and structural changes in the labor market. In this session, we will examine the evolving dynamics of labor markets shaped by demographic shifts, by technological changes, by changing broader economic conditions. We will focus on the impact of aging, migration, skill polarization, digitalization and automation, of course, including AI, on labor supply and demand, potential growth, and on wages. We will also touch upon the effects of global trade and impediments to trade. And ultimately, our aim is to flesh out some implications for economic and monetary policies, of course. We have 4 outstanding experts to shed light on these issues. I start with Martin Kocher, who is Professor of Economics at the University of Vienna, former Federal Minister of Labor and the Economy, and also former boss of the Institute for Advanced Studies, and designated OeNB governor as of 1st of September. Martin will set the scene with a big picture view of key factors driving labor markets and technological progress in the years to come, as well as key areas where economic policies should become more active. Second, we will have Jakob de Haan, Professor of Political Economy at University of Groningen. Jakob is also the former president of SUERF and currently member of SUERF's Council of Management, and formerly the head of research of DNB, among other functions. When checking the internet for this introduction, I got ambiguous information on your publication lists. So one source gave me 700, the other gave me close to 1,000. So I'm not sure what is correct.
Pick which one you like.
Jakob will offer key insights from his extensive empirical work on the impact of technology and trade, as well as of structural reform on employment. Third, Oskar Arce,
Arce, I think, DG of Director General of Economics at ECB,
Very good.
and Chair of the ECB's Monetary Policy Committee, formerly Director General of Economic Statistics and Research at the Banco de España, which also involved roles in the Banco de España's board, the ECB Governing Council as alternate member, and in the EFC. So you have seen it all. Oscar will zoom in on some specific stylized facts and challenges regarding productivity and labor market developments, including implications for labor costs in the euro area, which is, of course, a very important aspect for inflation. Oscar will also offer a glimpse into new monitoring and forecasting tools developed at the ECB and at the Eurosystem in response to the recent high inflation episode and, of course, also during COVID and so on. Last but not least, I welcome Eduard Talamas, Assistant Professor of Economics at IESE Business School. Eduard will zoom in on the impact of AI on the knowledge economy, and more specifically on labor markets and international trade patterns. Eduard will also explain how different forms of artificial intelligence have different effects and why it matters for countries' autonomy to regulate artificial intelligence where AI computing power is located. So is it in the US, China, or in Europe? We'll first have 4 presentations of 10 to 12 minutes each, and then have the opportunity for interaction among the panelists and with the audience. Without further ado, over to you, Martin.
Thanks a lot, Ernest. First of all, thanks a lot for having me. It's a great pleasure to be here. And I think it's the last session of the afternoon, and I'll try to be very crisp and clear and short, hopefully, and talk a bit about some policy issues that I think are relevant at the moment. And I see 4 challenges, and we're mostly addressing some of them today, actually. But I start with the one that is more or most relevant, in my view, when it comes to the topic of the session, and that's demographic change. What you see here is a projection of the percentage change of the population by NUTS 2 regions from 2015 to 2020, and you probably don't see the details, but the yellow places or the yellow NUTS regions are those where there is less than a 10% reduction in population, but there's also the blue regions where there's more than 25% reduction in entire population. And it's not only the workforce, it's the reduction in the population in itself. You see that most of European NUTS 2 regions are actually declining in terms of population over the next 25 years. The process started, but it will actually become much stronger over the next 20-25 years until 2050, depending, of course, on some not known developments such as migration from outside the European Union or the euro area. But in the end, there will be a decline, which is, of course, quite dramatic in historical terms. There is aging all over the world, particularly in Europe and in Asia, but also in the US. There is different projections until 2060, but we'll see quite a lot of changes when it comes especially to the workforce. The workforce is shrinking in most developed economies over the next 20 to 30 years, actually. And in some, it will be dramatic. Let's just take an example. Outside of the European Union, China is projected to reduce population by the end of the century to about 700 million, which is about half of the population that China has at the moment. And this is, of course, unprecedented in former times, except for whatever. The plague probably was the only example where population was shrinking in some areas in the same extent and at the same speeds. The second thing I wanted to mention very briefly is technological change, and this is I'm sorry, there's no headline. This is labor productivity in different parts of the world, some examples, and you see that is reducing, and that the European Union countries, most of the European Union countries, I have 4 here, are below the United States for almost 20 years now when it comes to the growth of labor productivity, which is, of course, a problem in terms of the outlook, the economic outlook. So if you want to summarize that, we see four things that I think are relevant from a policy perspective. We see a slowing down of potential growth due to a lack of skilled labor, which is quite dramatic when you see the forecasts that are existing at the moment. So there's a forecast for Germany where potential growth for the next 10 years is around 0.4, 0.5%, a reduction from about 1 to 1.2, 1.3% in the last decades. Also for Austria, potential growth is reduced below 1% over the next 10 years. It was close to 2% in the last decade before the pandemic. So a slowing down of potential growth, which is of course quite substantial in historic terms. We'll see perhaps less innovation and innovation diffusion due to aging. We know that aging societies, they don't adopt technological changes, innovations as quickly, at the moment at least. This is something that has an effect, of course, on the economic potential output. And we see a general upward pressure of labor costs due to scarcity. You know, of course, the projections are always difficult. We'll hear about AI and the effects on the labor market from some of the panel. So we'll see what's going to happen. But at the moment, the projections tell us that labor scarcity will lead to an increase of labor costs, a trend that will, of course, affect costs for companies. And we'll see much more competition for workers between countries and industries. And we'll see that already very strongly. Now, at the moment, given a sluggish growth in many European countries, it's not as binding as it was, for instance, in 2022. But in the next recovery, stronger recovery, we'll see that very strongly, and we already see that in some of the industries or some of the parts of the labor market, the health care and caring system or caring industry is, of course, already characterized by strong scarcity, actually. And I just wanted to mention very briefly to actually set the stage for some discussion, a few things what I think is needed in the future by the European Union and by the member states to actually address these challenges that I mentioned. First of all, skilled labor supply, any kind of measures that provide a higher supply will be helpful, actually. And there's lots of things that can be done, reducing the tax wedge between gross and net incomes, modern training, reskilling and upskilling, better childcare and child education, inclusive labor markets, but also, of course, qualified migration. There is a lot of potential within the European Union that is not in the labor market yet, but of course also outside of the European Union. Second, changes in labor market policies, which I think is difficult for many countries. My experience over the last couple of years was that many people still live also perceptually in a period of surplus in the labor market, which means unemployment. And many of our institutions, many of our policy measures are targeted to the surplus problem and not so much to the scarcity situation, the shortage situation that we might face in the future. So it will be important, public policy, but also company policies. There's still a lot of company policies that are not well targeted, well suited to what we are going to expect in the future. Very briefly, support and embrace technological change. There's a lot of things to be done here. I'm not going to go into the details, but it will be important, of course, to do everything to compensate perhaps for the scarcity in labor by technological advance, by innovation. There's lots of possibilities here. And if this is done properly, I'm convinced that there is much more room for compensation than we are thinking at the moment in the future. And at last, I would say some well-founded optimism. So not the kind of optimism that some of us probably had today when you think there's not going to be any rain tonight and don't bring any jacket, as I did. That's probably not the well-funded or well-founded optimism. But I think there is good reasons to believe that policy measures are able to actually address the problems that are faced by many European countries at the moment when it comes to the labor market. And if you don't like optimism, at least you should probably follow Miley Cyrus' advice. Let's pretend it's not the end of the world. Thanks a lot.
Thank you very much, Martin, for this excellent overview and introduction to our topic. You highlighted that demographic problems are not confined to Europe, but a global phenomenon. You pointed out the 4 challenges, I think, and you also sketched very briefly and very concisely the key policy areas where we should become active. Let me now hand over to Jakob de Haan.
Thank you very much. I'm not going to talk about monetary policy, despite the title of this session. And I'm also not going to talk about normative issues. So this is just research about the impact of technology, trade, and structural reform on employment. By way of motivating, I like to refer to Donald Trump. Then at least I can say he's useful for something. And also, I like to refer to an ECB publication. The first is about, the issue of the impact of trade on US employment or unemployment. And the citation from the ECB suggests that we need a lot of labor market reform. Is it true? Is it really true that trade has an impact on employment? And what about technological progress? And structural reform, as the ECB is calling for, does it really help? Has it any impact on employment? Well, for answering those questions, we do research. Unfortunately, as is often the case with research, there is not necessarily a uniform answer. Well, the good news is that keeps us busy. But the bad news, of course, is that as a policymaker, you want to hear what we can learn from research. So what we do, therefore, in this presentation is presenting, or summarizing, better said, 2 recent papers. In one recent paper with some of my colleagues at the University of Groningen, we conduct a so-called meta-regression analysis on the research of technology and trade and their impact on employment. So there is a lot of research, as I will show you in a second, and unfortunately that does not give you a clear-cut answer. And what we try to do is use meta-regression analysis to find that clear-cut answer. The second paper I'm going to talk about very briefly is also very recent research with some colleagues, again, at the University of Groningen and elsewhere, where we examine the impact of labor market reforms on employment. And we do that using a very recently proposed methodology. In case you fall asleep during my presentation, very likely at this stage of the day, the key messages that I want you to remember from my presentation are, first of all, don't talk about employment effects. Talk about employment effects differentiating between skill levels, because that is key in understanding the literature on the effect of trade and technology on employment. Second, if you talk about reform, again, don't talk about reform on employees. It very much depends on whether you talk about employees with a fixed contract versus those with a temporary contract. As I will show you, the impact of structural reform has a very, very differential effect on both types of employees. Okay, so key question in the literature is to what extent globalization or trade and technological change have influenced employment patterns in advanced economies. And as I said, there's a lot of research on that topic. And there's also a lot of diversity in terms of research. So there are differences in methodology, specification of the model used, data differences, and et cetera, et cetera. And all of these differences, of course, can affect the results. And that's why I think if there's a sufficient number of studies available, meta-regression analysis can be very helpful to draw lessons from that particular type of research. What is meta-regression analysis about? For those of you who don't know it, what you do is to take regressions in a paper as the unit of observation. Yeah? So suppose a paper has 20 different specifications, then all of these different specifications is 1 unit of observation. And you collect all the papers that you can find and that are useful, and you take that entire body of research and try to distinguish reasons why these papers or these specifications come to different conclusions. And based on that, you can draw inferences from the broad literature. Yeah, I skip those, hop, because that's all about theory, and I'm talking about empirics. So what we do is we selected 56 high-quality studies that were all about the impact of technology and or trade on employment. And we tried to distill from those studies as many labor market estimates, impact estimates, as we could. So these are the employment elasticities. And employment elasticities measure the responsiveness of employment to changes in technology or trade. And so what we have in the end is almost 400 estimates for technology and about 350, or slightly more in fact, for trade. And so what can we learn from that research? Well, the first thing we can learn is that it's all over the place in terms of outcomes. Yeah, so this is a graph summarizing the estimated elasticities in both lines of research. And here we distinguish, in line with what I already alluded to, different skill levels, because the impact of trade and technology can differ across skill levels. But even if you distinguish between different skill levels, you can still get results that are widely different. In fact, they can even have different signs. Yeah, so some have a positive elasticity, others have a negative elasticity. Yep. There is, of course, a median. That's the line in the bars. And, well, they suggest something, but again, the main lesson comes out of this graph is that there's a lot of variability. So how can we make more sense of this literature? Well, the figure I just showed you is summarizing the studies without accounting for the many differences that these studies show. So what we do in this meta-analysis is to account for those differences to draw inferences from this evidence-based. So we ask the question, what countries are considered? What time period is considered? What type of skill levels do the studies take into account? What type of technological progress do they measure? What kind of econometrics do they use, etc.? So all of these studies, or better, all of these regressions in the studies used are coded. And we also take into account whether and where the study has been published. So we have a lot of potential differences across these studies, right? And I'm not going to show you all of them in detail, but this is a summary of the factors that we consider to explain why these studies come to such different conclusions. And then, as a next step, we run regressions. Yeah, but we do that in a particular way, so-called Bayesian model averaging, which is just, well, a modern, so-called modern approach to run regressions. In fact, quite a few regressions, because what this modeling approach accounts to is to just use all possible regressions that you can think of. So don't take one you like. No, just run all the models that you can think of that make sense. And then on the basis of a particular measures, the so-called posterior inclusion probability, decide on which of these variables really matter. And this PIP is measuring, in essence, the importance of each variable. Yeah, so how important is that particular variable to explain why studies come to different conclusions? And these are the variables that really matter. So these variables explain why some studies reach a positive yield a positive elasticity and others perhaps a negative one, or why the size of these elasticities differ so much. Yeah, so what, for instance, matters is whether the paper has been published in a peer-reviewed journal or not. Yeah, that matters. The number of observations plays a role, etc. So all of these factors can explain why studies come to different conclusions. So now we have done the first step in our analysis. We can explain or we can identify why studies come to different conclusions. And also we can identify to what extent these factors yield different elasticities. So that's the first step. But, and I'm going to skip this one, what we can also do is the outcomes of that regression analysis to come up with what we could say is the best practice. I don't like the term best practice because that suggests that we know it better. That's not what this implies to. In the meta-regression analysis literature, it's called best practice, so that's what we do as well. But in fact, what you're doing is to use the outcomes of the estimation to come up with a synthetic study. So suppose the procedures that we can identify are used as input. What then do we get? So what we have is, for instance, a clear preference for a model specified in first differences, because that is what the PMA estimate suggests. So if we do that, and if we do all the other things as well, where do we end up with? Well, we end up with this. So this is our reading of the best practice. So if you were to do a research project on the impact of technology and trade on the employment, this is what you will get. And what you will get is, first of all, that you see that the differences, that there are important differences depending on the skill level of the employment. So technology clearly has a positive impact across low-skilled, medium-skilled, and high-skilled labor, but the effect is especially significant for low-skilled and for high-skilled labor. This, especially the low-skilled part, may come as a surprise, but that's what we find. And this is not what we find based on our regression, but this is based on what the literature has to say about it. Likewise, what's the impact of trade? Well, there is no impact when you look at medium-skilled or high-skilled labor. There is a negative impact on low-skilled labor. So that's what you find based on this large number of studies on the impact of trade and technology on the labor market. So the lesson is that if you talk about policy lessons, if Donald Trump gets his way, and indeed trade changes a lot, that may have an impact in the sense that if trade reduces, this suggests that employment of low-skilled people in the US may indeed improve. This is not to say that this is what he should do, don't get me wrong, but our results suggest that this may be the outcome. Finally, how much time do I have? 2 minutes? Yes. That will do. What is the effect of structural reform on employment? There is quite some research again on this issue, although not as much as on the previous topic. But what we try to do is to use our measures for reform of the labor market, which we used in a paper published last year. And the important thing is that this database not only includes reforms of the labor market, but also counter-reforms, so the opposite of reforms. And that is important for a reason I will just explain in a minute. What is also noteworthy is that we distinguish between two types of reforms, because that, I think, is important. First of all, employment protection legislation, and second, unemployment benefits reforms. Unemployment benefits reform sounds good. It essentially means cutting the level of benefits that you get in case you get unemployed. And employment protection legislation means that you can easily fire people. That is what, in essence, these reforms come down to. And as I said before, we distinguish between employees that have a fixed versus a temporary contract. What is new? Well, not the topic. The database has also been used before, although we updated it. What is really novel in this project is that we use a better methodology. Because the problem with this type of reforms, and especially if you want to use a kind of local projection approach, is that most studies ignore whether observations have been previously treated and therefore should disqualify as usable observations. Likewise, there are many studies that do not take counter-reforms into account. And of course, it makes a huge difference whether you compare a situation where there's a reform and then look at what happens versus a situation where you have a reform and then a counter-reform and then look at what happens. Yeah, so that really makes a difference in terms of proper identification. Yes, so we can't claim any fame here, but we took a methodology that was recently proposed, and it's called the local projections diff and diff approach. And that allows us to address all these issues. Yeah, so that's why I dare to say that this is, so far, the best estimate you can get because of the fact that we take care of all the issues that previous studies did ignore, including, by the way, research I did myself. So I'm criticizing myself. What do we find? Well, very simple. If you look at the reform of the protection of people having a contract, how easy can you fire people, then, and if you distinguish between people having a temporary versus a regular contract, then you see for regular contracts, there's no impact whatsoever. So even if you can, fire people more easily in case they have a regular contract, it will not have an impact on employment. In contrast to temporary workers, what you see there is a negative impact. Yeah, so what will happen if you make labor markets more flexible is that employment of people with a temporary contract will go down. What happens if you look at unemployment benefits reform? Again, all the action is in the segment of the labor market where people have a temporary contract, and there you can see a very positive impact. Yeah, so if you make it less attractive to be unemployed for quite some time, then that will have a positive impact on employment. But again, only for that segment of the labor market that has a temporary contract. For people with a regular contract, there is no impact whatsoever. This is a rather shocking outcome, I'm afraid. Not necessarily in line with what the ECB is advocating, but this is what we find and that is what we report. So thank you very much for your attention.
Thank you very much, Jakob. I now hand over to Oscar.
Very good. Good afternoon. Thank you very much, Ernest, and the colleagues from the OeNB and SUERF for inviting me to this very exciting event. The usual disclaimer applies. So I will try to be rather brief. I have just picked up a number of issues that we consider as relevant in our day-to-day analysis at the ECB with regard to the labor market. I don't have a super elaborated narrative, just a few observations, a few, if you wish, messages that I consider particularly relevant in the current juncture or that have been particularly important in our recent experience in the euro area. So I have organized my remarks into first some backward-looking lessons, some lessons from the recent experience, and then I will say something about what I think could be the main challenges when one thinks about structural changes in the labor market and monetary policy making in the euro area. So if I look at the recent evolution of the key aggregates of the labor market since the pandemic, I think it is fair to conclude that the euro area labor market, well, there is nothing like the euro area labor market. It's a collection of quite different labor markets there. But okay, let's pretend there is a single market. And I would say that the evolution, when one looks at the key variables in terms of participation rates, unemployment, and so on, has been quite positive since the pandemic. Of course, there was a significant drop during the pandemic in terms of participation rates, the employment rate, and so on. We know that. But after that, the recovery was quite quick and intense. As Hugh mentioned before, for the UK, in the euro area, we didn't have anything like the Great Resignation. Actually, the participation rate of senior workers increased significantly during the pandemic and after the pandemic, and this is still on the rise, probably as a consequence of the process of aging population that Martin was emphasizing before. Another group, socio-demographic group, which is still increasing its participation in the labor market is that of females. And an important third addition to the dynamism of the labor market comes from immigration. I will say something in a second. So far so good in terms of employment, unemployment rates, participation, and so on. But there is one area in which the performance of the euro area labor market, of the euro area economy, I would say, has been quite disappointing. And this is in terms of productivity, which is the message on the right panel. Here I'm comparing through a very simple decomposition of GDP based on GDP equals employment times productivity. I'm comparing the US developments and the euro area developments in terms of cumulated GDP growth since the end of 2019. And well, first of all, you notice the big gap in terms of total GDP growth over the last few years in these two economic areas. And one single factor stands out as the main explanatory factor when it comes to understand the differences between the euro area and the US, which is this big yellow bar, which is productivity per hour. I mean, productivity per hour in the euro area has been super flat, super low, whereas it has increased significantly in the US. This is not TFP in connection with the discussion that we had before the lunch, but if you look at TFP, it's not that different either. So yes, we have an issue with productivity in the euro area. Productivity has been too low, very low. Some of us expect that it will recover because for sure there was a cyclical factor there pushing down productivity in the euro area. And we have seen some small increases in productivity in the last few quarters. But the risk of being trapped for a longer than expected period in this current situation of low productivity is a non-negligible one. And this may have consequences for monetary policy, as I will say in a second. So immigration, if there is, to me, this is probably the aspect of the labor market in the euro area which has been most visible and more surprising, if you wish, from a quantitative point of view. I mean, as you can see on the left part, on the left chart here, I'm showing the evolution of total labor force in the euro area, decomposing it between foreigners, that is, workers coming outside of the euro area, which is the red bar, and national workers and other euro area workers in the yellow part. So, just to give you a figure, over the last year, in 24, 60% of the increase in labor force in the euro area came from foreigners, from workers coming outside the euro area. So in countries like Spain, which is the country, the large economy which is growing fastest today, at some quarter, something around 80% of the increase in labor force came from immigration. So this has been quite a big thing in the euro area these days. So if you were to do a very simple GDP growth decomposition, again, looking at the contribution of national versus foreign workers, you would find out, as I did on the right panel here, well, first of all, as I said before, productivity explains almost nothing of the accumulated growth in the euro area recently because it has been very low. So most of the growth in the last few years, according to this very simple decomposition of labor, national versus immigration, would come actually from an increase in the number of working age foreigners, which is the light green bar on the right, and from an increase in the employment rate of foreigners, which is the yellow bar. So, I mean, much of the, if you wish, I mean, if you trust this kind of very simple kind of partial equilibrium, the composition of GDP growth, you would conclude that much of the growth of the economy in the euro area in the last few years would come from the contribution of foreign workers, which is quite an important issue, I think. So let me say something on the nominal part. So what we have seen in the last few years following the surge in inflation in 21-22 is a very spatial sequence in terms of the reaction of the main components of domestic demand. Following this big inflation shock, energy shock in 21-22, that we have discussed at length in some previous presentations today, what we saw is that because wages were initially quite rigid nominally in the euro area, firms were able to pass most of this increase in energy and other costs to their final prices. So as a consequence of that, as I said, wages remain quite rigid, quite low, but firms were able to increase their profits. So in 22 and to a large extent 23, much of the increase in domestic inflation was a reflection of a very strong pass-through of the supply shock cost from firms to final prices, and this was reflected in an increase in corporate profits. And this was due to the fact that, as I said before, due to some institutional factors, wage negotiation in the euro area in many countries, as you know, is quite concentrated. And wage agreements typically, it depends very much on each country, but typically wage agreements are signed for a number of years. In some cases, only 1 year, which I think is pretty much a good description here in Austria, but in other countries like Germany or Spain, and more so even in Italy, wage agreements may last for up to 3 years. So this means that it took some time for wages to react. And wages actually started to react already in 23, 24. They are still going up in some places. And while this happened, firms accommodated this increase in labor cost, so they allowed for some reduction in their corporate profits. And this is through this mechanism of buffering the increase in labor cost, we are seeing these days two things that in principle are not super intuitive when considered together. We have seen significant, large increases in wages, but at the same time we have seen a significant slowdown in inflation. The piece that makes these two things compatible with each other was precisely this compression of corporate profits, which is the red line on the left. An important driver of wages over the last few years, according to our analysis at the ECB, has to do precisely with the aim of unions and workers to recover the real purchasing power of their wages. So in a sense, past inflation has been driven wage growth in the last few years. So there was a very strong catch-up motive in wage negotiations. This was something that was has not been seen in the euro area until very recently. Maybe during the first 20 years of the common currency, we didn't see this thing at all. I mean, wages were quite insensitive to developments in inflation, but what we have learned over the last few years in a relatively painful way is that when the inflationary shock is sufficiently large, yes, unions, workers will try to recover the real purchasing power of their wages. And this creates some persistence in wage inflation. So let me look forward and mention some aspects that are particularly relevant today, and probably they will be in the coming years when it comes to think about the potential implications of labor market aspects into inflation and then monetary policy. I think our key problem when it comes to the labor market and the contribution of labor has to do, as I said before, with low productivity. And in particular, what we have seen is that the poor development of productivity has particularly concentrated in the last few years in the case of industry. You see on the left of the chart that most of the slowdown in the last few years took place in the industrial sector. So in services, I mean, productivity was never super high, but it has been relatively stable over the last few years. So yes, we have a serious problem of lack of productivity. This is bad news, of course, no question about it. And maybe the not so bad news is that, or yes, who knows, but maybe a little bit positive is that it seems to be quite concentrated on in the manufacturing sector. I would say it's probably not as, it has a relatively positive interpretation in the sense that, okay, I mean, the manufacturing sector, important as it is not the most important sector of our economy. But nonetheless, this loss of labor productivity in the industrial sector is, of course, having a serious impact, is having very negative consequences on the competitiveness of euro area industrial firms. As you can see on the right panel here, which is drawn from some surveys from the Commission, firms are telling us that yes, they feel that they are losing competitiveness, in particular, and among other factors, but in a very important manner because of the poor developments in terms of productivity. And this is particularly the case in some important industrial economies, as it is the case of Germany, as you can see there. So also looking forward, potential growth in the euro area has been relatively modest. I'm showing on the left here some estimates from the European Commission. The estimates of the European Commission that are probably in line with those of the IMF and those internal ones of the euro system are consistent with potential growth around 1%, which is not particularly high from historical standards. And we expected, or they expected, the Commission expects even some moderation of this potential growth rate. No? As you can see on the left, in the coming years, they expect some further slowdown in this potential growth. So one important factor there is that they expect a decline in the contribution of labor. And this is in spite of the immigration trends that I have mentioned before. So the idea here is that immigration will not be enough to compensate the decline of national population that Martin was mentioning before. So labor is expected to contribute less and less to potential growth in a population that is becoming older and older. So the only way to compensate this declining contribution from labor is to increase the TFP contribution to be more efficient. So this is implicit in the assumptions about potential growth of the European Commission, the blue bars on the left. They expect some positive contribution from technology in the form of higher TFP. And here on the right, I'm showing some estimates produced by some colleagues of mine that have been recently published in an ECB blog, where they estimate that, I mean, in average terms, the adoption of artificial intelligence over the next years could be next 10 years could produce an improvement in productivity of around 3.5 percentage points. This is the accumulated impact over 10 years. Of course, there is a lot of uncertainty on these estimates, and the final impact of this new technology will depend on things on which our knowledge is necessarily very limited at this stage, like the preparedness of firms to adopt these new technologies and their productive capacity as well. But in principle, this should be an important lever to at least maintain these not so high potential growth rates. So what does it mean? What are the main preoccupations or the main concerns in terms of the nominal part, the connection between the labor market and prices and eventually monetary policy? Well, if we face a world in which we are going to be hit more frequently by supply shocks, or if we are going to work more frequently on the supply side that Hugh Peel was mentioning before, probably an important aspect for conducting monetary policy in this environment with more frequent and potentially larger supply shocks is the potential occurrence of second-round effects. I mean, as long as a supply shock does not generate significant adverse second-round effects, you can look through the shock. The problem is when the shock is sufficiently large so as to induce a significant response of wages, for instance. And this is what happened in the last few years. Here on the left, we are using a model to try to estimate the second-round effects through wages of the previous shocks on inflation, which are represented here through these red bars. As you can see there, I mean, these second-round effects were not huge, but for sure they are there. And actually what we are seeing these days in terms of the inflation of the euro area, and in particular inflation in services, it was 4% still at April, is very much a second-round effect. It's the consequence of the previous increase in wages that are now being transmitted to the services sector. Of course, it goes without saying, and this is the message from the right side, that wages are particularly important when it comes to explain inflation in the services sector, because it's more intensive in labor. So a critical aspect for the future when it comes to think about optimal monetary policy in face of supply shocks will be the question on how to estimate this point at which a given shock may trigger, maybe through some nonlinearities, potential second-round effects. Potential second-round effects that eventually may even threaten the anchoring of medium-term inflation expectations. It's a super difficult question, of course, but this is probably, in my humble opinion, the most important question today in terms of monetary policy. So let me finish just mentioning how we are doing in this very complex world when it comes to think about the evolution of what as today is, as I mentioned, the main driver of domestic inflation, which is wages. As Hugh Peel said before, in this very volatile environment that we have been living in the last few years, one cannot trust mechanically the usual tools. I mean, very early in the process of the high inflation episode, we realized that our standard macro models were not a useful guide when it comes to think about the future evolution of wages. Why? Well, because those macro models were estimated with historical data pertaining to the period before the pandemic, when wages would not react at all to any shock, as I said before. So these models had not seen any situation as the one that we were living at that time. So, of course, we look at the models, but in these very unusual circumstances, we have to find something else. And what we found was a very, very useful instrument that rests very much on the collective wisdom of the euro system. Remember, we are not alone on this. The euro system is the ECB, but it's also 20 central banks, national central banks around. So we were able to construct what we call the wage tracker, which captures almost in real time the evolution, the results of wage negotiations in the 5 largest countries of the euro area, plus 2 smaller countries, which are Greece and Austria. So thank you very much to OeNB for the very good contribution on this. And this is very helpful because this is hard data on how wages are evolving, but it has a very strong, a very reliable forward-looking component, because as I said before, wages are set in some countries for a number of years. So once you see an agreement today, in Germany, for instance, you get a good idea of what the wage in this particular sector is going to be in the coming 2 or even 3 years. And this purely empirical tool has become the best guide to navigate these very turbulent times with so many things happening on inflation, wages, and so on. I will stop here. Thank you.
Thank you very much, Oscar. We are now turning to Edward.
Thank you so much, Ernest, for having me, and thank you to the rest of our organizers. I'm really happy to be talking about my research with Enrique Ide. We're both assistant professors at the ESE Business School. And if we could put my slides on, here we go. So this is joint work. Everything I'm going to say is joint work with Enrique Ide. And this session is about structural shifts, and in particular structural shifts on the labor market. And I wanted to start by reminding you of this kind of structural shift that is happening, which is if you go around San Francisco these days, you're going to see these kinds of billboards, many billboards like that. Humans are so 2023, hire an AI business developer representative, right? And you know, I've been fortunate enough to be spending time in San Francisco for the last year, and I see two kinds of reactions to these kind of billboards. On the one camp, there's the, oh my God, we're all losing our jobs camp. And then there's the other camp of, this is all hype. You know, San Francisco is full of hype. There's nothing to be worried about. And of course, I believe the truth is going to be somewhere in the middle. But before proceeding, let me sort of, just in case anyone is on the this is all just hype camp, let me tell you why I think it's not just hype. The truth of the matter is that we're throwing billions of dollars at this technology. There's many labs really putting a big effort and putting a lot of resources into building a lot of computing power and making these things work. So I think it's not just hype. And also, just as perhaps an anecdote can help in terms of the vibe that I see these days around this topic, which is I've been presenting this work with Enrique at the major labs, OpenAI, Google, and so forth. And there, the few economists that are studying the question are like all about unemployment will be huge, the reorganization of society will be immense, and we have to be thinking about all sorts of aggressive policies to deal with this. And then I also, while I was there, I also was invited to present this work at the San Francisco Fed. And I thought, okay, in San Francisco, the Fed, I'm sure they'll be really worried about these kind of things. So the first thing I said when I got there is, will I be talking to the team that works on AI? And essentially their answer was, what team? Right? What are you talking about? So it was pretty much business as usual. And spending the whole day here, I've been very happy to see the vibe here in Europe and around central bankers. And I have the feeling that it's a more similar vibe to the Fed than to OpenAI. So just in case you're still skeptical, I really like this idea of take what-if scenarios. So just, you know, if you still believe it's hype, I think it's still important. It's something that potentially is a big deal. So we can, if you don't believe it's a thing, you can still hopefully go along with me in the next 8 minutes and say, okay, what if this is a big deal? Let's think about this, okay? So what are the implications for the labor market is, of course, the big question. So let me tell you what Enrique and I have been doing for the last 2 years. The first question we wanted to ask is AI just more automation? Is it just more toasters, or is something fundamentally different? We thought it was something fundamentally different, so we had to understand what. This is what the main insight that we got around this, which is what makes AI different from previous automation technologies is that it can do non-codifiable knowledge work, as opposed to codifiable knowledge work. So all previous automation we've seen, be it cognitive or manual work, it has always been about codifiable knowledge work. What is that? It's things that you can put into an algorithm, essentially. You can put into a list. This is how you do this production process. You start with step 1, step 2, step 3, step 4. If you know how to spell out that process, a machine will be able to do it. A traditional machine will be able to do it. What's different about AI is that by training these machines via examples, they can now start doing things that we don't know how to put into an algorithm. We don't know how to put it into a list. And that is essentially everything that had to do with non-codifiable knowledge. Non-codifiable knowledge was just the realm of humans until now. Now AI is entering that realm as well. Okay? And so far, we're thinking about cognitive work, things that you can do on a computer. There's talk also about the future combining these new LLMs and the subsequent models that will come with traditional robots to come to physical AI, so doing non-codifiable manual work. But for now, I think the most relevant for the future, if anything, is going to be cognitive non-codifiable work. So that was the first, I think, important point, realizing, OK, let's point, this is what makes AI really different from previous automation. So the second question is, OK, why is this important? And what we realize here is that actually there's a whole literature for the last 2 decades that has been studying the importance of non-codifiable knowledge for the economy. And the point of this literature, starting with Luis Garicano's job market paper in the University of Chicago in 2000, is this idea that non-codified knowledge work is a major bottleneck in the economy. What's the idea is that once humans, we are all doing things that are non-codified, these are precisely the things that are very hard to transfer. Why? Because we cannot put into a list how you do things, right? As a result, people who know how to do certain stuff, we can only access that knowledge with this individual's time. As a result, you want to have organizations around these individuals to make sure we use their time in the best possible way, right? So what's key about non-codified knowledge is that it's embodied in individuals, it's hard to transfer, and its use is constrained by the humans who have this knowledge, by the time of these humans. As a result, there's a key role of organizations to sort of work around this major bottleneck. Okay? So what was our insight here is, well, if that's the case, and AI is coming exactly for this bottleneck, and AI can be scaled because the main input in AI, once you have the algorithm, is computing power. And computing power is vast and growing exponentially. So the main sort of idea we're pursuing is this idea that AI being able to do non-codified knowledge work, which is a major bottleneck in the economy, it's a major reason why we see organizations structured in the way that they are structured. Now you introduce AI that can automate the major bottleneck of these organizations at scale. That should lead to a reorganization. And we think we need to understand this reorganization to understand the effects on labor markets. Okay? So far we've produced 3 papers. The first one, where we really sketch out the whole approach, is forthcoming at the Journal of Political Economy, so you can see all the details there. The second one we've wrote for the Journal of Monetary Economics. There's this Carnegie Rochester NYU conference where we presented this work 2 weeks ago. It's all about offshoring and the implications of the reorganization of AI towards international trade. And another one we're working on is the Turing Valley. I thought for today's purposes, it would be better to give an example in terms of more policy-oriented. That's going to be the second paper, the one we just presented at the Carnegie Mellon Rochester NYU conference. So I'm going to be talking about the second paper, which is going to be at the Journal of Monetary Economics next year. So it's just an example, very, very quickly. We start with 3 stylized facts in this paper. We say offshoring is increasingly about services. So a lot of the offshoring and the increase in offshoring we've seen in the last decade, it's about advanced economies offshoring services to and especially digital services to India, Costa Rica, Philippines, and so forth. Now, what we observe is that these agentic AI models can actually automate a lot of these services. We see companies like Klarna and many others starting to use, and recently this week UBS said it was starting to use these AI agents for consulting and other services. So we know offshoring is a lot about services. AI agents are entering that point. And also, an interesting thing that motivates this paper is this observation that if you look at the computing power that is relevant to run these AI systems, most of it is in advanced economies. In particular, most of it is in the US. And we think that would have implications for policy. In this paper, we explore this. Okay? So let me give you the three main messages. The first is this won't surprise you given what I said before, is that the AI scalability has the potential to lead to a major reorganization of international trade, right? So currently we have advanced economies offshoring a lot of routine service work to developing economies. If AI can start doing this routine service work and the compute to do that we need to do that is in the US, that can completely lead to reduction of offshoring. And there we see a lot of interest in developing economies and a lot of worry about what's going to happen if we stop offshoring. India's economy, a large fraction of it is dependent on this offshoring knowledge work. So it's a big deal for many economies. So what is our main message here? Well, working through the model, we see that actually AI can lead to more offshoring or less offshoring, depending on how good AI is. If AI is not so good, actually the concern is valid and it can lead to reshoring. But if AI is actually very good, if it can solve a lot of problems and it's very capable, then actually it can lead to more offshoring. So that's one main message. Second is we can start thinking about policy and we can say, oh, perhaps what we observe is that once you introduce AI, it tends to increase labor income inequality. So you might say globally, you might say, what can we do about this? Well, could we restrict the autonomy of these AI agents? The key about this agentic AI is that these models can be autonomous, can go out in the world and do a lot of stuff by themselves. You could ask, oh, what if we could regulate that, restrict that autonomy somehow? Well, that would lead to lower labor income inequality, but it would also lead to lower global output. So there would be this trade-off here that policymakers would have to navigate. And the third, and possibly the most interesting for this audience and for developing economies more generally, is that the ability to do meaningful regulation in these terms of AI autonomy actually depends on your having computing power in your jurisdiction, right? So countries that don't have computing power in their jurisdiction, essentially, if they are going to regulate AI, they can only regulate how individuals in their jurisdiction can use AI. And using the model, we show how that actually is going to just harm, just restricting AI autonomy via this way. If you cannot restrict how computing power is used because it's not in your jurisdiction, that does lead to lower labor income inequality, but it doesn't really help the least knowledgeable individuals. So really having computing power in your jurisdiction is key to have meaningful ability to regulate. And that's potentially very relevant to the discussion in Europe about AI regulation. Okay, so let me finish by just saying the essential idea that we're pursuing across these various papers is that AI is potentially a big deal because it can potentially automate a big bottleneck that has shaped how organizations operate. And if we deploy AI at scale, that can lead to a big reorganization of society. And we want to understand this reorganization because we think once we understand this reorganization, we can understand the effects on the economy. Final point, again, depending on your views about the technology, depending on how familiar you are, this might sound that is very far-fetched, but I really like the point before about, well, we need to be prepared. We need to have what-if scenarios, and I believe this is a very important what-if scenario because it's a technology that has a lot of potential. I hope you'll give me that. And it's moving very fast. So I think understanding and this ability of AI to actually lead to big reorganizations can lead to potentially, in the short term, unemployment that comes just from these reorganizations. I think we need to be ready to understand how to optimally respond to this and how to understand what even to measure to understand at what point of these reorganizations we're at. So I hope there's going to be much more work on this. Thank you so much.
Thank you very much, Eduard. If we stick to our timetable, and I understand there is a hard constraint by 2 panelists needing to go to the airport, so I think I have a good incentive to stick to the timetable. We have 10 minutes or so for Q&A. Are there any questions? Yes, David.
Yes, thank you. Yes, sorry to return to the theme of Sherlock Holmes, but again, it's the dog that didn't bark, because I don't think any of you has spoken about monetary policy, even though that's in the title. So I did want to ask Martin Koch, if I could, please, to embark on this dangerous terrain. You've been very fastidious in sticking to the labour market issues, but given the fact that we do have this debt problem, that's another big D, along with deglobalization and demography, I just wonder whether you think, as a novice and not yet baptized member of the Governing Council, whether you think that the very large debt levels in some countries in the European Union monetary area are going to constrain the ECB from perhaps what would be the right, healthy policy in coming years. It's a fairly easy examination question for you.
Well, maybe let's start with Oscar on the labor market impact on monetary policy. What's the thinking in your analytical units?
Well, on the second question, actually, by David, yes, it's a relatively simple question. The ECB will do whatever is needed to deliver on the mandate, as you know, no? And as you can expect. No? You didn't expect other answer, I guess. So, I mean, the labor market is critical when thinking about monetary policy. I hinted at some important element there when it comes to calibrate the optimal response in face of supply shocks. No? But at the end, monetary policy is about managing the impact of imbalances between supply and demand. It's all about that, as simple as it sounds. So. And the labor market is absolutely critical when it comes to both sides, demand and supply. And some of the changes that we are seeing these days will probably change profoundly the way we understand some aspects of the two sides of the economy. Let me mention two examples. When it comes to the supply side, when we did this strategy review, monetary policy strategy review in the year 2021, of course, one important aspect there that was already factoring in our collective thinking was the fact that the societies were aging. And our conclusion there out of this observation was that this would probably push inflation downwards for many obvious reasons. But these days, based on the recent experience, I think it is fair to put some more weight on potentially inflationary factors coming from this process of aging. And Martin hinted at some. Something that we just didn't expect. Maybe Charles Woodward expected, but not many others expected, was that the labor market would face labor shortages. And we have seen that. And part of it, we think we know now, has to do precisely with this process of aging. Many high-skilled people, low-skilled as well, but high-skilled people in the manufacturing sector in particular, but also in the construction sector and so on, are going to retire and are retiring. And this is, for many corporates, this is a big challenge. How to replace this level of skills is being a big challenge. And this is probably giving rise to some labor hoarding. Many firms prefer to keep these high-skilled workers, in some cases are senior workers, with them even when demand is relatively low. And this has consequences for productivity. It typically will make productivity more pro-cyclical. And this will have consequences on labor cost. And this will have consequences on inflation. And as a policymaker, a monetary policymaker, you may want to pay attention and try to understand this phenomenon because it will affect the level and the cyclicality of inflation. This from the supply side, for instance. From the demand side, let me just mention something which is pretty obvious. The core element, the core lever behind the narrative that we at Frankfurt have about the recovery of the euro area economy after the high inflation episode hinges very much on the evolution, the joint evolution of employment and wages. The main driver of growth is been so far, and let's see what happens in this complicated future, was this idea of a recovery of consumption based on the recovery of real incomes, which in turn is the consequence of this relatively stable employment pattern, this relatively robust labor market behavior, plus this gradual recovery in real income. So these are two aspects that are absolutely critical when it comes to analyze the macroeconomy, which is, of course, a prerequisite to get it right in terms of monetary policy. So,
thank you. Yes, please. Ermal, I understand. Yeah?
Yes, that would be Ermal from the European Stability Mechanism. And this question is to Edward, and it's not on monetary policy. I recall 6-7 years ago at the IMF, there was this presentation on the services most likely to be affected by artificial intelligence. And the usual suspects were retail and finance and administration. And one that was considered safe from AI was priesthood. Being a priest would keep you the safest from AI job threats. Now, in your work, have you looked at what are? I'm not saying that we should go in that direction. Although this is a nice Catholic country, but in your work, have you looked at services sectors of, let's say, not just high cognitive scope, but high creativity that are the safest from AI interference? Do you have some sort of a grading or taxonomy of services according to their AI vulnerability?
I would love to. I think it's a great question, very relevant. We don't have what you ask for right now. What we do have is this literature that I've been referring to, started by Luz Garicano and followed by many others. Knowledge is always unidimensional. And when we present this work, oftentimes we get a similar, it's not your question, but it's a similar question of, wait, but knowledge is multidimensional. How do I think about that? So now this is why we have this third paper. It's called the Turing Valley. And it's looking at now we're generalizing to multidimensional knowledge. So now you can have creativity and you can have hard skills, quantitative, qualitative, whatever you want to call it. And then there we're studying, using the same kinds of models, what happens when AI becomes better in one dimension versus another dimension. And there is a notion of labor income first going down when AI improves and then going up. That's why we call it the Turing Valley. And why is it called the Turing Valley? Because the bottom of the valley is exactly when AI passes the Turing test. So while AI is worse than humans at any particular dimension, you improve AI in that dimension, labor income goes down. And that has all sorts of implications for policy as well. So I'm not answering your question, but that's the closest I can get.
Yes, please.
Yeah, Thomas Haar from Danish Central Bank. I have two different questions. So one for you, Jakob. I think you said something about that trade is actually bad for high-skilled people. And coming from a small open economy, we think that the high-skilled people have benefited enormously from trading, and trade have grown a lot. So I just want to, if you can give a comment on that. And then to you, Oscar, I guess when you talked about productivity in Europe and why it has been so low compared to US, how much weight would you put on after COVID that you had all these Kurzarbeit labor compensation scheme, which you didn't have in the US? So I was just wondering whether you think that is also explaining a bit of the low labor productivity in Europe. Thanks.
Could you please put on the slide, one of my slides? Back. Further, please. One further. Yes, that's the one. Okay, this is the summarizing graph that we draw based on this line of research, right? And what you can see is the impact of technology and trade. Technology is blue, and what you can see here is that technology has a positive impact, according to all these studies, on low-skilled labor and also on high-skilled labor. When it comes to trade, what you can see out of this graph is especially low-skilled trade suffers from trade. Low-skilled labor suffers from trade. Yeah? Think of outsourcing, obviously. The effect on high-skilled labor, on average, that we find is none. Yeah, that doesn't mean that there can't be any exceptions, like perhaps your country, yeah, but according to this broad set of studies, on average, the effect on high-skilled labor of trade is zero.
I think I could take one more question.
Can I say something to Thomas very quickly?
Thomas, yeah.
He had two questions.
Yeah, very quickly, Ernest, if I may, to Thomas. I guess you are referring to the potential negative impact that the short-term protection schemes had on the potential reallocation of workers across sectors and firms in the euro area, in Europe more generally, and that were not present in the US because they didn't care much about protecting jobs at that time. Well, in principle, it's an appealing argument. I am not aware of any empirical study that has found that this is a materially important channel to explain the low productivity issue in Europe. Some colleagues of mine at the ECB have tried to analyze this issue, and the results were in the direction of, okay, this does not seem to be a first-order importance element. Moreover, what they find is that this slowdown in productivity, especially when it comes to the manufacturing sector, is something that is seen everywhere. It's not the result of a composition effect of some sectors or firms keeping too many workers, whereas others not being able to attract the skills. No, it's something that it's happening almost everywhere in a universal manner. So I would look at different factors that are probably more general, affecting all the firms, rather than trying to, well, I mean, I don't think these schemes did play a significant role. I would look at issues like the energy crisis itself, labor hoarding factors, aging, and so on. This, to me, seems more promising.
If I just may add one sentence, I think the fact that we have this gap between labor productivity growth in the US and the European Union for quite some time already before the pandemic is also an argument why the pandemic inefficiencies or the consequences of the pandemic policies that might have led to some inefficiencies is probably of a minor importance in the long run, actually. Then.
Martin, if I may follow up with you a little bit. So we have gotten an impression of the, in reality, much bigger range of tools that the ECB uses to analyze labor markets. So that's central banks. So central banks use this analysis as an input to gauge, labor wage pressures and inflation pressures. But of course, the more competent authorities are the governments. And you just come from a job where you were at the core of labor market policies, and also across European countries in the Council of Ministers and so on. So to what extent, in your experience, do countries use the opportunity within the EU to learn from each other, to learn from best practices and so on? Are there any outstanding examples within the EU from which other countries like Austria could learn?
Oh, of course, they are. To be honest, actually, there's much less learning going on than I think would be optimal, actually, between European countries. The reason is that there's a lot of navel-gazing in the policy debates that we have, the national policy debates. Especially labor market policies are very strongly domestic discussions because there's differences in the different policies that are close to labor market policy, like education policies, social policies, and then of course it's much more difficult to take a look at another country and adopt some of the measures because it depends on the entire system that works together. On the other hand, there's lots to be learned, especially in active labor market policies, and I think one of the changes we need in labor market policies is a change away from the standard passive labor market policies, which means unemployment benefits that we had for a long time until 10, 15, 20 years ago, to a much more active approach, which includes, of course, reskilling and upskilling much more strongly than we did so far. Given the change in technology, given the change in many industries, I think that's the way we have to go. And active labor market policies, so how to train people, how to incentivize these trainings, what firms can do actually to organize that. This is much easier to learn than the standard, or much easier to observe from other countries than the standard passive labor market policies like unemployment benefits that are based in a system of benefits and policies that are much too different across Europe at the moment, I would say, actually. So I think there's more learning going on there, but there could be much more, and we are actually reinventing the wheel much too often in the European Union.
A typical example that comes to mind is Denmark.
Absolutely, you're right. If you take a look at countries, Denmark is a very good example. But again, if you compare Denmark with Austria, very interesting. Denmark has less than 100 municipalities. And the labor market policy and the social policy is done at the municipality level, which makes absolute sense there. But of course, you can't do that in Austria. We have 2,200. So,
yeah. I think Jakob wanted to come in.
Yeah, there's one thing I think, listening to several contributions in this panel, what really makes me think about the future, also from a policy perspective. If indeed migration plays such a very important role in also explaining growth. And if I see at the moment, the change in attitude in many European countries, talking about learning, there's already quite a few countries that try to restrict migration. Whether that's going to be successful or not, I'm not sure. But suppose, it works. If true, then your results suggest that our labor market will even become more tight than it already is. And that may, of course, have implications also for inflation. So if that pessimism is correct, then I think you in your new position may face some very challenging issues in the near future, because inflation will then, no doubt, go up.
I fully agree with your analysis, Jacob, but let's keep in mind that immigration has effects on inflation through many channels, not only the labor market.
That's true.
I think it was Hugh who mentioned before that it's probably generating some housing price inflation as well. I mean, if you go to my home country, Spain, I mean, you can see it there. Of course, immigrants consume. They are part of the supply, but they are part of the demand. So on this, I must confess, I don't have a clear view on the final inflationary effects. But in terms of the level of tightness on the labor market, I think that your analysis is impeccable.
So I draw as a conclusion that central bankers should not only be volcanologists, geopolitical experts, health experts, as we saw during the pandemic, but also migration experts, housing market experts, and so on. So my solution would be, let's not do that. This suggestion for present governor and future governor, let's rather have consultants coming in. So this is where Jakob then comes in. Just buy the service and the knowledge for, where you need it ad hoc. So this concludes our session and also day one. Thanks to our speakers, Martin, Jakob, Oscar, and Edward. This was really very instructive for me. I learned a lot. And to all of you for your interest and for your questions. I hope we see all of you tomorrow morning at 9 o'clock for 2 super interesting academic sessions. I can promise you this will be very thrilling, and I hope to see you there. Thank you, and see you tomorrow.